done very well. Small mid-cap companies in India have actually been doing much better than some of the larger cap companies. But you look at larger cap companies too, it's about being selective again and finding those idiosyncratic stories where there's strength. So we've talked about some of my favorite companies like Adani Ports, where you're really seeing integration with respect to their clients. M&M is a company that's been hit a little bit because of the conflict. If there's a resolution, I think those shares look so incredibly cheap. GMR, that's another company, GMR Airports. I like it because it's levered to the travel theme, but there's also ballast around it with respect to real estate, duty-free, how they operate within the airports, and it's also more domestically levered to India. And I think the perception outside of India isn't the same as inside with respect to how the consumer is able to do, especially perhaps the middle class and upper middle class who are still able to travel despite this conflict. So it's all about being selective about what you own in this market.
All right. Hi, Matt. Morning. Good to see you in. I thought Interglobe Aviation as well was coming up on that list, given that crude oil prices are down. That's the earlier favorite that you had. And also in the banking names, you've normally liked some of these larger private sector banks. What's the pick over there?
Yeah, so Interglobe it's been challenged by a number of exogenous shocks that it's had. I think I'm going to wait for more of a recovery before really getting back into that name. But again, it's a high quality name. They've added to their fleet. They're going to come back. It's just a question of when, and where putting that marginal dollar to work can be most productive. If we do get a deal, Nigel, I think financials could do very, very well because they've been beaten up incredibly hard. They're trading very cheap on a PE, price to book. I like the valuation perspective for some of these larger banks, but the macro narrative has been challenging. So if there's a catalyst to change that narrative, I'd rather wait for that to happen because there's plenty of room on the upside to see the shares jump. So again, it's a story of watching very closely, but waiting before I'm going to put a little bit more money to work in those names.
Thank you. Matt, always a pleasure speaking with you. Sorry, I think I called you Raymond earlier, but thank you. Thank you very much for joining in. Always a pleasure. Let's tell our viewers the interactions lined up on the show today. So coming up 8:35, we have ETO Markets, Jonathan Barrett, to talk about the fall seen in crude prices. 9 a.m. We'll be joined by Jay Kali of Elara Capital to put the spotlight on the auto sector. 9:20, Pankaj Murarka, Renaissance Investment Managers, will be a market master for the day. 9:30, the management of Narayana Health will join in on Q4. Following that, the management of JK Cement will chat with us. 9:40, 9:50, we bring you another earnings conversation, this time with the management of Anupam Rasayan. Towards the end of the show, Lata will chat with Neeraj Seth of 3R Investment and Mithul Kotecha of Barclays in today's It's the Economy.
Time to slip into a short break. We've got a lot of stock-specific action to track with today in our special Top 10 segment. We're looking at Eicher Motors, Hindalco, Fortis, Colgate, Anupam Rasayan, Bliss, GVS Pharma. All of them will be reacting to positive news flow, while we have NTPC, Divi's Laboratory, JK Cement that will be reacting to negative news flow, and we'll expect a mixed reaction on all the stocks that are reacting to the crude oil price moves.
Welcome back. Let's talk about stocks. This is CNBC TV 18's list of top stocks for the day. Our entire research team is standing by. But let me begin with earnings from Aisha Motors. Sudarshan now joins in with the fine print. Good morning.
Good morning. So it was a good set of earnings from Eicher Motors for Q4 FY26. As far as the volume growth is concerned, it continues to be healthy, and that has aided the revenue growth. And in resultant, company has posted revenue growth of almost 16%. And for Eicher Motors, the concern has been around the margin, but this time also company managed to hold to the margins to levels around 25%. It has come at 24.9%, almost in line with our expectations. Profit too has seen an increase of 12%, and EBITDA has seen a jump of 20%. Now, like all the other companies, Eicher too has faced the commodity cost increase of 90 basis points, but the price hike to an extent has mitigated that impact. For Q1, company is saying that because of commodity cost increase, the impact can be in the range of 3 to 3.5%, but of which 1.75% price increase is already taken, and remaining that will be done through other means. So overall, their entire impact can be offset because of the measures that company plans to take. Second, about the volume. So in the month of May, because of manpower issues and LPG shortage, they had the production issue and also supply issue. But on that issue, company is saying it's being resolved. So overall, Q4 earnings were good, and near-term outlook is also looking healthy. And I'm going with green.
Okay, all right. So Darshan, thanks a lot for that. Well, I'm going with green on Hindalco. The Q4 FY26 numbers were better than expected. I'll tell you what, Q1 FY27 will be even better. But just keep in mind, the stock ended at the high point of the day. And since the onset of this Middle East conflict, Hindalco is up 20%. It's even outperformed the Nifty Metal Index, which is up close to around 8%. Taking you through the basic numbers, the total India EBITDA was better than what we were working with at around 6,600 crores. The aluminium segment as well was close to 50 crores better than what we were working with. And copper was a pleasant surprise at more than 900 crores. On the aluminium side of things, the EBITDA per ton for the upstream business, that came in at $1,750 per ton. Tracking the company from the time, it's a little closer to around $1,000 per ton. So splendid set of numbers out there. And I'll tell you what, the next quarter will be even better because aluminium prices currently are around $3,600 per ton. For the past quarter, it was sub $3,200 per ton. So this quarter will look much better. Copper business, how did it come in at 900 crores? Well, it's driven by the sharp increase in byproduct prices, which is effectively sulfuric acid prices. And also value-added copper as a percentage of the mix moved to more than 70%. The debt remains at around 65,000 crores odd, but that was more or less on expected lines. Green to start for Hindalco. But the other frontline name that came out with a set of numbers was NTPC, and Vivek's going to dissect those numbers for us. Morning, Vivek.
Well, good morning. NTPC along its peers, especially when you're talking about the power sector, slightly subdued quarter, low PLFs, low demand is something that marred this particular quarter. So weak demand outlook, muted generation, low PLFs, but the company has kept the outlook steady. In terms of the numbers, it's a miss across all of the estimates that we were working with. Revenues down by close to 2%, EBITDA higher by 11%, margins expanding by over 350 basis points. Now the reported tax is not entirely comparable on a year-on-year basis because of a deferred tax benefit that the company has taken and a remeasurement of the tax. So the adjusted PAT is up 6%. In terms of the key guidance that the company has given as far as FY27 is concerned, they have reiterated close to 9.5 gigawatt of capacity addition, of which a little over 1 gigawatt is thermal. Almost 8 gigawatt will be renewable energy via both its own NTPC green arm as well as the JVs. Now talk about the FY27 capex guidance, close to 40 to 45,000 crore. So overall, because it's a miss on numbers, going with the red, but the outlook remains steady, which is a positive read-through.
Thank you very much for that. Ekta now joins in to tell us about Fortis Health and Divi's laboratory.
Morning. Well, I'll start with Fortis Health. It came out with what was a good set of numbers. So the revenue was up around 18%. The EBITDA was up around 22% year-on-year. Margins expanded to 22.5% versus 21.7%. And it had a profit which was up around over 40% as well. What took place was the hospital business did well. So it was revenue was up 19% there. Occupancy was steady at around 68% versus 69% year-on-year. And the diagnostics business had the margins expand to 22% versus 18%, and that's what resulted in the overall margin improvement. Divi's Labs numbers were largely in line with estimates. So revenue growth was 10%, was led by segments such as custom synthesis. The margins were within that range of around 32 to 34%. Now, the company has reiterated its double-digit growth target for FY27. Margins to remain at 32% in FY27, broadly stable. New products should contribute to volumes in FY27, and the company company remains focused on the execution pipeline. I expect some red on the stock simply because the street was working with estimates of as much as 20% in terms of growth, and it is an expensive stock, so maybe there could be some amount of profit booking.
All right, thanks very much, Ekta, for that. So Divi's keep an eye, perhaps a little red, as Ekta points out. Colgate is what we want to focus on next. Mangalam has got details here. Mangalam, morning.
Good morning. So it's a shining set of teeth coming in from Colgate this time around. Why do I say that? Because, the expectations weren't much. We were expecting mid-single digit sort of revenue growth. The company reported high single-digit revenue growth. So closer to 1,600 crores on the top line as against expectations of it being closer to 1,500 crores. Revenue growth at 9%. The expectations were that of 4%. EBITDA at 510 crores. The street was working with a number shy of 500 crores. And the net profit came in at 353 crores versus expectations of 357 crores. But this, remember, contains an exceptional loss of 17 crores. So you add that back and it's a 9% jump in the net profit as well. The management commentary was fairly sanguine too. They said that the growth has been balanced between both pricing and volume, which implies mid-single digit volume growth, a multi-quarter high for Colgate. Momentum, they say, was broad-based across core and premium portfolios. And the strategic premium portfolio of the company growing at 3x. Remember, the stock is down 18% over the last 12 months, has been a bit of an underperformer. So we may see a bit of a pop on Colgate today. The only question, whether this double-digit sort of growth continues into the next few quarters or not.
Got it, Mangalam. Thanks a lot for that. I'm looking at JK Cement and maybe a tinge of red to kickstart trade today. Remember, the volume growth was solid, and that's the one that's actually led, the top-line growth out there. But realization's not as good due to the white cement business. The grey cement, well, that's done pretty well, actually. But the white cement business, which is a smaller in quantity, but it gives higher amount of realizations, that was a little subdued. And to give you a revenue number, white cement is approximately 20-22% of the revenue mix. Margins are a little lower than expected because realizations were a little soft, particularly in the white cement business, and input costs spiked up. That's why the EBITDA per ton came in at around 1,010 rupees per ton. Jeffries was working with a number of around 1,040 rupees per ton. And the net debt number, well, that has stayed more or less stable on a quarter-to-quarter basis at around 3,400 crores or thereabouts. But there was another big deal that was announced over the weekend, and that's why we'll have Anupam Rasayan and Bliss GVS Pharma that will be in focus. Ekta joins us to run us through those details. Ekta.
Well, interesting deal. So Anupam is going to acquire 43.3% or 48.2% stake in Bliss GVS Pharma. Total will be around 1369.5 crores. The company has the option to acquire an additional 5% stake. So that would be a total of 154.9 crores. There will be an open offer which will be made as well. It will be funded by a loan of 300 crores and a non-controlling and non-voting equity instrument for the balance amount. Bliss GVS manufactures branded formulations. They have a flagship anti-malarial WHO endorsed brand which is called Lonart. They have 6 manufacturing facilities as well. Now, if you look at their FY26 revenues, revenue was 927 crores, margins expanded to 18% versus 16%, and profit of 135 crores, cash of 167 crores on their books, and 0 debt. So this is going to be an interesting deal, which will propel Anupam to get into the formulations segment when it comes to Bliss GVS Pharma. And for Bliss GVS, it will be the promoters exiting.
Thank you very much for that. Bliss GVS Pharma is a stock which has rallied 83% since the start of the year. And keep your eye on oil marketing companies because there has been that 4th petrol and diesel price hike. And now cumulatively, in about 10 days, petrol and diesel prices have been hiked by 7.5 rupees per litre. But that said, crude prices are trending down today. This morning, Manisha is joining in to talk more about that. Manisha, what's happening in commodities?
Well, we've seen a sharp decline come in for the crude oil prices. Remember, it's a long weekend for U.S. The markets are shut for U.S. markets today, and it's expected to be lower volumes when it comes to Asian and the European markets as well. But we have seen a 4 to 5% of a decline come in for the Brent crude oil prices, and with that, it's trading at a 2-week lows. Not just crude, but heating oil is trading at a 2-week low as well, gasoline at a 4-week lows, and the market's also taking our cues from the U.S. and Iran statements coming in. The street believes that with more and more now countries getting involved, conversations coming in, statements being released, it does look like that a peace deal is not too far away. The potential U.S.-Iran deal could reopen Strait of Hormuz, and as the statements have been coming in as well, that a framework for a peace deal with Iran is largely negotiated. But what the markets do not like is uncertainty, and that still continues to be in there. The U.S. says that they will keep the blockade of the strait in place until a formal agreement is reached. U.S. also has said that they are in no hurry to enter a deal that that would not give them complete control of what all they have been asking for in sense of those pointed agendas there. And is the reason we are still holding around that $98 to $100 a barrel mark at this point in time. The street has seen a lot of volatility going in, and the expectation is that if the Strait of Hormuz actually opens, you could be looking at 80 to 95 of a range, then continuing for this quarter and the next as well.
All right, Manisha, thank you very much for that. So that is the oil situation right now. So just under 99 at this point. Well, stocks with positive news flow that we covered are Aisha, Hindalco, Fortis, Colgate, Anupam Rasayan, Bliss, GVS, Pharma. They're up on your list. And of course, stocks with negative news flow, NTPC, Divi's, JK Cement. Well, of course, it's a bit of a mixed view as far as crude sensitives are concerned. But you know, the broader overlay is positive, so it's like a rising tide this morning. Let's just hope the tide doesn't go out by 3:30 and things look up. Okay, well, Vivek is now standing by with the FTSE changes which are afoot. Vivek, good morning.
Good morning. Well, over the weekend, FTSE announced index review changes as far as the quarterly index rebalancing review is concerned. Quite a few additions as far as the Indian stocks are concerned. These stocks will be added to both the FTSE All World as well as the All Cap indices. Tata Capital expect close to $60 million of inflows. Lenscards, mostly you'll see newer listings. LG Electronics, Meesho, ICICI Prudential AMC, Grow, Billion Brains Garage, as well as Tenneco Clean Air are the stocks that will be included into the FTSE All World as well as All Cap index. Tenneco Clean Air will be added to the All Cap index only, and the highest inflow will come into ICICI Prudential AMC with a little over $55 million of inflows. On the other hand, All Cargo Logistics will be a deletion. Expect small $2 million outflow in this particular name. All of these changes will be effective June 22nd, 2026.
Thank you very much for that. We will get into a break. On the other side, we'll talk more commodities. Jonathan Barrett will join in to talk about commodity markets, where we're headed.
Welcome back. Here tuned into Bazaar Morning Call. Well, it's that part of the show when Hormuz joins us to tell us about some of the big movers on Friday and some of them that were backed with delivery. Hey, Armas, morning.
Morning, Nigel. And NASA Consumer was among the top gainers on Friday. Saw a big up move after its results. The stock at one point was up around 10 odd percent, recovered, fell slightly off the highs, but still ended with gains of around 6%. The fourth straight day of gains, the biggest single day gain in a year for the stock. Volumes were the highest on record as well. Close to 7 crore shares were traded. The 20-day average is only 6 lakh shares, and around 9% of those shares are marked for delivery. So around 52.5 lakh shares for delivery. The 20-day average here is only 3 lakh shares, and in fact the volumes also were the sum total of the last 63 sessions put together for Honasa. The stock was the most traded on the Nifty 500 on Friday. Although it's only up around 17% from its issue price, it's still at a 52-week high. On the flip side, a negative earnings reaction on Friday was Engineers India, the biggest single-day fall that the stock saw since June of 2024, and the third straight day of losses. Volumes were the highest in over a month. Close to 2 crore shares were traded, that is 4x its 20-day average, and a third of those shares were marked for delivery. So around 57 lakh shares for delivery. This too was around about 3x its 20-day average, and the stock has given up almost 50% of the gains that it saw from the lows of the 30th of March till the highs of the 7th of May. It's retraced almost half of that rally. Now, and LIC was one such mover as well. The stock again cooled off the highs during the last hour of the trading session. Volumes were the highest in a year. Close to 2 crore shares traded here as well. The 20-day average is only 13 lakh shares. Half of those shares were marked for delivery. So 94 lakh shares for delivery. The 20-day average is only 6 lakh shares. So significant delivery buying seen in LIC. It was the fourth most traded stock on the Nifty 500 on Friday, and the stock is down around 17% from its 52-week high, which is 980. The all-time high is well over 1200, and the stock is well below all of its three issue prices. There were different ones for policyholders, retail, and for institutional investors. Trades below all of those.
Okay, all right. Thanks a lot, Harmas, for joining in and giving us, all of those details. Well, for the time being, I think we'll slip into a short break. Come back. We'll go full tilt on commodities. We have Jonathan Barrett, who's waiting for us to discuss the big swings we're seeing in the commodity markets. Stay with us. Welcome back. You're tuned into Bazaar Morning Call, and that screen is telling you the picture. Brent crude prices are lower. The GIFT Nifty suggesting a bombastic start. And guess what? A lot of the FI participation could be lower today because quite a few markets are shut for today's trading session. The mother market as well, US markets, are shut for Memorial Day. Well, let's get in Jonathan Barrett, Chief Investment Officer at ETO Markets, who joins us on the show. Hi, Jonathan. Good morning. Good to see you in. What are you making of these wild swings in Brent crude prices? Directionally, do you think we are lower, going by the commentary that we have heard? And this has been going on for a fair bit. What are your estimates in terms of crude oil?
Look, it's quite an interesting opening this morning. I think when you look at particularly the Brent contract and the comments made over the weekend, it's ripe for it to trade lower. Very interesting to see that the US are obviously saying we're getting very close to a conclusion to the war effort. Iran saying there's still a few more sticking points. I guess that's creating the volatility. But I do get a sense that at the end of the day, both parties, both the US and Iran, want to do a deal. It makes sense to do a deal. And I think there's external pressures applying on both of them to actually make a deal. And that's primarily China. So I guess we're getting very close. There are a few sticking points, but I think a deal will be had. And I think as a result of that, oil prices should go lower.
Okay, so what would the broad estimate that you'll be working with crude oil prices in hopefully the post-war era?
Look, I think it's really interesting. When Epic Fury was actually launched, remember that was on the 28th of February, crude oil prices were trading at around $70 a barrel. So given where it was trading, does it make sense for crude oil to come back to that level? I think it's a bit tough because we really need to see how this will unfold and how the deal will unfold. But I do get a sense that prices will trade lower. I do get a sense they'll probably trade back to 80, 85. And I think it might be quite sudden. I do know there's a lot of backlog, a lot of orders to be filled. But at the end of the day, I think the market likes to price in where ground zero will be. And as a result of that, I think we've got a little bit lower on the downside to go.
All right, Jonathan, from an India equity market perspective, $80, $85 per barrel, we'll take that, I think, because the fear was it could be up and running. Got that. Let's focus on the other one, gold. Since this entire conflict broke out, gold had corrected close to around 17 to 18% approximately. It's holding at around $4,500 an ounce. But otherwise, things were shaping up pretty well. What's the trajectory on gold from here on? And in that light, what about silver? That's seen a sharper correction, $120 all the way to around $70. Currently, it's holding closer to around $80 odd. Where is that one headed?
Right. Okay. When we look at gold, and we take a look at gold first over silver. When I look at gold, I get a sense now the market's got to assess where they think US interest rates will go as a result of a deal that is done in the Middle East. Now, if that's the case, the market has been factoring inflationary pressures. Inflationary pressures hasn't seen gold move higher. So I expect the opposite to occur. So if in fact we do get a deal, then the trajectory for gold will be higher because people will say, well, look, we're not going to have interest rates moving higher. They'll be going lower or stable. And that's a good environment for gold. So I think gold will start to trade higher. In fact, had a great bounce this morning. So I'm encouraged it'll go higher over the next coming trading week.
Okay.
Silver is very crucial. Sorry.
Yeah. So ultimately, if you were to give us, say, a 12-month target with regard to gold, what would it be?
I think we've got to retest the highs again. Okay. I'm that bullish to where it'll go. And I think gold will retest its highs. If the US starts to move into, because of the economies are slowing down, if they start to move that, then they're going to have to move on their interest rates or do nothing. And I don't think they can actually tighten. So I think that'll give it a bit of a push for gold. So yes, I'm quite bullish gold. I would like to see it trade to those record highs, but just for the week, I think it'll be up and higher on the week.
Got it. And you were making the point on silver?
Yeah, silver's very interesting because silver has so much application, and I really get a sense of a lot of news coming out of China in terms of China's use for silver, and their imports of silver have just continued to increase up around about 50 to 100%. So if China is actually playing that environmental, the green economy, then you'll find that they don't have the silver they need and they'll have to be in the market. And that was one of the reasons why silver traded to that 120 level. So I get a sense that silver to me has always been a buy on dip. whilst we're merging into this green economy, particularly more so if China sort of really made that mark as a producer of particularly green cars, etc. So yeah, silver in my mind, back to that 110, and then even 120 and even higher throughout the course of the year.
Silver over gold then?
Silver over gold, yes, sir.
Well, Jonathan, it's always a pleasure having you on the show. Short but crisp chat. We appreciate you giving us all those inputs. Next time around, we'll discuss a little bit on industrial metals as well. Have a good day ahead.
Thank you.
Let's welcome Devin Choksey, MD at DR Choksey Finserv, who joins us on the show. Hi, Devin. Good morning. Bulls will be happier this morning. You're always smiling, but the Bulls will be smiling with glee this morning, going by the cues that we have. What are the stocks that will be on your radar? The OMCs were bleeding 15, 16 rupees odd per litre. Now price hikes to the tune of around 7.5 to around 8 rupees. There's still going to be some under recoveries out there, but it's relatively less. What's your view on the OMCs and would you buy them?
Yes, Nigel, good morning. And well, I think if what we are hearing today, if it is happening to be true, then certainly I think the markets overall will remain pretty comfortable going forward. And I think the crude oil is a direction first and foremost. If $98 to a barrel is, I think, the first drop that we are seeing today, that could possibly translate to, I think, a bigger relief, even to OMCs included. And I think the user industries, particularly for the petroleum products. So I believe that I think this is going to be very well for the overall environment. But it is in the near term, we are going to see the pressures of, I think, what we have seen in the past in form of, I think, higher crude oil baskets, the resultant cost, under recoveries, and the pressure that will continue. But nonetheless, I think the market always looks ahead. So from that perspective, if you want to consider, there is going to be a strong tailwind for the OMC companies as I see it. Along with that, certainly, if this particular threat and the pressure is reducing, certainly, I think the market will start recovering and stabilizing. That is for sure. And that's where some good quality stocks with the valuation moderated, I guess, I think offers you an opportunity to add into the portfolios.
You want to talk about some of these good quality names that you would like to add this morning or this week? What's on your radar?
So, believing that some of the larger ones, I think, who are significantly corrected on the valuation side, they would be the first ones to start looking up. We feel that some of the pharma companies, they look pretty set for the higher growth. We also feel that I think the larger ones in the banking and NBFCs, private sectors particularly, they could possibly show the participation. The largest company in form of defining and the consumer product segment, Reliance, could show, I think, a good amount of recovery from here on. So yes, I think that particularly the eye would be on some of the large cap companies, though the mid cap companies among the quality names, a few of the real estate companies as well as automobile ancillary companies could possibly also position for an upside.
Got that. Well, it was good to see the banks outperform significantly. So this morning, while the GIFT Nifty is suggesting a strong gap up with a start closer to 23,900, will the banks continue with the leadership that they showed on Friday, where the Nifty Bank closed up with a gain of 1%, and now the Nifty Bank on Friday, closed up above that 54,500 mark. So closer to some resistance levels. 54,000 is where it closed on Friday. You add another 500, 600 points, and that's where resistance for the Nifty Bank is. Let's see whether we can hold up above that level. Any view, Devin, on the Anupam Rasayan Bliss GVS Pharma deal?
Well, I haven't gone through completely the acquisition that they are making, and probably would like to, I think, understand in detail from the company about the synergy that they're forming, along with some of the APIs that they've been supplying to the pharma sectors. How exactly the integration is going to play a role from backward integration to forward integration to the API supply, and you have to, I think, get the full grip on it. But yes, I think sounding positive for Anupam per se, I think, at this point of time.
Okay, all right. Devin, any view on some of these other stocks that have come out with their numbers? Hindalco, the numbers look good. The only problem is, since the start of this conflict, actually, it's been a big outperformer. The metal index is up 8%. Hindalco is up 20%. But it's tick marking everything. Novelis will improve from here on. The aluminium business, India business will do better because obviously LME prices are higher. And copper will do better because sulfuric acid prices move up, which is otherwise a byproduct. Suddenly they're gaining so much more. What is your view on the stock at around 1100 rupees? And also any other stocks, you had Asarda Energy, for example, came out with a very strong set of numbers. And now a conservative management is talking about doubling their EBITDA by 2030. Your view on either of these names?
So, in particular, the Hindalco or the metal commodities, so I think white metal commodities in particular, I think would definitely remain very strong as far as the demand trajectory is concerned. And we feel very comfortable with this kind of a scenario where both ferrous as well as I think non-ferrous metals, both of them are appearing to be having a very strong trajectory going forward, given the kind of requirement the world is now going to be asking for from different usage perspective. The white metal in particular, the data center, the semiconductors, I think they are some of the relatively new area which are entering into the manufacturing space in a way. So from that perspective, I believe that I think what growth is being expected from here. Hindalco in particular has a decent run, at least in the near term. And probably one should be prepared to have some amount of fall in the metal commodity prices. If the crude oil prices eases correspondingly in correlation, I think metal commodity prices should also ease. And should that particular downward correction in the price give an opportunity at lower levels, it could be a good buy opportunity if it gives a meaningful 5 to 10% correction from here on.
Devin, morning. The IT index was up 4% last week, but it was down 6% the previous week. So perhaps it was correcting an overcorrection of the prior week. But, generally the trend has been down, bounces along the way. What would you do here? Is there some repair underway here in some of the names and you'd be a buyer?
From the valuation perspective, Prashant, yes, I think they could be real good opportunities. From the point of view that I think most of these companies have practically discounted most of the negatives in the price today. Sitting on a pool of cash, I think, which is significantly important, and I'm talking about some of the large cap IT companies. And we believe that AI way of working is actually giving them an advantage and not otherwise. So from a perspective of looking at these companies from bounce back from current levels, the possibility is going to be quite high. In fact, I think the theory goes that if I think the overall market is looking a little expensive, and in the bounce back, I think it may exhaust the rally. Probably, I think some of the IT companies may give an opportunity for at least, I think, 10 to 15% upside from current levels. So we remain relatively more confident about the trajectory because of the price at which they are available. Mid-tier IT companies, particularly the engineering R&D companies, the companies which are in the embedded software technology which they provide to some of their OEMs, I believe that I think those companies are equally interestingly positioned, and we like to have them in the portfolio, though they are slightly expensive. But yes, I think they are giving good amount of clarity for growth as well. So yes, overall positive view on the IT at this point of time.
Devin, we'll come back to you. The big story globally in AI is the cost of AI. So Uber in April had said that the CTO in April, this was 1 month back, said that they've already used up the entire AI budget, the entire tech budget, and predominantly on AI. So in the first 4 months, they've used it up. Then over the last couple of days, Microsoft is actually pulling back people from their employees from the Claude Code licenses, and they're saying moving them to their internal Copilot. It's just that once again, now people are realizing the cost of AI, that while it does increase productivity, employees were actively asked to use these AI tools to improve the productivity. It's just that now the costs are adding up. And Fortune, I think, ran a story this morning that using AI is more expensive than paying human employees. So that's the big story which is blowing up globally. We will get into a break. We'll come back with pre-opening rates. We'll also be joined by Jay Kale of Elara Capital to put the spotlight on the auto sector. The earnings that have come through. Stay tuned. Mitesh Thakkar and Sudarshan Sukhani will also join in after that for some technical trading ideas.
Okay, well, Mitesh Thakur is with us, and so is Sudarshan Sukhani for what they'd want you to do as we start strong this morning. And we've started strong. The pre-open indicative open is about 300 points. Well, let's see. I'd be surprised, but let's see. The Sensex is up 300. The Nifty is up 300. It'll settle. It's just the first initial raids. But what are sort of, markers, and how do you trade this in that sense? Gentlemen, good morning. Good to have both of you here. Mitesh, you go first. What's your sense, and what to do on the index first?
I think one thing, which will be positive today would be the fact that we will go beyond 23,800, 850 zone. And if we don't come back, good chance that we'll see some follow through on the upside as well. I am penciling in target of around 24,400 to 350 zones for the Nifty, with a minor pivot which is coming in around the 24,100 mark. But broadly, I think good chance that we will, in the next few days, head towards 24,350, 400 zone. So will be a positive kind of a beginning for me. Of course, if we start slipping below 23,850, I think that will be a stop loss kind of a position and exit on the long view. But the overall bias, at least for today, is and the next few days, is on the positive side.
Sudarshan is also joining in. By the way, crude prices have now inched further lower. It's 98 against the dollar for against the barrel for Brent crude prices. So that perhaps is explaining the pop that we're seeing this morning. 97.76. So the level on Brent crude is declining quite rapidly in the first 1 hour, and the rupee is opened significantly stronger, 95.34 against 95.69. All this is suggestive of a strong opening. Sudarshan, you want to comment on the opening and a gap up?
Yeah, good morning. So last week I had suggested we should go and buy because we were seeing a pattern of higher lows. So for those traders who are actually long, your stops are 23,700 and stay there. For the traders who want to take a trade today, I would suggest don't buy the gap up, wait for a minor dip. So it's difficult to identify where, but let's say 23,850 or close by, and then keep a stop at 23,700. So on any minor dip, you go long, your stops are there. The chances are that we'll eventually break 24,000 and go higher. We'll see how much higher.
And stocks, Sudarshan?
Well, Sona is a buy, Sona Precision. It's a buy with a stop under 580. Trent is a buy with a stop under 4210. Both these stocks, Sona and Trent, are also positional buys. While my stops are for a swing trade, if you want to buy and hold for a few months.
Okay, Sona and Trent, but we'll come back to Sudarshan to get more clarity on the levels and if he has any more ideas. Mitesh, you want to tell us your ideas?
I have all buy calls today as well. Saman Capital was a buy earlier last week sometime. Now it's a fresh buy with a stop below 157 and a target of 170 can be looked at. Hindalco continues to make new highs. That's a buy as well. Keep a stop below levels of 1,089. Look for targets of 1150 here. A buy on Axis Bank with a stop below 1264 for targets of 1325, and MFSL is a buy with a stop at 1657 for targets of 1750.
Okay, we'll come back to you for 9-10 calls. Rupee has opened at a 2-week high, 95.34 versus 95.69. Let's put the spotlight now on the auto sector. Jay Kale, Executive Vice President Research at Elara Capital, is now joining in. Jay, thank you very much for joining in. Let's just begin with Aisha Motors because that's the stock which will react to earnings straight away in 10 minutes. Jay, can you hear me?
Hi, good morning, Rima. Yes, I think Eicher Motors. Yes, I can hear you. Can you hear me?
Yes, go ahead.
Yeah. So, Eicher Motors. Yeah, Eicher Motors reported, a decent set of numbers. Margins were largely in line to marginally above estimate. The management also guided for a capacity increase going from 1.4 to 1.6 million and then eventually 2 million. So the capacity increase is on track. Demand continues to remain robust as of now. One needs to see the impact of the current macros and price increases on demand going forward. But overall, I think steady state of numbers, and we remain positive on the stock and remains one of our top picks.
Okay. And overall, what's the rate of the earnings season from the automotive pack in terms of volumes, in terms of pricing growth, in terms of inflationary pressures that companies could see and what it means for margins?
Yeah, I think if you see, most of the companies that have reported till now have reported in line to marginally above estimate numbers, except for Q4. But the real inflationary pressures was expected to be seen in Q1 FY27. Margin compression or the raw material impact, having impact on margins of around 3 to 5%. But part of it is also being, cushioned by price taken by the OEMs, close to around 1 to 2% price increases the OEMs have taken. So Q1 will be muted on a QOQ on a margin side, but most of the stock price have already factored in that pressure. What is key to note is that, how demand pans out. The demand commentary, especially from the passenger vehicle players, has been quite robust. But one needs to see with the increase in fuel prices and price increases, how that demand momentum sustains. Currently, we believe that EV and two-wheeler industry growth could hover around 6 to 8% in FY27, despite all these price increases in fuels and product prices.
Okay. And just with this rise in petrol and diesel prices, cumulatively about 7.5 rupees in the last 2 weeks, anecdotal evidence, are you seeing a big push towards EV? Are we seeing increased sales either of EV passenger vehicles or EV two-wheelers? And you gave your estimate, I think you said 6 to 10% kind of growth. Could it actually surprise positively?
So I think if you see from the core ICE segment growth, historically, not only fuel prices have had a direct correlation to the volume growth, it's a confluence of factors like fuel price, product price inflation, rainfall, other regulatory costs. So it's a combination of all of these factors that determine the cycle of the industry. Historically, we've seen that, total cost of ownership has increased by 4 to 6% as well. But this time around, what benefit we have for the auto industry is that the GST cut means that despite the inflationary pressures that we have seen currently, the total cost of operations are still below the pre-GST levels. So to that extent, that should support momentum and growth for ICE segment. EVs, yes, then there will see increased demand momentum going forward, purely because the sentiment of fuel price increase will have consumers shift to EVs who are at the border, or at the margin, thinking of EVs or ICE. So we are expecting strong growth for EV, both in two-wheelers and passenger vehicles. Our penetration increase is close to around 2 to 3% per annum over the next 4-5 years for EV penetration, both in two-wheelers and passenger vehicles. That penetration momentum was softening a little, but now will accelerate going forward.
All right. Thanks very much. I appreciate you joining in. Good speaking with you, and thanks for taking out the time. Let's just look at the rupee and the dollar rupee and where we are at to get a quick sense of the strength we are seeing. So almost 90, close to 90, 96, I think was the low, and from there 95.30. So that's like 1 3/4% kind of a move that we're seeing in about 48-76 hours or so. So it's been a very, very strong pushback from those levels that we've seen. So, 40 paisa this morning, 0.4% change on the rupee, the dollar rupee, and there's a strength. The Brent oil price is the other one. I think one is watching the other. I mean, of course, it's oil which is being watched at the center of all of it. And there we've seen oil prices taking another leg lower. We were at about 99 this morning, close to 99 this morning. And from those levels, we are down about $1.20 or so. So there is additional incremental over the last 1 hour drop-off which has happened as far as oil prices are concerned. And I think we've come to the end of the pre-open session. So maybe just look at oil marketing companies, right? I mean, a cumulative price increase of some 7.5 rupees is what we've seen. That's 4 hikes. IOC, HP, BP. HP is up about 3.5. Of course, reacting because, they were taking all the hit. And some of that, of course, is now being passed on to the consumer as well. So there is a bit of lift which is happening across these companies, IOC, HP, BP. ONGC is the other one, which, of course, was strong as oil prices. I mean, it's a direct a correlation with oil prices at about 290 or so on ONGC at this point in time. So a fair bit happening, but that's just the oil sensitives. There's enough and more news flow related names out there. Midesh is with us. Midesh, just a quick word, if you will, on the IT services stocks, if you have a trade there, or because 6% fall the week before last, 4% rebound last week. What would you do here?
I think, there are signs of some stocks reversing, particularly the strongest has been OFSS. But last week, we also had a buy on Memphis. I think that was another stock which reversed. Infosys and HCL Tech look appealing to me from a trading point of view. These are not long-term reversals, these are short-term reversals, but yes, IT looks positive.
Okay, IT looks positive. To look for ideas, OFS, Oracle Financial Services, of course, has seen a very, very sharp rebound, but some of the others Mitesh mentioned as well. Let's bring in Mangalam back on Colgate, and the price will come up as well. Mangalam, take it away.
Well, in pre-open, Colgate is up around 1.5%. That's because the results were fairly strong. The reason were, the stock is higher is because, one, the revenue of the company in the fourth quarter grew by about 9% as against street expectations of 4%. And the company attributes that to a healthy mix between both pricing and volumes, which implies that there has been a mid-single-digit volume growth, which would be a multi-quarter high for Colgate. Importantly, the EBITDA as well. That is coming at 510 crores. Our poll was indicating a number of 488 crores. And we've seen, the net profit as well, largely in line with expectations, but there is an element of exceptional. So if you, strip that off and add that back in, the EPS growth of the company has been around 9%, and that's something that the street likes. However, sustaining these numbers is something that everyone is watching out for. The stock has been an underperformer over the last 12 to 18 months, and which is why, they're not, jumping on the stock, and we're not seeing a 5 to 7% sort of pop or something. It is a lot more moderate because sustaining these numbers are a key for Colgate. Growth is balanced between pricing and volume. Premium products are doing well, but how the company takes this forward, the momentum forward, is something that all the brokerages and the investors will be betting on to.
Okay, all right. That is Colgate in focus. Mangalam, thanks very much for that. NTPC is the other one, and Vivek is back here. Vivek, morning.
Well, it's going to be interesting to see how NTPC actually reacts to these numbers, because P&L has been slightly subdued against what the street was anticipating. Multiple one-offs in this particular quarter, especially in terms of how the company has been measuring the tax, and that actually impacted the P&L in this particular quarter. So revenues were down 2%, just on account of the fact that weak demand led to muted generations, and the company has been operating now for quite some time at very low plant load factors. EBITDA, however, was up 11% on a year-on-year basis. EBITDA margins expanded. The adjusted PAT was up just 6% on a year-on-year basis. The key that the street will be watching out for will be the FY27 guidance. Total capacity addition guidance has been maintained at a little over 9.5 gigawatt for FY27, of which majority, in fact over 8 gigawatt, will come in from the renewable energy side, both from NTPC Green as well as the JVs. Now, in terms of the FY27 capex guidance, close to 40 to 45,000 crore is what the company is guided for. So again, strong capacity addition guidance and capex guidance is something that the street would like, but the P&L was slightly soft.
Okay, P&L was slightly soft. Thanks very much, Vivek, for that. Bliss GVS Pharma, stocks up about 7.33% at the end of the pre-open session. Anupam, of course, is the acquirer here. And we'll see how much more as far as, Bliss is concerned. Anupam is starting about 1.75% higher as well. Here's a quick recap of stuff that we put out in terms of single stocks from the morning. Eicher Motors is up 3.6 this morning. Hindalco is flattish. Fortis is up 0.9. Colgate, which Mangala mentioned. Anupam Rasayan, Bliss GVS, I mentioned just now. We've got the NTPC stock up on your screen. Divi's, which is down about 2%. JK Cement, and you'll hear from the management in a bit, about 0.25% lower. And the crude sensitives, IOC, HP, BP, ONGC, they're all starting mostly slightly higher. I mean, there are more oil marketing companies listed as compared to upstream companies. Although we've got ONGC and Oil India, both which have responded positively as oil prices went up. But of course, hopefully they're not going to be lower. At a net level, you want it to be lower, not higher. We've got the market open, first rate starting to come up. It's 200 points higher on the Nifty. 23,940 or so is the pre-open rate. And what do we have? 23,950. So it's about 1%, a little stronger. 800 on the Sensex, so 76,200 on the Sensex right now. The Nifty Bank is up about 1.3, 1.4. You've got the small cap index, which is up 0.15, the mid cap index, which is also going to come up, and that is, slightly higher. It's going to be higher as well. So it's a uniform 1% kind of pop across the board on mid and small caps. Small caps, I mean, they from the lows rebounded the strongest. And of course, after that, they've given back a little more as compared to large caps and the mid cap spaces. Today, looking better. We've got Sun, which is down, Hindalco, which is down. Easier to count what is down because you only have about 5 names which are down. Everything else is up and about. Eicher, Shriram Finance, Mahindra are the top Nifty gainers. Rima.
Well, it's LTIMindtree also, which is under pressure in one of the larger names. That stock is down 1.5% after JP Morgan downgraded it to a neutral. And what they're saying is, on the back of that acquisition of Randstad that they announced on Friday, more than the price paid, we see the acquisition as a sign that organic growth opportunities are drying up and managements are being forced to evaluate unusual acquisitions to bulk up rather than thoughtfully added capabilities. So LTIMindtree is under pressure. ONGC has lost about 1%. Generally, IT has got a little bit of a cautious tone this morning on the back of the rupee appreciation. But the big star today is Aisha Motors. It's added nearly 500, it's added 5% today. It's a 350 rupee pop on Aisha Motors, 7318 on that, on the back of numbers. Shriram Finance is moving quite smartly. Autos are higher in trade. So you've got Tata Motors, passenger vehicles, M&M up. Interglobe Aviation and Asian Paints seeing buying as crude prices have dropped and continue to drop. It's 97.3 now against the Brent, for Brent. HDFC Bank is providing support, and once more, the Nifty Bank is outperforming frontline indices. The Nifty Bank is leading the charge, 1.5% gain. It's HDFC Bank higher in trade, but Kotak Mahindra Bank, Axis Bank also up 1.5%. Strong, very strong advance decline ratio to begin trade with. We've got nearly 6 stocks advancing for 1 in the red. So 1% gain on the benchmark indices. Banks outperforming. Mid caps, small caps also looking up.
Well, that's right. Banks outperforming, mid, small caps looking up. And you have some of these crude sensitives that are bursting away. You had HPCL that's up and about in today's trading session. BPCL as well as IOC. All of them are participating on the upside. Interglobe Aviation, that's the other one that's a potential beneficiary of this. So that stock is doing quite well. But let's look at the broader markets. Vikran Engineering, that's a big surge in terms of the sales number. It's coming at more than 600 crores, which is much higher on a sequential basis and a year-on-year basis. The margins have compressed, but the PAT number is looking much better. The order book as well is quite good at around 5,200 crores. So I guess that's the reason that stock is moving higher on very, very large volumes. Sterlite Technologies, there was an order win, I think, that was announced, a rather large one. So that one's locked up in upper circuit. I think it's up close to around 5%. Very minimal sellers out there because of the kind of buying in the news flow. Keep in mind, this is a stock that's moved from around 310 rupees to 460 rupees in a matter of less than 30 trading sessions. So big move is what we're seeing, but the order win is good. And the street is looking through who are the other potential beneficiaries in the similar space or, somewhat of the similar space. HFCL, that stock, just take a look at the volumes out there. It's up close to around 6%. Massive volumes is what you're seeing on that name. A few more notable winners. Green Lamb, I think we should pull up the stock up there. That's up more than 10% and volumes as well fairly decent. So keep an eye out on that one. Big move is what we're seeing. Lakshmi Dental, that stock is well up close to around 8%. I think it's reacting to its number. So solid move over there. NIBE, I think that's the defense company. It's already seen a big rally. There was some news flow in the last week. It's done very, very quickly from around 1,150 to around 1,500 rupees. So that's another stock and volumes fairly large. And Ramco Systems as well up and about. Net, superstar to trade. The bulls will want to end with these sort of gains because we're trading about the 20 DMA. We have conquered the 50 DMA on the headline index. But the real story is in the broader markets when you have 5 stocks advancing for 1 stock that's declining.
Okay, well, that's the market, right? I mean, 250 odd points, 23,970, and it's looking up. It's looking good. We've had good starts. We've had fewer good closes, and that needs to change. Hopefully, today we will see it. Pankaj Murarka is with us, CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thanks for joining in. You are, I know from our chats, unfazed by a lot of this macro stuff. You pay attention to it, but you're sort of, focused on stocks and where the opportunities are emerging. And there's been so much movement and dispersion, Pankaj. So just start by outlining, what your portfolio construction, your current portfolio, how is that constructed? is it very large focus on heavyweights as compared to, as some have done, moved into large caps, more defensive kind of names, capital protection, and then the second layer in terms of where you are overweight right now. Then we'll pick up from what you say. Go on.
Good morning, Prashant. Let me start by articulating how I'm thinking about this whole, series of events that have been playing out. What essentially has played out is rising oil prices is definitely a macroeconomic shock for India. But, India is a large economy. I've been saying this, where it's a very resilient economy. It's not a fragile economy. And one must concede that this government has been fiscally prudent in terms of managing the economy over the last decade. So we entered into the crisis with fairly resilient macroeconomic fundamentals, which effectively means the crisis does have an impact. But India has the ability to deal with it. And experience tells us that India does not get being a large economy, it does not get a macroeconomic shock very often. You get these kind of events once in a 12, 15 years. Last time it happened was in 2013 in midst of taper tantrum, where currency had adjusted sharply and all the markets, fixed income, currency and equity markets had, reflected that crisis. I think we had something similar episode. And from an equities perspective, experience tells us that while the next couple of quarters could be challenging from a corporate earning perspective, because the transmission of macroeconomic shock to the microeconomy will happen over the next 2 quarters. But experience tells us that these kind of macroeconomic shocks are a good time to be investing into Indian equities, and investments made during this period do lead to much higher returns than what normalized returns are over a longer period of time. So in that context, while over the last 12 or 15 months, our portfolio construct has been more defensive stance because the economy had headwinds and we had global headwinds. But now probably over the last few months or weeks, we have got much more aggressive in terms of portfolio positioning, where we are probably tilting our portfolios more towards mid and small caps, because we think probably, we are at a point where a lot of this, a lot of potential risks are now getting priced in that sense. So obviously, from a portfolio perspective, financials is our biggest sectoral allocation. And they've been at the receiving end because of, the rising oil prices and the macro impact that we have seen. But I think I feel fairly positive about financials across, and especially banks across both large cap banks and some of the mid cap banks, because I think asset quality in India's financial sector is very resilient. And we're seeing a revival of credit growth, where credit growth is, after being moderate or soft for last 2 years, are showing signs of pickup, and valuations have become very compelling. So financials remains a large overweight. And apart from that, I find a lot of value in some of the consumer names and consumer discretionary, which includes both consumer discretionary as well as autos, because underlying demand, as far as autos is concerned, remains resilient. And I think we'll see a recovery in discretionary consumption, which again has been very slow for the last 2 years. And valuations are reasonable in their pockets, where on a bottom of stock with picking basis, you can find stocks which are more attractively priced. So these are some of the key sectoral position. Apart from, having said that, we've always had exposure to IT services that continues in the portfolio.
On the consumer side, I think last time you were talking about Tata Consumer Products. I believe that was a part of your portfolio, and it came out with a blowout set of numbers. Godrej Consumer was another stock, the name that you had flagged off. Any more names you can share that you've added to your portfolio on the consumption side, whether it's staples or on the discretionary part?
So you're right, Rima. We are making a tilt towards more discretionary consumption, because we're seeing that the demand is fairly resilient, and more importantly, one must concede that it's a K-shaped economy. So while demand remains completely, very healthy and strong at the upper end of the economy, it's the lower end of the economy which is really facing demand challenges. So you clearly want to play consumption which is more inclined towards, higher end of the discretionary consumption. So we own names like, United Spirits as well in our portfolio.
Any other on the discretionary end?
We own some of the consumer durable names like Crompton Greaves, and one name which has not done so well, but we remain fairly sanguine, is Jubilant Foods, the pizza franchise.
All right. Hi, Pankaj. Good morning. Good to see you, Ben. In terms of asset allocation, what would you do right now if you're, deploying some money? what would the asset allocation strategy be? Gold has been a big outperformer. That's pulled back though. Good 20% pullback, I think 5,500 on 4,500 approximately. Maybe you could be around 15% or thereabouts. What would your allocation to gold be, to equities? And how much cash would you sit on? Because still things are very, very fluid. Mr. Trump says this and that every second day. For the time being, we believe de-escalation is, we're on our way over there, but you can never say never. So how much cash would you deploy?
Well, Nigel, one thing I can say, as you said, there's a lot of uncertainty, and as you rightly said, Mr. Trump keeps flipping. All of those things are beyond, any logical forecasting or analysis. But it looks logical that probably Hormuz will open, and that's I think the biggest delta for India in terms of oil prices and the premium which is priced into the oil. Today, probably oil is corrected a bit. And I think probably once we get this through, we should see oil probably Brent at sub $90. And I think India can deal with that shock. I think my experience, see, it's difficult to call out what happens over the next 4 weeks, 6 weeks, or 8 weeks. But what I can say is it's time to be overweight equities and probably slightly more aggressive because on equity allocation, because I think, as I said, we're coming out of a cycle where markets have not delivered absolute returns over the last 2 years. So the aggregate level valuations have normalized. There are pockets of markets and there are sectors where you find a lot of value. I think probably the worst of economic slowdown is behind us. Underlying economy remains fairly resilient. But probably the next 2 quarters, as I said, could be challenging from a corporate earning perspective. But also, I must tell you that, if you look at India's historical earnings evolution pattern for corporate earnings, whenever you get a period of 6 to 8 quarters of moderate earnings growth, and if the underlying economy still keeps doing 10-12% growth, then obviously you create a gap between the economy and the earnings growth, and earnings do tend to catch up. So effectively what really happens is you get a period of a couple of years where you get very strong earnings growth because earnings are catching up with the normal growth which happened in the past. So I think markets will overlook some of the earnings headwind of poor corporate earnings that might happen in the first half of this financial year. But I am remaining in the camp that second half of this financial year and going into the next year, we'll see very strong corporate earnings coming back after almost 8 to 10 quarters. And I think markets will really look forward to that. And that should drive significant returns on equities. Also, given the fact that, as I said, we're coming from 2 years of no returns or flattish markets. Obviously, there's a catch up to do, and which I think will happen over the next 12 to 18 months. So I would say one should be overweight equities. Given whatever is happening in globally, and probably uncertainty is the new normal, and on top of that, we have these geopolitical events which keep playing out. It might not be a bad idea to have probably a 4-5% allocation to gold from a longer term perspective, though I still think that in the near term, gold will underperform. I think it's time to be investing into equities, not holding that cash back, but putting that cash to work.
Just to go back to what you started with, which is private financials look very attractive, right? Now, as you said, right? That's the view. That's the top idea, right? Pankaj?
Yeah, absolutely, Prashant.
Okay.
Absolutely.
So my question is, and this is a slightly, maybe not near term, but this could be important. So the IRDA chairman told us that the distribution reform paper will come out in 3-4 weeks, right? For all these private banks, actually except ICICI Bank, which does not sell ICICI Pru policies, life policies, but everybody else, this is a large portion of their income. Fee income. This is a pretty large portion. Yeah, what's your sense, Pankaj? I mean, could it be meaningful because the regulator, the insurance regulator is saying, well, insurance should be much cheaper. So why are you charging so much? That's the basic thing that they're going in with. They want to, it's an insurance for all government mandate by 2047, and they're pretty serious about it. So just your thoughts there, private sector banks.
On the insurance side, I think...
No. My question is, will important income stream get hit because of the insurance reforms for private banks?
Not really, I don't think so, Prashant, because one, the penetration of insurance in India across life, health, and others still continues to remain very low. compared to global standards. So I think we have still a very long way in terms of increasing penetration. I think what the regulator is trying to drive at is for banks to have an open architecture platform where banks would distribute insurance policies across manufacturers and not necessarily of their own group companies. So that we can have a more, so the customers can have a more choice from banks. I think that is what one they are trying to drive at. And secondly, there could be some capping of commissions, but we need to understand that the cost of doing businesses in India is reasonably high. Because customer access, customer reach are pretty expensive in India. So eventually, in the ecosystem, players have to make money. So I don't see a significant risk to that from a bank's perspective, because while overall fee income is significant and insurance is a meaningful contributor, but it does not move the needle from an aggregate bank's perspective, even if there is some moderation in those commissions. So I don't see that happening, Prashant.
Okay, all right. You don't think so? And maybe valuations are, the starting point is cheap enough. So we'll see. But, I've heard some say maybe, sell banks and buy insurance companies. That kind of a trade. I don't know. We'll see. Maybe buy both. Thanks very much, Pankaj. Good to have you with us here. Thank you for joining us. As always, it's a pleasure. All right. Well, let's just look at the Aisha Motors stock, right? It's up about, I think, 4-5%. And it's responding to numbers. Hood is here with the detail on Aisha. So take it away.
As you said, it's reacting to the numbers of Q4 FY27, and those numbers look much better than expectations. Headline growth continues to see a double-digit growth aided by the volume, and on the margin front, also company manages to hold to the levels around 25%. That also has been taken very positively, and mainly because of the reason that it has come amid the geopolitical tensions. So talking about the headline numbers, profit has seen an increase of 12%. Revenue was higher by 16%. EBITDA has seen a jump of 20%. And margin has come in at 24.9%, almost in line with expectations. So this was about Q4 FY26. What about going forward? So everyone is expecting to have an impact because of commodity cost increase. But to mitigate that, company has already taken a price increase. So for Q1 FY27, commodity pressure impact can be seen in the range of 3 to 3.5%, of which 1.75% price increase company has already taken. And a remaining part, company is saying that via other means, they are going to mitigate that impact. Now talking about the volume, in the month of May, as per the Wagon data, it was showing that there might be some impact on the retail data, and on that company has made a comment that they had faced certain issues related to manpower supply because of LPG shortages and other issues, and that issue is also getting resolved. So on volume front also, they believe that in the month of June it will be much better. So reacting to the earnings and also positive commentary about Q1, that's the reason you are seeing Aisha Motors currently up more than 5%.
Big star today. Thank you very much for joining in. Moving on now to the next corporate conversation. Narayana Health has reported a steady set of Q4 numbers. The company reported its highest ever revenue as it integrated the UK business. Sandhya, the group CFO at Narayana Health, is now joining in. Thank you very much for joining in. This is Rima here. Let me begin with your margins. While your margins have expanded on a quarter-on-quarter basis, it's still lower on a year-on-year basis. This is post the acquisition of the UK practice group. So just tell us, particularly in Q4, what led to the margin pressure? Is it the UK business? Is it clinics, insurance business in India, new bed addition?
Good morning. Thank you for having me here. This year, if you look at the hospital segment, we have seen the positive impact of all the transformation that we've done, where patients have opted for higher configuration beds. You would remember that we were consistently talking about working on our bed configurations. We've also been able to get the benefit of the operational efficiencies from our tech and throughput improvement initiatives, which we've always spoken about. So India Hospitals has seen a substantial growth in the margins. We have seen dilutions coming in India, one from the investments we're making in the integrated care business, which is the clinics as well as the insurance. As far as the Cayman business is concerned, we have seen dilutions from the Cayman insurance business, but the Cayman hospital has fully come back to its old levels. So at a blended basis, there is some dilution that we're seeing in Cayman. And UK is a lower margin book that we have we have picked up, and therefore UK will be dilutive to the group margin. So all of it put together, you are seeing the sum of the parts is coming in at a relatively lower margin than where we were before.
So Sandhya, particularly on the UK business, what is the margin profile and how should investors think about UK's margin trajectory over the next 2 to 3 years?
So UK is not a high margin like the way you look at in India or you look at in Cayman. Having said that, it's a very stable and high cash flow business. And that was the reason why it was also interesting for us. UK is operating at about 10.5% EBITDA. We do believe that we have the ability to improve that to a higher number, similar to peers in the UK market. Having said that, the way to look at the UK business is to look at the steady stream of cash flow it generates, the consistency in terms of top line, because a lot of our business comes from NHS, the government payer, and therefore there is a predictability in the revenue, and it is also a leveraged acquisition, and therefore the acquisition has been accretive to us from all the return ratios point of view. So I think that's the better way of looking at the UK business.
Okay, that's helpful. So some of the parts, Sandhya, what could be the consolidated revenue growth guidance for FY27 and margins for the company? In FY26, it was 22%. Does it stay around this level?
So from like we can't guide the numbers, but then just directionally, we will continue to see growth in India, though we aren't adding any capacity as such, which is material in India. There is one hospital which is going live next month, but there is no significant capacity that's coming up. So most of the growth in India will come organic. Integrated care and insurance in India are growing. Insurance, in fact, has done quite well in the second half of the year, and it will continue to consolidate and build on those gains. So that's as far as India is concerned. Cayman, there was a significant growth that we saw last year, both because of the new capacity going live in Cayman, as well as the insurance business picking up significant momentum. The current year will be a more balanced growth because you don't have any inorganic element coming into it. So Cayman will grow, but it will be moderated and balanced. UK is something that we don't have a very strong view on how the growth will pan out. We are very confident that we will be able to grow in the UK because even before acquiring the business was growing reasonably okay, but we still don't have a complete outlook on how UK would turn out to be. We would definitely say it will be positive. Positive to what the business was doing before we acquired.
Yeah. Sandhya, hi, morning. A couple of questions here on UK to begin with. If you will, what is the proportion of the NHS business there?
So currently 93% is NHS.
I'm assuming for margins to improve substantially, that share has to come down and private patient share has to go up, right? So could you guide what that trajectory will look like?
Yes, so I would just slightly paraphrase it to say we would want to retain our NHS work, but we want to grow the patient private pay. So from that perspective, we are aspiring. If you see the competition in the market, they do have significantly high private pay volumes. So therefore, it is doable. So that's our aspiration, and that's what we're working on. Even in Q4, we have seen very positive shoots on the improvement in the private pay. We're still pulling it all together to start reporting them. From next quarter onwards, we will start reporting that so that investors have a view of where we are heading with it.
Sorry, reporting what? You said NHS is 93%, right? So
yes.
You'll give more granular data on UK from next quarter, you're saying?
Exactly, yeah.
Okay. But can you tell us where will that inflection point come and what is the margin upside room here as that share goes up? The private patient share goes up. What's the room as you see it?
It's a little difficult to predict for us, but what we can say is the competitors are operating in high double digits, so high teens. So that's where the competition is operating, and we are still, just at 10. So that can technically be the margin headroom.
I see. High double-digit margins for competitors, and you're at about 10%. So there is room in that sense, right? But you'll put out more data next quarter, so we'll chat then. Just on this insurance side of things, and you said it's done well. So could you give us a sense of the scale up there? Does it require more capital commitment? Because most capex is going to hospitals, but will insurance require more capital commitment from you?
So if for the year we have done a GWP of about 44 crores, and this is coming against almost a zero baseline for the last year. So that way it's the significant gain that we've taken. We have currently invested 117 crores into the insurance business, and we do believe that there will be some some capital that we will have to infuse, because as the premium keeps growing, you are legally required to infuse capital, but it will not be significant, is our understanding as the business grows, because we've already put in the initial 100 crores, and that takes care of the significant part of our headspace to grow. As far as the hospital capex is concerned, we've already announced our capex plans, and we will announce more. There are certain projects in the pipeline, and as and when they materialize, we will announce them.
You have all the products you wanted to launch on the insurance side, because I believe the lowest cost plan gives access. There is difference, right? I mean, higher tier plans that give access to the lower tier plan the insured are restricted to the Narayana Health ecosystem. The higher tier plans give access to a much wider hospital set.
Exactly. So we have multiple plans, actually. We have some plans which have Narayana, some are Narayana plus a few set of hospitals, and then there is a plan which gives the access to the entire tier, and of course the costing is different. We will be launching more products on the insurance side, especially on the missing middle segment, where we feel that there is a gap. And I think you were also speaking to your previous speaker that the insurance penetration is not growing because the affordability for insurance is not there. So we are working on several products that can address that space.
Okay, got it. We'll leave it there. Sandhya, we wish you all the best of luck and look forward to our next conversation. Stock's doing very well. It's up about 5.5% It's one of the best performing hospital names out there. We'll take a break. We're back. We have the management of JK Cement joining us on the other side. Stay tuned.
Welcome back. Let's turn our attention to the cement pack. We have with us Mr. Anuj Khandelwal, the business head at JK Cement, who joins us on the show. Hi, Mr. Khandelwal. Good morning. Good to see you, Ben. Well, the past quarter was pretty okay in terms of volumes. However, input costs have gone up, which could be a bit of a worry. But good day for you to join, because this morning crude oil prices have seen a sharp decline, which could ease out a little bit the input cost pressure. So let's get to the point. First, in terms of demand, how is demand on ground, if you could give us some clarity? And in terms of volume growth, what are you all guiding for? You all have outgrown the industry for the past year.
Good morning, Nigel. Many thanks for having me here. Yes, crude prices have dropped, which is a good sign, but it's very volatile. So I don't know how much to make out of it. In terms of your question on volumes, we believe that industry might grow by 6 to 8% this year. Last year also had grown by similar levels. And last year, yes, we had outpaced the industry growth. We had grown by more than 15%. This year, we at least plan to clock double-digit volume growth again this year, given that we have capacity headroom with us. and thus outpace the industry once more.
Got it. Okay, all right. And the double digit you're giving us is the blended number. You want to split it up between grey and white?
No, this I am speaking more so on grey.
On grey. Got it. All right. We take note of that. What about input cost spike? You know, when you joined us in March, you were telling us that the packaging cost has gone up and the fuel cost as well has gone up. You all are trying to mitigate it by, changing your fuel mix. But could you tell us, for Q1, what kind of cost per ton increase should we see? And for Q2, what kind of cost per ton we are likely to see? Going by the rates that we currently have, hopefully things de-escalate and you'll be in far better shape. But in terms of cost increase, what is it?
Okay, so there are three aspects to the cost increase. While I had come in the last show, there were two aspects. Now there is a third aspect, which is the diesel price increases as well. So the packing cost for the full quarter, we will spend around 80 to 100 rupee per ton that the entire industry will incur as an extra cost. In terms of the fuel basket, it depends on the inventories of various players, but high cost inventory will get used for most of the players, including us, in the first week or the later, or let's say second week of June. So a little bit of impact, not much, maybe 20, 30, 40 rupees. So that makes it around 150 for this quarter, packaging plus the fuel cost. In terms of diesel, if you look at it, last 4 increases have amounted to around 7 odd rupees. So which will increase the fuel cost for the material which is transported going forward by around 30 to 40 rupees. So, but that will only play out for half a quarter. So you could maybe say 15 rupee per ton. So around a 165 odd rupee per ton or 170 rupee per ton will be the impact in this quarter. In next quarter, further 150 rupee per ton is what we are staring at. Of course, if there is some relaxation in any of the input prices, then it's a separate issue. We see some good signs. Packing cost has started reducing. But too early, too volatile. But Q1 like a 150 to 170 rupee per ton impact.
Got it. All right. So around 165 for Q1 and 300 rupees for Q2, because you add another 140 rupees ballpark. How much of this has been passed through? Because you all have been gradually taking some price increases in April as well as in May. I believe there were attempts. So how much of it has been passed on?
Region-wise, very different. For example, North, there has been good increases. East and even South Central, hardly any. So on an average, around 80 to 100 rupee per ton, we've been able to pass through. But as I said, cumulatively, basically we need the cost will increase by around 350 rupee per ton if you look at the entire cumulative impact. So not enough, I would say.
Okay, got it. What would that mean in terms of an EBITDA per ton, sir? What kind of a guidance can you give? Last quarter, you've done ballpark around 1,010. Some on the street expected you to do around 1,030 to 1,050, so more or less in line. But in terms of a guidance, what could it be?
See, too early to give a guidance. Honestly speaking, I have told you about the input costs and I've also told you about the prices. Rest is match. But having said that, I would only say that we would be lucky as an industry to even touch the EBITDA per ton which we saw last year. It's early days. I'm not being pessimistic about it, but at present, the cost impact is quite high, and we are trying to work out all the efficiencies possible to try to mitigate it as much as possible.
Okay, all right. Before we get back to your company, I want to ask you about the industry dynamics. Now you have you have Dalmia that's going to be entering the central market, where you have a fair bit of exposure, I think. And Ambuja is gradually, the Adani group, so to say, they have been talking about scaling back on that aggressive plan that they had. What is your view in terms of industry dynamics and Dalmia coming into central India? Would it be a bit of a challenge for you?
So, yeah, let me first talk about Dalmia. Look, I will divide this answer into short term and medium term. In medium term, doesn't impact that much simply because central India is one of the highest growing regions of India also because government is giving a big push to development there.
Okay.
And if you look at Dalmia's capacity of around 5 million ton cement, it's like 6-7% of the, let's say 7-8% of the entire industry capacity. And you would assume that the demand growth will be able to ingest that kind of new capacity which comes in. However, in the short term, right now, central India is one of the lesser profitable regions in the country, and the demand supply equation is not very favorable. So for a few quarters or maybe 1 or 2 years, it will be difficult for the industry, but the mid to long term story of Central India is far intact. In terms of Ambuja scaling back its let's say expansion, look, they must have taken a studied call. To give them the credit, the kind of expansions they've had over the last 3-4 years has been a lot. So what I see this as more of a deferral of their plans which are already made. So maybe some bit of respite for the industry for a few quarters, but one must also be mindful that they have done a really good job of scaling the capacity in the last 4 years.
Okay, got it. Getting back to your business, then the paints business, I recall when you all announced the foray, the street didn't like it, and then they said, okay, we forgive you all because you all are growing at this sort of a pace. What is the revenue number though for the past year, and do you all turn EBITDA positive in this year?
Look, again, I don't look at the paints business, but I can give you, I could answer some of your questions.
Yeah.
We did nearly 400 crores in paint net sales, which is spectacular given that we've started off really from ground zero. Next year, we are planning around 500 to 550 crores, which is again a good growth of, let's say, 25-30%. And our hope is that we'll come near about EBITDA break even in paints this year.
And you all want to grow this business, or now you've scaled it up, the industry is looking up, maybe if you get a good deal, just get rid of the business and get the capital back into the company, given that you'll have an ambitious growth target as well. You're clearly saying no, I think so, nodding your head.
No, there's no chance about it. We want to grow this business. We are long on this business. One must remember that, the entire white cement business, the putty segment as well as the white segment business, is a complementarity of paints. So both the businesses are mutually benefited by having each other around. Okay. So given that it's a core business, it's not value addition, we are not looking at it at all.
Got it. Okay, very quickly, the Middle East exposure, you have a grey cement unit, I think 1 million ton, and you have a 500,000 ton white cement business over there in the Middle East. Are things functioning as normal? Obviously, there would be some kind of hit because of the crisis that's taking place. But in terms of utilization levels in comparison to earlier and the outlook for this business?
So we operate it only in white cement, and it's around 500,000 tons of capacity.
Okay.
Last quarter was pretty decent. It was normal, and as you can see by the results, but it's also because for the first 2 months there were hardly any impact and the things were going strong. That business is actually dependent on two broad business streams. One is the export, which is hit, as you can imagine. But the part of the business, and it's a significant part, which is dependent on the local economy, that's going reasonably strong, whether it is white cement or even the allied products like plaster, etc.
Okay.
So yes, there will be an impact, but at least there's a local demand which is there, which is good, which we are catering to.
Okay, all right, Anuj, thanks a lot for joining. I think that's a 600,000 ton unit, and you're saying maybe some near-term challenges, but outlook fairly okay. Appreciate you joining in.
All right, that is cement. Let's move on to the pharma and chemical space. Anupam Rasayan is the company I'm talking about. The management is with us now. Anupam reported what was a weakish set of fourth quarter numbers. Revenues were up 27, but margins fell very sharply. They've also announced that they're going to acquire a large stake in Bliss GVS. So it's structured in a three-part process. I mean, there's a stake acquisition, there's an open offer, and then there is a right to buy an additional around 5% as well, which, if all completed, will put them in it'll put them in the promoter position post the open offer, but they'll have around a 74% stake. Vishal Thakkar is Deputy CFO at the company, is with us to take some questions. Vishal, good morning. Great to have you with us here. Thank you for joining us. We'll get to the numbers. We'll flip it. Numbers later. Let's just talk about this Bliss, the GVS deal. So just first up, tell us the rationale, because Bliss is largely a formulations and a branded sort of export pharma company, whereas you are in custom synthesis, specialty chemistry, etc. So, what's the synergy here? Why do it?
Hi, good morning. Thank you very much. And you mentioned about our performance. I'll take two things together. One is the performance and then the acquisition also. this year actually has been very good for us. In terms
Sorry, Vishal, I'm sorry. Can you start with the acquisition? I promise I'll give you a chance to respond to the numbers. Yeah.
No problems. So let's talk about Bliss. So yeah, you're right. Bliss has been in the is in the pharma sector. But if you look at Anupam also, in last 3 to 5 years, if you see, we have been growing our pharma portfolio. Basically, it was few crores to now 20% of our revenue. Yes, we are more in the KSM space, and they are in the formulation. So today, as we go, we'll be able to offer a full platform to our customers. Also, if you look at Bliss today is having a capacity utilization of around about 30%. They are hardly very small, in small way they are present in US and Europe, and also limited in India. And I think these are the geographies that we can really help them grow well. That's the geographies that we have been traditionally very strong. And as we go forward, there will be a full integration approach that we will take. Like if you look at even with Tenfact, what we did, it was a very couple of products focused industrial company, which over a period of time we've been able to help them with our technology, with our marketing capabilities. We have been able to deliver. So I think we should be able to do that here as well.
Okay. So two questions. One, in terms of how you are, what are you aiming to do? You yourself mentioned 30% capacity utilization, right? So is this an easy fix to ramp it up? Is this a hard fix? Does it need operational overhaul? So that is one. Second, of course, is the transaction itself. What will Anupam look like once you're done with this? I mean, the overall numbers, top line, margins, bottom line. Just give us a sense.
Sure. So first, if you look at it, it is that they recently added capacity and they're in the process of adding a little bit more capacity as well. So it's not about only the opportunity, but also you would also see that there is a strong growth opportunity left out in Europe, US, and India. And we believe that that's something which we can really help them grow well. So our thing is that yes, in a very near to medium term, we should be able to take them to full capacity is our understanding. I think similar is what we have done with Tenfact. So I don't see it to be a very heavy lifting, but yes, there is an execution that we'll have to look at.
And what will the total shape of things look like for Anupam once you do this, once you are at where you want to be in Bliss, the numbers?
So Bliss today is around 1,000 crores of top line today, with a decent EBITDA margin. We believe that once we scale it up and take it to at least 70-80% of the top line that we capacity utilization, you can do the math on the numbers. I'm not trying to guide any numbers because yet we have to get into the final conclusion, and then probably it will be more appropriate for me to give you more detailed one. But I believe that the EBITDA margin should also have an upward bias to this. So maybe in the 20s is what we would want to bring them up, along with a high growth that we have been mentioning here.
And what's the timeline to both of these happening? We're in Q1 of 27.
So first, let us conclude this transaction. But I'm talking near term. I'm talking near to mid term. So let's say 2 to 3 years is the timeline that I would say.
Okay, so in 2 to 3 years, target utilization goes up to 70 to 80% of Bliss compared to 30% right now, which pushes your margins to 30% plus. What about the funding of this? If you add the open offer, the total outgo will be close to 2,200 crore rupees. How are you planning to, you've explained how you're planning to fund it, but could you give us an indication of the net debt and how you're thinking about leverage thereafter to deleverage it? We know the funding.
No, so first, the debt on my balance sheet will be only 300 crores. Balance is coming in as a quasi equity, so there is no debt leverage that is happening there in that sense. So if you look at it totally on a console basis, also if I look at it 1,100 plus 300 plus 300. So I'm not talking about a very significant debt being brought up here. And this company today is having an EBITDA of around about 180 odd crores and a PAT of 130, 140 crores. So looks pretty comfortable for us in that sense.
Okay, so you don't see an overstretched balance sheet on the back of this. Now let's get to the numbers, Vishal, as promised. So operating margins came in at 22%. It's a sharp fall compared to 30% that you had a prior year ago, and even below the Q3 level of 25%. So what caused this deterioration, and what is the guidance to improving margins in the near term, say by the end of FY27 end?
So if you look at my annual margins, I'm in the 25% EBITDA margin. And historically, I've guided that historically our numbers will be in the range of 25% plus or minus 2 percentage point would be my EBITDA margin. And I believe that that's the kind of a number that I would guide further as well, or suggest that we would be able to go achieve. Quarter on quarter, yes, there will be some bit of a movement that will be there. And I would say that last year's numbers were on the higher side. And that's what I had, even when I met you last time also, I had mentioned that the numbers of the last years are a little on the higher side than what normally we would have seen.
All right. Hi, Mr. Tucker. Good to see you in, and congratulations on this inorganic growth. You have been on the go. The last few years, I think at least 3 is what I remember you have done in terms of inorganic growth. That said, I just wanted some clarity on a couple of details. One is, you're saying on the acquired asset, it goes from 30% to around 70% utilization levels, and the margins hold around 20%. So that would mean in the next 3 years, Bliss does a revenue of at least 2,100 crores. Would that be fair? With an EBITDA number of around 420 crores, mathematically, sir?
You know that better than me. I would refrain from making that statement. I have not even acquired this company yet. So making any statement right now fully would not be in my place today, at least. Today there is a management.
Mathematically, Mr. Tucker, it's doing around 930 crores approximately. If the utilization level doubles, it goes to close to around 2,000 crores. And then margins, they're doing around 18%. You're saying, say, around 200 basis points improvement. So approximately 400 crores of EBITDA with revenues of around 2,000 crores is mathematically not wrong. That's the way I put it.
Mathematically, it is correct.
And that could be the aspiration that you have.
I would leave it for you now.
Okay, I think we're just putting numbers.
Yeah, but you're right. You're right. I'm not trying to get you.
That's done. Super. Next one. In terms of consolidated debt, you said no big stretch, but just spell it out for us. Currently, what is the debt in the book? And post this acquisition, what does the debt go to? The consolidated net debt number.
So my debt was this year has been 1,500 crores on a gross, and on a net basis, it will be around 1,100 crores. And 300 is what I will add to that.
Got it. Okay. All right. And final question, sir. Do you have some more ambitions in terms of inorganic growth? Because some part of the street is a little confused, in terms of the aspiration, the direction that you're heading in. Inorganic growth is good, but do you have a bigger appetite, or now you're done? Now you'll want to ramp up all these assets?
So, see, we have done two acquisitions in this year. Calendar year, if you look at it. One is we did Jayhawk in February, March. And another one that we're looking to consummate it in another 2 to 3 months' time, depending upon the SEBI's open offer and SEBI's approvals and others. I think there is enough that we have done. Today, there is nothing more that is on the horizon to make any statements here, I would say.
Okay. All right, Mr. Tucker, we appreciate you joining in. And if you do, we are at CNBC TV18 are happy to host you. All the best with this inorganic growth, and all the best for the remainder of this fiscal as well. We'll chat up rather soon.
Thank you.
Okay, all right. That is Anupam Rasayan with perspective on the numbers and, of course, the acquisition as well. I mean, markets have come off a little bit, but not much. 220 points, 23,940 is where the Nifty is at. So it's a slow, soft slide which has happened from the top, but not very far. Just two names, right? Data Patterns is up about 3.5%. And Paris Defense is the other one. Paris Defense is up 6.5% right now. So just want to highlight. And you got three large cap names, Eicher, Mahindra, which is up 2.5%, and L&T. Mahindra and L&T have not done well. I mean, in the rebound, etc., Mahindra has lagged. L&T as well. They saw initial excitement off the lows, but then really didn't go anywhere. And of course, Shriram Finance, every time it comes off to close to about 950, it starts to see a bit of a bounce. 966 on Shriram Finance coming through as well. Lots of stuff at this point. Nagaraj said he's with us to run us through what he'd want you to do. Nagaraj, good morning. Good to have you here. So would you want to go long here, wait for a dip? What's the thought process?
Hi, good morning, Prashant. Yes, Nifty has moved above the hurdle of the last couple of weeks around 23,800 levels. The overall chart pattern is looking positive right now. And as long as Nifty sustains above 23,850, 23,900 levels, there is a higher possibility of a sharp breakout. And initially, we could see Nifty reaching the target of around 24,300 levels in the next few sessions.
And stocks?
Yeah, I have two stocks from the long side. First one is ICICI Prudential Life Insurance. The worst part seems to be over for this ICICI Pruli and has bounced back very well after forming an important bottom reversal somewhere around 490 levels. The overall chart pattern is looking positive, showing some accumulation patterns. I'm expecting more upside from here onwards. Currently trading around 526.75. One can look to buy at this point of time. And immediate target would be around 555. One can place a stop loss at 510. Second one is CSE. CSE Limited has been in a consolidation phase in a downward correction over the last couple of weeks, and it has bounced back very well in today's session from the lower levels. I think 175, 180 seems to be a bottom reversal for the stock price and currently moving up from near the hurdle. And overall chart pattern is looking positive. One may look to buy CSE at this point of time, currently trading around 183.75. Immediate target would be around 193. One can place a stop loss at 178.
Thank you very much for that. Get into a break on the other side. Manisha Gupta will talk commodities. Stay tuned. Welcome back. As promised, let's talk commodities. Manisha is joining in and she's talking about the decline seen in crude oil prices. Manisha.
Well, absolutely. Last week was no better. We did see prices come off from the kind of highs that we've been trading at. And this week as well, it started on a weaker note yet again. 6% of a decline and just about trading at around 97 to 98 between those levels. So it's not just the Brent which is trading at a 2-week lows. You have heating oil, gasoline prices trading at a 4-week lows as well. All of this on the kind of statements that we seem to be reacting to on the weekend there, where the potential US-Iran deal that could reopen Strait of Hormuz is something that the market are working with. But in sense of statements, the US is saying that there is a framework for a peace deal with Iran that is largely being negotiated. US also has said that there's no hurry really for a deal and that after a deal only the blockade of Iran will be open therein, and until then it will remain in place therein. If you look at the key price movements, really the last 2.5-3 months have seen big volatile moves come in for the crude oil prices. On 28th of Feb, that is when we saw the instance of US and Israel attack on Iran. That is when we saw prices gain up anywhere between 10 to 13%. And then on 31st of March is when we saw the peak cycle coming in for the crude oil prices, when $120 a barrel came in on the chart as well. This was after the closure of Strait of Hormuz. Until then, it was only a conversation, but 31st March is when Strait of Hormuz got shut. 7 to 13th April also has seen a lot of movement come in for the prices. We did see prices decline by 18% on ceasefire news, and then it came back above $100 a barrel after the US blockade of the port in sense of Iran there. 20th to 22nd of May, the prices have kept on above $110 a barrel, even as the peace negotiations were getting on and then falling apart therein. And then we are looking at the markets today, where we're looking at 5 to 6% of a decline coming for the crude oil prices. So even as there is a decline in the international markets, Indian prices have been hiked in sense of fuel for petrol and diesel as well. A fourth instance, really, when you look at the last 10 days, between 15th of May and 25th of May, we've seen 4 instances where Indian petrol and diesel prices have been hiked, coming to the total of around 7.5 to 8 rupees for both of those varieties there. Looking forward, when you look at the price forecast, most banks and brokerages believe that we are looking at higher prices in this year and much lower or perhaps status quo in 2027 as well. EIA says $89 of an average is what we will look at this year, but cuts it down by $10 to $79 for the next year therein. JP Morgan talks about 96 of an average this year, 75 again on the lower side. You have 70s being talked about from Morgan Stanley as well. But Barclays and Goldman Sachs believe that 80 to 100 could be an average for crude this year and the next year as well, because most of the statements coming in from major crude producers and traders is that it would take by the end of 2027 before we see normalization or full resumption of crude production and exports coming in from Middle East.
All right, thanks very much for that. So just holding around 98, but about $1 lower as compared to where we were about 3 hours back even. We'll take a quick commercial break here. We'll come back and it's the economy. Lata speaks with Neeraj Seth of 3R Investment and Mithul Kotecha of Barclays on rupee, rates and equity. Stay tuned.
Welcome to It's the Economy. Indian stocks and currency have got a shot in the arm today, with crude falling below $100 for the first time in May. If the Straits of Hormuz were indeed opened shortly, what's the likely impact on the rupee? And will FPIs start giving Indian equities a serious look in? Separately, fuel prices have been raised for the 4th time in 2 weeks. Does this elicit a rate hike from the Reserve Bank? And if petrol and diesel prices are higher and there is a rate hike too, will that mean earnings downgrade, keeping FPIs away for a bit more? For all these key questions on rupee, rates and stocks, I'm joined by two experts, Mithil Kotecha of Barclays Bank and Neeraj Seth, founder and CIO of 3R Investments. Mithil, Neeraj, deeply grateful. Thank you very much indeed for joining. Mithil, we want to understand rupee. We saw 96, but thereafter there has been a sharp 1.5% recovery in the currency. Is most of the bad news in? Can we see more stability?
It's a very good question, Lata. Thanks for having me on the show. Look, I think a lot of bad news is in the price, for sure. There is no doubt about that. I think the rupee is benefiting from a number of factors here, right? We're edging towards some sort of a potential MOU between Iran and the US, if you take a look at all the press reports over the weekend. Oil is lower, and that's obviously benefiting the rupee, given a lot of the pressure has come because of India's oil import bill. Separately, the RBI meeting, there is some speculation talk that the RBI may need to tighten policy to defend the currency. And we know that the RBI has enacted a number of measures over recent weeks to try and support the rupee. And so there is some speculation, not just potentially of a rate hike, although that's not our base case, but potentially of other measures that the RBI might announce. So when you put it all together, it's given some relief to the rupee for now. We're not entirely convinced this is going to be sustained, but I think at least for now, we may not see the same sort of pace of depreciation in the weeks ahead that we've been seeing more recently.
Okay, just if you can develop that only one point very briefly. On Friday, we saw a fairly good rally in the currency, especially after Indonesia raised rates by 50 basis points. So is the rupee rally contingent on rate hike expectation? I mean, if it didn't come on June the 5th, is the rupee hurt?
That's a good question. Look, our view is that to really defend the rupee, we need to see a much more aggressive rate hike from the RBI. If it's a 25 basis point move, it may not have much of an impact. Even 50 is questionable. I think, you need to see something aggressive. But given how much markets have already priced in, don't forget the markets are pricing in already several hikes from the RBI in the next several months. So it may come as a disappointment if nothing happens. But look, it still seems unlikely in our view that the RBI will hike as early as this meeting. So, yeah, I don't think that's our base case.
Okay. Well, actually, the governor has spoken today to Mint newspaper. And the key takeaway I'm getting is the chances of a rate hike have increased, but not on June 5th. That seems to be the understanding. Neeraj, actually a similar question to you. Are you penciling in a rate hike? Since you look at all three markets in India, stocks included, a rate hike along with fuel price hikes means some change to earnings expectations also. So what are you penciling in on June 5th and later in terms of hikes?
So, Lata, in my base case, I think RBI is going to be on a wait and watch mode. And I do agree that at this point, rushing into a rate hike might not be the best decision. And if you look back last couple of weeks, you've seen some of those hikes coming through. You saw Indonesia actually surprised to the upside. It didn't do a lot for the currency from that aspect. So I think given the uncertainty with regards to the Strait of Hormuz and the resolution, I don't think rate hike immediately is the best option. It should be on the cards, but not now. And obviously, the earnings will become an important focus when you think about the oil price where it is and if you do get rate hikes.
Okay, fair enough. I mean, see, the Reserve Bank's flexible inflation targeting framework actually requires it to use interest rates for inflation and other measures for exchange rate. But, when things go to an extreme, there is a debate whether they will, go away from the Brahminical path of FIT. But Neeraj, the bigger question actually is, let us assume, hypothetically, the weekend news that Mithul was referring to is going to end in the Straits of Hormuz opening sometime in June. Does that attract FPIs into India?
So I do think that will actually lead to a relief rally. But for seeing a sustained rally, I think you need different factors, including the earnings momentum to pick up, the earnings growth to show up. And one important point that we have talked about it a lot in the past, India is not a part of the AI story, which is what the momentum is around at this point. So I don't think that resolution completely, even tomorrow morning, in terms of the flow of oil from Strait of Hormuz, leads to a sustained rally in Indian equities as yet.
Okay. Well, you know, I've gone through this argument with every guest. When you look at the markets that have done very well over the past 12 months, Neeraj, it is not only the AI markets. Of course, Taiwan and Korea have beaten several markets hands down. And specific stocks like Samsung and Nvidia have beaten other stocks. But there have been commodity. For instance, Brazil has done well. South Africa has done well. So, I mean, growth has a chance. You don't think that non-AI, there is a non-AI opportunity in India once this crude uncertainty is out of the way?
There certainly is, and that obviously will be, again, how investors would look at it. But if you think about where the starting point of the valuations are, let's say if you look at India versus Brazil, South Africa, China, India is between 6 to 8 times of additional multiple on the earnings that one is paying. So the growth has to be meaningful to justify that valuation at this point for a global investor to allocate aggressively towards India.
No, I take your point. We've so far looked at our higher valuations as a birthright. And the big lesson from the last 2 years has been that the world is not yet, I mean, at the moment, not willing to give us that extra valuations. Mithul, similar question to you. What are foreign funds telling you about entering India? Is there, a likelihood of a flip in the sentiment because rupee is so cheap and stocks have fallen? You know, we are in correction territory from 26,300 24 months ago. We are now at 23,000 plus. It is a 10% correction and it is like a 15% correction in the currency. Is the combo likely to attract foreigners to at least bonds, if not rupee, if not stocks?
It's unlikely that at this point it's going to suddenly result in a rush of capital coming in. But ultimately, to your point, both the currency and, as we heard from RBI Governor Malhotra today, the currency is cheap. Equities have cheapened, no doubt. But clearly, again, to the point made earlier, I think India needs to see, one of the things that when I speak to investors is that the lack of significant AI element in Indian equities has been a big drawback, especially as you mentioned, when you look which equity markets have really rallied in Asia, it's those tech-heavy Korea and Taiwan. And India's found it very difficult to keep up with that because of this AI or relatively missing AI component. So it's not just about valuations. There has to be an inherent fundamental reason. And I think, look, so far, the weakness in the rupee has also had a large part to play from the equity outflows that we've seen from foreign investors, which have totaled over $23 billion so far this year. So clearly, any turnaround in that would help. And, as I said, the rupee is also cheap, but things can remain cheap for a long time before they turn. So it's not obvious that foreign investors would jump in just because the rupee or equity valuations have cheapened.
Fair point. What's the chances that India may get into the Bloomberg index, you think, Mithul?
Look, I think there is, in terms of bonds, I think, look, that there's every chance that India is moving gradually towards that way. I think
June itself, June, because I think they're going to relook in June, right?
It's possible. I mean, look, it's hard to say here. I think the Bloomberg will look on India in a better way, especially given recent news about potential reduction in tax for foreign investors into India's bond markets. That's been a big bugbear for foreigners, this withholding tax. So if that changes, that could help. But it's not clear yet whether enough has been done to warrant India's inclusion, at least at this stage.
No, the government has not yet talked about removing that withholding tax at all, nor removing the capital gains or what you call residence-based taxation for equity. So yes, that bugbear remains. Neeraj, your take on the Bloomberg inclusion in June itself?
I think that sounds a bit premature. Medium term, I do think that's the direction of travel. I do expect. Another point worth highlighting is these index inclusions also, you have an announcement And then it's a long path between 18 to 24 months for actual index inclusion that happens. So I think this certainly, I would expect it to happen, but I'm not sure about June at this point.
Yeah, fair point. And not only that, even after the inclusion, there can be people who will be underweight vis-a-vis the index. So yes, all those are there. But Neeraj, are you nibbling at this point in time? Is there, for instance, say, banks have done well today, probably expecting that there will be rate hikes at some point, given the fourth consecutive petrol price hike. I mean, anything you're picking up?
So we've been more tilting towards, obviously, the fixed income and the credit side of the equation. So where we are nibbling, and I'm still comfortable in the dollar-denominated credit space from India, still like the front end of the curve, like 2-3 year maturity names, fairly stable. The technicals are extremely strong despite the tight valuations, because at these levels of dollar rupee and the hedging cost, there's not really much of a supply that will come from India in the dollar market. And in the onshore market, we're pivoting more towards a high-yielding, illiquid private credit and INR in India, because there you are from a risk...
Neeraj, let me interrupt. Something big may come your way. The big buzz in India is that along with the monetary policy, or, you know, sometimes even differently, separately, there is a chance that PSUs, especially PSU banks, I mean, including PFC, REC, may be asked to go out and borrow via ECBs or bonds, and the Reserve Bank will bear the hedging cost or subsidize it. Will that have an appetite?
That will have an appetite. If I take a step back, I think the more important point that I would highlight is, in a near term, India needs to boost confidence, and the confidence around the ability to attract as many dollars as the country needs, so that the concern around balance of payments and these current account deficits are at least lower. I don't think PSUs going and borrowing a little bit will solve that confidence. I think there needs to be something bigger. You go back in history, we have seen it in 90s, we've seen it in 2013. It did have an impact, but then it was 2030 was 25 to 30 billion dollars. PSUs cannot borrow $30 billion out of market.
Okay. Sorry, out of time, Mithul, but if there were such an offer, will it be bought?
I think you need to see attractive rates. It goes back to the FCNR as well, right? The RBI may need to offer more attractive rates to encourage such inflows going in. And I totally agree. I think if it's just PSUs, I don't think you're going to necessarily see the sort of inflow that would be needed.
Yeah, I would assume that both on taxes and on this ECB move, the government and RBI may be just willing for the most catalyst moment. Probably with the Straits Open, you announce on that day, it could be better received. Well, that at least is the buzz. I'm not any more informed than others. Thank you very much, Mithul and Neeraj, for improving our understanding of how things might be if the Straits were to open, if the Reserve Bank were to announce something. Wrap up on Bazaar on that note. Chartbusters in a minute.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, markets holding with solid gains. It's a super start to the week. Monday morning, markets holding well in the green. Nifty up, Mangalam, 250 points. The broader markets as well participating. And a lot of earnings are trickling in. The positive today has been that crude oil prices have cooled off. That said, since we're getting a lot of results that are coming in, let's welcome the first management, Minda Corp. They posted actually a rather strong showing in the fourth quarter, record quarterly revenue as well as margin expansion, despite higher input costs. Mr. Ajay Agarwal, the president of finance and strategy at Minda Corp, joins us on the show. Hi, Mr. Agarwal. Good morning. Good to see you in. Congratulations first. Good set of numbers. The street likes it. Post your numbers. I think the stock has rallied 8 to around 9% or thereabouts, telling you that the street likes what they saw. Let's look ahead though. Input costs have spiked up. How much of the impact will we see in the first quarter? And will it be that in the second quarter we'll see a larger increase because input costs have gone up? There is some supply disruption as well. So give us some clarity on that front.
Thank you so much for having us on your channel. Yes, input costs are increasing, and thankfully, the way our industry functions, most of our input costs, whether it is commodity or non-commodity, is generally bypassed to the OEMs and to the automobile companies. So while we will see a little bit of margin pressure because of the denominator and numerator factor, but overall, we don't expect from our balance sheet point of view to have any kind of impact on escalation in commodity or any other input cost price.
All right. So you don't see any impact on your input cost price, and you are on track for your margins to reach about 12.5% by FY30. That's correct, right?
Yes, we are targeting that, and I think our trajectory is well planned to achieve that stated target.
Right. You know, as I speak, I'm curious to know what's written on the whiteboard behind, because a lot of that appears to be Japanese script. And that brings me to the question, the Toyo Denso joint venture that you've made, right? What's the kind of total addressable market that you foresee here? And what's your own estimate of revenue contribution from this over the next 3 to 5 years? What's the kind of margin this business has?
Yeah, so just to correct you, it's written in Taiwan and not in Japanese.
Got that. Not that we understand either, sir.
You are right. Had it been Chinese also, we would not have been able to understand. Now, to answer your question, yes, we are extremely proud with the joint venture which we have signed with Toyo Denso last year. I think the progress on putting up the factory, coming up with the facilities on track. We expect the first SOP to start towards the Q4 of this fiscal year and ramp up to happen the next fiscal year.
Okay. All right. And you're saying Toyo Denso, this JV, the market opportunity size is 10,000 crores or thereabouts. What kind of number will you be looking at, say, in the next 3 to 5 years from now?
From a full-scale point of view, we are targeting, close to about anywhere between 600 to 700 crore revenue out of this joint venture up till 2030. And thereafter, we will see how do we, take a larger market share from other OEMs.
Okay. I had one question with regard to this JV that you're merging with the entity, Minda Vast, I think so. Did, I think, revenues of close to around 500 crores in the past year and margins of around 7%. So give us some clarity on this. What will be the dilution of this particular, merging this smaller entity into the parent company? And what does it take the promoter holding? What was the holding structure over there in that entity?
So it was a 50-50. And just to correct you, we are not looking at either merging ourselves or merging Minda Vast with Minda Corporation.
Okay.
We have amended the shareholder agreement. This is the first amendment which we carried out in consultation with our joint venture partner. Due to amendment in the joint venture agreement, it has helped us to consolidate the result of Minda Vast into Minda Corporation. So that's the only technical change has taken place, which will allow us to add close to about 500-600 crore of top line. And, it is targeting to deliver anywhere between 8 to 9% of EBITDA. So that those two numbers will get consolidated.
Till now, you were not consolidating it. It was coming as... So now it goes to above 50%. Is that correct?
The shareholding ratio remains the same. However, because of the amendment in the shareholder agreement, it allows us to consolidate the result into Minda Corporation.
But that does not make any more change than cosmetic, right? Because then you will have to remove what is not your share on that already. Earlier, what was done below the line item now comes on top of the line. So what was the rationale for doing this?
The rationale was clearly to look at how do we get better control over the operations of the company as well as on the management, to also to ensure that this company gets consolidated into Minda Corporation.
I mean, better control you could have...
Otherwise, you are right that, it was only the profit was getting added in our profit after tax line item. Now we will see a line-by-line consolidation into Minda Corporation.
Yeah, but then, I mean, I'm not sure whether just financial consolidation would change the way you control that business in any way, right? I'm just trying to think of it from a business operations standpoint. You amended the shareholder agreement and now you're consolidating it line by line as against just the profits coming in earlier. When I ask you the rationale, you're saying that it will give you better operational control. Can you explain how it will give you better...
For example, should the party do not want to continue the joint venture, we have certain preemptive rights where we will be able to take control of the company. That's not the idea. That's not what we are thinking of doing it. Nonetheless, the idea was primarily to see how we can consolidate the Minda Vast business into Minda Corporation.
Understand that. So does that change your long-term 2030 guidance, or this is just a way that, you get more sure of the 2030 guidance? Because earlier, I'm not sure whether this was factored into the guidance that you had given of 17,500 crores on the top line.
No, your understanding is correct. It was always part of our 2030 guidelines, including the consolidation of Minda Vast.
All right. And you also had a plan of making an acquisition, a 500 to 700 crore rupee acquisition, to further boost that, to further accelerate your boost towards that 17,500 crore mark. If you could give us a sense on where that is, and also give us a sense on, how your realization per vehicle is likely to be over the next few years. You've given us a higher share of revenue coming in from PVs by 2030. What is the glide path to that number?
So if you look at, PV contributes about 14-15% today. With Minda Vast consolidation, it will contribute about 20-21%. And with other product, which is the pipeline, we are looking at how do we take the market share, or at least from a group consolidated point of view, up to 25%. That's the guidance we have given to the market to reach 25% passenger vehicle revenue coming up to 2030.
All right. And exports is a relatively smaller part of your business. Growth you're guiding for year, and have there been disruptions in the last 45 days?
We have not seen, any kind of change or any kind of disruption. And, if you look at this year, export contribute about 10%. And long-term guidance also, if you look at, we said by 2030, from current 550 crore, by 2030, this number should triple up to 1,500 crore by way of an export.
Take that point. Thanks a lot. Always a pleasure speaking with you. You've given us clarity on a whole host of questions that we had. Wish you good luck for the future and your 2030 guidance as well. With that, we'll take a short break. In fact, as we do that, let's get you some ideas for profit coming in from our colleagues at Money Control Pro. We hear out what Jitendra Gupta has for us. Take a short break, come back and get you more on the markets, a lot of individual stocks, perhaps the management of Hindalco as well.
Hi, thanks. We like JSW Energy, which is one of the fastest growing private sector power companies, now focusing towards large renewable additions, storage expansion and battery manufacturing integration, which together I think would drive the next phase of earnings growth. Part of this is visible in Q4. We saw almost 41% year-on-year growth in revenue, while EBITDA surged almost 87%, supported by higher generation, renewables, strong utilization, of course, benefit of recently acquired assets. Management remains optimistic on the demand outlook. If you look at after muted FY26 power demand growth was just 0.9% due to extended monsoon and demand recovery. But nevertheless, the demand recovery has already accelerated to around 4.6% for the period year till date. It has nearly 14 gigawatt under construction, which is in line with its long-term 30 gigawatt target by 2030. Storage is emerging as another major growth vertical with locked-in storage capacity reaching almost 30 gigawatt per 30 gigawatt hours across battery storage and pumped hydro projects. Going ahead, it plans nearly 3 gigawatt of fresh addition in FY27. In terms of valuation, the stock trades at 38 times its estimated FY28 earnings, which may be premium but should do well in the light. Stock should do well in the light of aggressive project pipeline and of course strong earning visibility.
Welcome back. It's a 1,000-point uptick that we're seeing on the Nifty Bank. All batters in fine fettle right now, just about 15 points away from the 24,000 mark on the Nifty. It's been led by the Nifty Bank. And pull up the intraday chart of the Nifty IT as well. We've seen some strong pickup out there. And this, despite the strength that we're seeing in the rupee this morning, which continues, which is a good thing for, domestic guys, but not so much for the exporters. But despite that, the IT index is doing extremely well. Rupee at the high point of today's trading session so far. Also, Reliance continues to do well, about 7 rupees higher in today's trading session, very close to both its 20 and the 50-day moving averages. So if Reliance breaks past, then you have the top 3 batters, firing up for the frontline index. And the mood in the broader markets is even better. If you look at some of these mid-cap IT names, so you have Oracle Financial Services, which has spiked to the high point of trade. We have Intellect Design Arena, which is up around 4% as well. And Tata Elxsi, along with KPIT Tech, are the others, which are higher as well. But the stock on our radar, the stock of Friday, was Hindalco. And we have the management, Nigel.
Well, that's right. Hindalco actually reported a good set of numbers with regard to their India business. The stock has come in for some profit taking. But to understand the past quarter, the way ahead, we're joined by Mr. Satish Pai, the MD at the company. Hi, Mr. Pai. Congratulations on a good showing. And in all probability, the way ahead as well looks quite bright. But let's get a couple of numbers. Earlier, you were factoring in aluminium prices at around $3,000 per ton. But now there's been a lot of chaos in the Middle East. A lot of capacity is going, out for a few months at least. What's your revised estimate on aluminium prices for the remainder of this year?
So as you said, the LME prices have gone up to 3,600, largely because nearly 2.5 to 3 million tons of Middle East aluminium has gone off the market. So I think that it'll be fair to say for the rest of this year, we are looking at an LME that could be in the 3,500 range. But you can see it's in a very steep backwardation. So next year prices are $400-500 less because people are expecting that Middle East aluminium will come back on the market by the end of this year. Now, the next important question is input costs. So input costs are going up. Q4 to Q3, the costs were up 2.5%, and we are expecting another 5% increase Q1 to Q4. What has really gone up is furnace oil. So all fuels, the prices have rapidly jumped up. So furnace oil is up, CP coke is up, pitch is up. So these are the ones where we are starting to see cost inflation. So our estimate is Q1 to Q4 will be another 5% increase.
All right, that's about input costs, but the dollar depreciating should be good for your business, right? I mean, is there any quantitative benefit that you can give us?
So for us, as you rightfully said, since our top line is dollar denominated, and most of our inputs, except the little bit we import, like some amount of CP coke is imported, coal in Dahej is imported. But it'd be fair to say that the rupee depreciation has benefited our bottom line.
You want to put a number to that, sir? Because there are costs and there are incomes, both dollar denominated. Net, what's the result?
Not really. It's
Okay, all right. All right, got that. Let's move on then. You know, the aluminium EBITDA per ton, Mr. Pai, it's done phenomenally well. $1,756 per ton. And going by what you're saying, on the pricing side as well as on the cost side, it appears that Q1 could be much better. Could you give us a number out there?
So difficult to say for the whole quarter, but it'd be fair to say that Q1 will be a step up from Q4 as well. Because, you know, we did Q4 at an average LME of about 3150. And I think that Q1 will be probably at an average LME of 3500. So you are going to see a couple of $100 more go down to the bottom line.
Right. What about the Oswego unit, sir? I just wanted to understand, because that commences operations this quarter. X of all the one-offs, what's the trajectory of the EBITDA per ton at Novelis? I mean, can you give us an exit run rate at least, EBITDA per ton?
Our real focus, as you said, in Novelis is to get Oswego restarted and get that volume back on the market. Because if we can get that volume back, our target is to maintain our EBITDA per ton around 500. It goes up and down depending on scrap spreads. So getting the Oswego volume back is our number one priority. And then, of course, to get Bay Minette commission, where the volume effect will not be seen in this FY26, but will be seen next year.
All right, Mr. Pai, what could be a bit of a tailwind to your business in the coming quarters will be this Midwest premium that has surged up. So what's the current Midwest premium? Where will it settle at?
So that's a good question, because the Trump 50% tariffs were baked into the Midwest premiums. But as availability of metal has gone tighter, the Midwest premiums are at all-time highs of nearly $2,000. So difficult to say, but if it depends on the supply and demand as well as the availability of metal in the US. But right now, they're very high.
Okay, all right. Let's turn to the other part of the business where there was a pleasant surprise. That's the copper business. But given the surge in the byproducts prices like sulfuric acid, should the copper EBITDA per ton reset even higher? Earlier, you were doing 600 to 700 crores odd. Last quarter, you did 900 crores. Will it get better?
No, I don't want to revise anything, but fair to say that Q1 should be more or less equal to Q4 because sulfuric acid prices are still very high. You have to remember that our profitability right now is driven by these byproducts, and many of them, the prices are high because of the Middle East situation. So clearly, the other quarters will depend on whether the Middle East situation gets sorted out, sulfur prices come down or not. But it'd be fair to say that Q1 will be in the similar level as Q4.
What's the outlook on CapEx? If you could give us a sense on how much you are going to earmark, and what does that take your net debt number to?
Yeah, I think that, we exited at 1.83 net debt to EBITDA. I think that we are going to spend 12,000 crores in India in CapEx, roughly 2.3 to 2.4 billion CapEx, largely Bay Minette in Novelis. Our estimate is that we will also exit FY 26, 27 at similar range of net debt to EBITDA between around 1.8, 1.9.
All right, final question, Mr. Pai, before we let you go. You know, you have aluminium expansion capacity planned here in India, but that will take some time, right? Give us a time frame. What is the quantum that comes on stream and by when?
So I think our 180 KT Aditya phase 1 will commission in December of 27, and the next 180 will commission in December of 28. So you're getting 180 KT each from next year onwards.
Appreciate you joining in, Mr. Pai, and giving us all those details. So in quarter one, the aluminium EBITDA per ton will improve. The copper EBITDA will improve, and Novelis as well could see a bit of an improvement. So there'll be an all-round improvement coming into those numbers. But if you just pull up a 3-month chart, you'll see that the stock has rallied 20%. The metal index is up close to around 8%. So that's why it could be coming in for a bit of profit taking in today's trading session. That's Hindalco. You know, in the last 3 months from those lows, 840 has become around 1,100 rupees or thereabouts. That's even outperformed what the metal index has done. And just one more point, he spoke about CPC prices. That's, the calcine pet coke prices. That has spiked up, and that's why we're seeing a stock like Rain Industries is up as well. And he said CTP, which is coal tar pitch, that as well has moved up. So that's the reason why Rain Industries has moved up yet again on the back of that commentary that the management did make. So keep an eye out on that one as well. Well, time to slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay with us. Welcome back. Markets at the high point of the day, and let's focus on the top gain on the Nifty. Sudarshan joins us to tell us about Eicher Motors numbers that look quite good. Sudarshan, run us through the numbers. If you want a ride, I can give you a ride later post-market hours. But for the time being, let's analyze the numbers.
It was a strong set of earnings that Aisha Motors has reported for Q4 FY26. Two main numbers, revenue growth, which was aided by the healthy volume growth. The company has seen it was up almost 12% year on year. And if you talk about the margin, despite the increase in the commodity cost, company managed to hold on to the margin levels around 25% at this quarter. It was 24.9%, almost in line with expectations. So in Q4, margin impact of 90 basis points was mitigated by the price increase that company has taken. But for Q1, commodity cost increase is going to be sharper. And for Aisha Motors, the impact is going to be in the range of 3 to 3.5%. Of which 1.75% increase, price increase company has already taken. Remaining impact that companies believes that it will be mitigated by the other measures. Other concern that for Eicher Motors, it was the volume growth, especially in the month of May, and that Vahan data was reflecting, for which company is saying it was mainly because of manpower shortage issue that company has faced, also because of LPG crisis, and that issue is also getting resolved. So if the volume improves, there is no concern for Eicher Motors. Most of the brokerages remain positive. CLSA maintains outperform call. Even Goldman Sachs has buy call. Even HSBC maintains buy call. And target price, if you talk about, goes as high as 9,500 rupees per share.
Okay, all right. Sudarshan, thanks a lot for that. And I promise you that ride on the bike, if you're interested. You can ride or you can sit behind. Either one, whichever one you choose. Thanks for joining in, soon. Well, let's focus on a few stocks in the broader markets. TVS Electronics, just take a look at that stock. That's moved to the high point of the day. It's up close to 15%. It's only a 1,100 crore market capitalization company, but big uptick is what we're seeing. TVS Electronics comes up for you on the screen. Suntech Realty, the stock fell one way. Today, it's moving higher on decent volume. Stock up 6.5%, though it's a far cry away from the recent peak. So keep an eye out on that one. Rain Industries, that's the other stock that we were talking about with regard to input costs moving up. For aluminium company as well, they're enjoying the benefit of higher selling prices, but input costs as well have spiked up. As Mr. Pai said, input costs have gone up by 2.5% in the past quarter, and they'll move up even more from here on. So that explains why that one is up close to around 5.5%.
Right, so those are a bunch of stocks. The Nifty within smishing distance of, the 24,000 mark. The Sensex doing extremely well as well. All guns blazing. What we'll do is leave you with an all-green screen on this edition of Chartbusters. But don't go anywhere. The team of Trading Art comes up next. Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, as always, Hormaz Fatakia and Ritu Singh. We kickstart a new week with a renewed hope of peace. The market's reflecting that. The absence of cues coming in from US tonight, along with the fact that you have the expiry week tomorrow as well, keeps this week very busy when it comes to cues, but none bigger than the hope for peace. And that's reflected in the reduction in Brent oil prices and the strength in the rupee that we've seen from Friday to now. Importantly, the broader market's doing a lot better. Nifty within touching distance of 24,000. Good morning, Hormaz. Good morning, Ritu.
Good morning, guys. And yes, the optimism is clearly reflected on the macros and in the equities. Crude prices above $100 a barrel for the first time that we're seeing this kind of a number in the entire month of May. And the rupee, better than, what we've seen in the last 2 weeks or even more, recovering as we speak, 95. 1-2. That's the level we're looking at. It's pretty good, nothing to complain about. The Bank Nifty also reclaiming that 55,000 mark. You have, the Nifty, of course, up just a few points away from 23,000, 24,000. Hopefully, we'll see those kind of levels. The IT pack is a bit of a drag, but apart from that, the market breadth is very good. You have more than 3 stocks advancing for every 1 stock that's declining. So it's looking like a good day today. Hormaz.
It indeed is, and the bulls will be happy for the fact that the macros are finally looking to fall into their favor, and the 24,000 level is the one that the bulls are watching out for with a bated breath as we head into the monthly expiry session tomorrow. We've been there and thereabouts all through the first couple of hours of the trading session, which still shows that there is some bit of resistance still there on or near that 24,000 mark. Of course, the big positive this morning has been the fall in oil prices. The Brent is now down 6%, as is NYMEX, and that is showing up on the stocks as well. ONGC Oil India down, yes, but the oil marketing companies, take a look at them. HPCL, BPCL, Indian Oil are now up 4% each. And not just the fall in crude oil prices, of course, the fuel price hike that you've seen today, it's the fourth in the last 10 days, and that too is having a positive impact on these companies. You take a look at the earnings reactions, there were plenty over the weekend. Eicher Motors is the top gainer on the index, 5.5% higher now. Some very bullish commentary coming in from the brokerages this morning. Narayana Health, of course, 4.5% higher, but not so positive reactions coming in on NTPC Green Energy, and Colgate opened higher and then has given up all of those gains, down 2.5% as well. You take a look at the newsmakers today. Titagarh is up 8.5%, and that's on the back of a news report which suggests that the railways is going to lay out a big freight wagon procurement plan, as a result of which the stock is doing well. Info Edge, after the price target cut from JP Morgan. Sterlite Tech, after a $1 billion order, is up in upper circuit, and Tenneco Clean, it's a FTSE All World Index edition, and analysts expect some inflows in the stock. Some movers in the small cap space today. Look at Hariom Pipes, it's up in a 20% circuit. TVS Electronics is up 15. Apollo Micro, yet another day of gains, 11% higher, and HFCL is now up 140% in just 36 trading sessions, and that's the kind of move that you have seen on the stock. And lastly, stocks at 52-week highs. Torrent Pharma, of course, another earnings reaction, 5% higher on the stock. Angel One continues to make new highs, as do Aditya Infotech, and Greenlam Industries up another 10% today.
Take that point, Hormaz. Thanks a lot for that. So you've laid out, the way the market's moving, individual stocks, a lot of earnings reactions as well. So let's welcome our first guest on the show. We do have TTK Prestige. There was a strong performance that we saw in the fourth quarter, intuitively led by induction cooktop sales with return to profitability, despite some pressure on margins. The outlook, the business, and the prospects. We do have with us the CEO and MD, Venkatesh Vijayaraghavan, who joins in. Thanks a lot, Venkatesh, for joining in. Always a pleasure speaking with you. It was a good performance. We did see, decent revenue growth. EBITDA grew by over 30%, and we saw some growth in your profitability as well. A large part was, understandably, appliance-led. Could you give us a sense on what proportion of your sales in the fourth quarter were contributed by induction cooktops, and how much is that playing out in the first quarter as well, in light of the uncertainty that still continues? And what's this likely to settle at going forward on an annual run rate, according to you?
Thank you. Always a pleasure to be on your show. Like you said, the last quarter has been sort of a good mixed bag for us, driven by induction cooktop, of course. However, I would like to qualify that in addition to the induction cooktop, I think we've also seen a reasonably good growth in the other categories, driven by some of the transformation work that the organization has been undergoing in the last 2 years. Induction cooktop, no doubt, has had an impact, but that would be probably limited to 30-40% of the upside. I think a large part of our growth is also being underlined by some of the initiatives that are bearing fruit for us over the last 2 years. And I'm quite sure that will continue to be the story as we move forward. In terms of the appliance side and in terms of induction cooktop trend, we do see that even in Q1, we are seeing an offtake driven by a little bit of uncertainty around the global economy and the issues around the global economy. That uptake seems to be continuing in the first quarter as well.
All right. Just another follow-up on the raw materials, because a large part of your raw materials, obviously aluminum, and we've heard from the management of Hindalco just moments ago that aluminum prices are likely to rise globally as well. This geopolitical issue with the depreciating rupee and higher input costs for a lot of these players are increasing a lot of your input commodity costs as well. So to that extent, what is the kind of margin pressure that you foresee? The fourth quarter, obviously, you had the benefit of lower priced inventory. As that gets eroded, how much of a price hike do you expect and how much of a hit on the margins will you expect?
Yeah, there's been a substantial impact on the input prices, particularly on aluminium, and we've also seen stainless steel also go up. These are two important commodity materials for us. Aluminium has seen a very steep increase in the first quarter. The price increase started happening towards the end of the last quarter, and it's continuing into the first quarter as well. I do believe that that could be to the tune of around 10%. A large part of it, we believe, would be passed on by the industry to the consumers. So we would look at sort of holding on to the margins with some amount of internal cost initiatives that we have undertaken. However, there is pressure on the margins. And like you asked, the extent of the cost increase has been around 10%.
Venkatesh, just a clarification on that. Since in the fourth quarter, your revenue growth was pretty strong and we still saw a margin compression. Any near-term, targets you could give us, any levers to improve this further? And also on your induction cooktops, they're 12 to 13% of your sales. They're a high margin product. Going ahead, what sort of contribution do you expect overall? And are consumers increasingly shifting towards this, or was it just do you think this is a few quarters phenomena?
No, I think while we initially did believe that this could be sort of a short blip, I think right now, going by consumer feedback, a lot of consumers have now started to look at induction cooktop seriously. The category was always a supplement to the gas cooktops, and it was always on the back burner. But today, I think with the changes and the possible impacts that could be visualized, people have started to buy them more proactively. So the category is here to stay. In my view, I think this is one of the shots that the category's got for a growth. And I do believe that the growth would sustain, may not be to the extent of what we see in Q4 or Q1 of this year, but it's a sustained growth vis-a-vis what was earlier. To that extent, I think margins from this category have been healthy, and it should help us as we move forward. It should help the industry as well.
Venkatesh, in light of that, fair to assume that the induction cooktops will become a far bigger part of your business compared to what it currently is, from around 12 to 13%. Does that go up to, say, 15-16% conservatively if this trend continues? And if so, and if the trend of buying is so good, are you looking at expanding capacity and so on to cater to this demand?
Yes, with the increased adoption of this category happening, we do believe that that would be accretive to the organization. We are market leaders in this category. In fact, we were the pioneers who innovated this category. We continue to be market leaders in this category as well. So we do believe that as this category starts to get its adoption triggers going forward, the growth would be accretive, one. And two, we proactively expanded our production capacities. We are now running at almost 2x of what we were pre-scenario. Today, our capacities have been expanded to 2x, and we've taken a little bit of a leap of faith to say this would continue, and therefore we've sort of expanded our capacities 2x.
That makes sense. Just on the core business then, let's talk about cookers and cooktops along with the Judge brand. On the cooker side, it's a barbell strategy, right? Premium products selling on the cookers and with newer materials selling as well. So you could give us a sense on the growth breakdown in your premium end via price, as well as how much of that is volume offtake, and Judge, which did about 50-60% sales growth, the mass play. How is that likely to grow in FY27? So both on the upper end, volume and price growth, the lower end, volume and price growth.
So we follow a trade strategy of both Judge and Prestige. However, Judge at this point of time is a very small part of a portfolio. It's an exercise that we believe can be of future readiness, and therefore we've been investing in that brand. As we speak today, Judge as a part of the total portfolio is very small. It's not more than 2% to 3%. And to that extent, I think the growth is being led by Prestige and led by the premiumization and innovation quotient of Prestige as a brand. So the Prestige brand continues to be the significant turnaround story that we are now demonstrating, complementing that with a new market opportunity that Judge is helping us address. So that's the way I would place it at this point of time.
Take that point. Thanks a lot, Venkatesh, for joining in and giving us your outlook on the business. Wish you good luck for FY27 and may growth continue into FY28 and beyond as well. With that, we take a short break, come back on the other side. Manisha Gupta, as always, joins in with a focus on the bond markets. And also, after that, we'll be having the management of Park Medi World Management on their latest acquisition. Stay with us.
Welcome back. You have the markets near the high point of the day, 23,987 as we speak. That's up to 70 points on the Nifty. What's helping them, of course, is the banking pack. The Bank Nifty is up almost 2% as we speak. And what's doing relatively better in that pack is the PSU banking names. Pull up a name like Canara Bank, Union Bank, Bank of India, all of these up by more than 3%. UCO Bank, PNB also seeing gains of almost 2.7, 2.8 kind of a percent increase in trade. So the banking pack doing relatively better in trade today. HDFC Bank and ICICI Bank also the top contributors to Nifty gain. But on the downside, you have Hindalco and Max Health that seem to be exerting some more pressure. But for now, let's go across to Manisha Gupta for the latest on the bond markets. Manisha.
Well, thank you for that. Seems like a better day today with the equity markets doing well. The rupee seems to have stabilized, and we're looking at the crude oil prices down between 5 to 6% as well. So we are looking at those markets kind of behaving well. What also has been happening is the swap rates that we saw in the previous week trading at a multi-year highs. There have been various reports suggesting on how the Indian debt fund managers are looking to boost fixed income returns therein. The swap rates, remember, have been gaining since the US-Iran war that began in late Feb therein. The traders also are betting on oil-driven inflation, and that could lead to a surge in the monetary policy tightening therein. 5-year OIS has touched an highest level since 2023, and the markets right now seem to be pricing anywhere between 85 to 125 basis point of rate hikes over the next year. Of course, it's a worrying situation right now with various banks and bond guys talking about this. But there are some private bond issuances as well happening today. You have Cholamandalam looking to raise nearly 50 billion rupees. You also have Muthoot Finance, which is looking to raise 50 billion as well. There also are reports suggesting on how the PNB Housing Finance is expected to announce an issue coming into the markets pretty soon. In the meanwhile, you also are looking at bond markets kind of being pushed. There have been various outreach programs that we have seen come in for the segment, and new policy framework are expected to boost liquidity within the space here. So you have bond index derivatives that the markets are looking a keen eye on. The market-making framework, where you have designated intermediaries tasked with presenting continuous buy and sell quotes. This is being done to improve the historically low liquidity that we have seen within the space, and the secondary corporate debt trading as well is expected to be supported via that. The large corporate framework that SEBI came out with is something that the street is looking at also. There are mandates for the large businesses now, with the outstanding debt above 100 crores, to raise a minimum of nearly 25% of their incremental funding through corporate bonds rather than bank credit. And finally, the corporate yields itself is something that we are looking at surging on the higher side, depending on the credit risk, of course. It's been trading as high as 7 to 14% on the higher side.
Manisha, thank you for those updates there from the bond markets. Continuing with corporate conversations then, Park MediWorld is set to acquire a multi-super specialty hospital, Medicity, in Uttarakhand's Rudrapur. Sanjay Sharma, the group CEO and whole-time director at Park MediWorld, is joining in now on the show. Mr. Sharma, good morning. Thank you for joining in. Firstly, if you could tell us more about this acquisition, sir. How do you plan on funding this, A? And B, if you could tell us more about the target entity as well, the kind of financials that it has, the occupancy levels, the RPOB, and so on.
Good morning to you, and good morning to your viewers also. And thank you so much for inviting us over your channel. I'm happy to announce this is one of our inorganic acquisition in Uttarakhand, Rudrapur city. It's a 330-bedded hospital, which we are acquiring 100% stake at all cash deal 177 crores, and largely it will be through internal accruals. Currently, they are operating 200 beds. The land area is about 7,000 square meters, and the built-up area, covered area, is about 1.64 lakh square foot. So they're operating 200 beds with an occupancy of about 60 to 65%. And the turnover last year was around 55-56 crore, with an EBITDA of 16%, that is 9 crore, and PAT of about 12%, which was 6.75 crore. So we will be commencing the operation by August this year, 2026. And we feel that in the first year, we will be able to clock 100 crores and at an EBITDA of about 20%, 20 crores, and PAT of about 12 crores at 12%. And we'll open up all 330 beds, and we'll keep the occupancy at 60-65% with the 330 bed capacity. And going forward, next year, we feel that we should be able to clock 140 crores with an EBITDA of about 25%, which will be 35 crores, and PAT of about 21 crores, which will be 16%. And the occupancy should rise to 70-75%. Now, this is one of the largest facility in Kumaon region. It is one of the few select NABH accredited hospital out there. It's a multidisciplinary capability and state-of-the-art infrastructure, which we are entering. By this will be our 17th hospital in 6 states. And our strength will go from 3960 to 4290.
Okay, 17th hospital in the 6th state. But, you've been making a bunch of these acquisitions in the last 6 months alone. There have been 3 or 4. Just going ahead, you've already deployed about 500 odd crores in making these acquisitions. Is there more in the pipeline? Will this strategy continue? If you could give us a sense of that. And if that were to be the case, are you looking at any kind of, fundraising in the market to support this acquisition? And also, if you could give us a sense of, going forward in Medicity, how much of the revenue is coming from these high specialty procedures, etc., and how you plan to increase sort of the talent capacity there as well to continue scaling to the levels you were talking about?
See, currently, I believe the doctors which are there are from the Premium Institute serving out there, and we continue to retain the talent out there, because they are one of the best doctors which have come from all over Uttarakhand and other states also, which are working out there. And we continue to hold them and work from that. The RPOB is what we are looking at increasing shade to about 18-20,000. Currently, the RPOB is much lower there. And also the 330 with further top-end equipment and facilities, we'll be going ahead. Currently, the super specialty is contributing about 60-65% of the revenue. And we believe that going forward, we will increase it to about 70-75% revenue coming from the high-end super specialties. Largely, we are funding this through internal accrual. The other question which you mentioned is in our pipeline, we have currently 1,500 beds which we are looking at. 500 would be, besides this, we'll be adding within this financial year only, which will be in Delhi, Fibres 200-bedded hospital, which we are commencing on August or September this year. And then we'll be coming up in Kanpur with 300 bed, which will be November 26. In FY28, we are adding 1,000 beds. 400 are coming from Gorakhpur, which is again in UP. And Ambala, we are expanding another 200 bed, which will be coming in October 27. And Mohali, we are expanding 150 bed, which will be in November 27. And Rohtak will be a greenfield project, which we are starting 250 bed in January 2028. And largely all this will be through internal accrual. But if required, we'll go ahead for debt if required be.
All right, take that point. FY26, anyway, you added about 610, which is highest ever bed addition that you've done in a year. And you have this expansion plan that you've laid out for us, Mr. Sharma. Just a final question from my end then is with regards to the very near future, FY27, if you could give us a sense on an increased bed capacity, what kind of occupancies, what kind of ARPOBs are you looking at? The share of revenue coming in from complex specialized surgeries, and any sort of payer mix changes that you can give us, because all of that would then lead to a margin profile plan as well for you. So ARPOB, realizations, the entire gist, if you could give us a sense.
Mangalabji, as I mentioned to you that with this acquisition of 330 beds, we'll be reaching a figure of 4,290 beds. With addition of 1,500 beds over FY26, 27 and 28, the total bed capacity will go to 5,790 beds. And we feel that this year, last financial year, we clocked one of our best results of 1679 crore with an EBITDA of 440 crore and PAT of 274 crores, which have been a jump of 21%, 20% and 27% respectively. And we feel going ahead in FY27, the total revenue should be to the tune of about 2080 crores. And in FY28, we are looking at about 2,550 odd crores of total revenue.
All right, Mr. Sanjay Sharma, thanks very much for laying that out for us. And we wish you the best with those endeavors and hope to have you back again when there are more updates. On that note, we'll slip into a short break. But when we return, we're going to discuss market technicals with Somil Mehta of Mirae Asset Sharekhan and also discuss his stock trading ideas.
Welcome back. Continuing to do well. The market's holding on to gains of around 250 points, still hovering around that 24,000 level is the index. A lot of these broader market names continuing to do well. MV Photovoltaic is now up 7%. Now it's featuring among the top gainers on the Nifty 500 today. Phenolics Cables has moved to the day's high, 6% higher on that stock as well. And Urban Company has made its way to the list of gainers, 4.5% higher on this stock as well. Somil Mehta, the head of retail research at Mirae Asset Sharekhan, is now joining in for a quick chart check. Somil, good morning. Thank you for joining in. Now that we are at the cusp of 24,000, do you believe that the index crosses this mark before expiry tomorrow? And if so, what are the higher targets that you are envisaging for the index and your trading calls as well for the morning?
Good morning to everyone. See, we had a range between 23,800 and 23,200, 250 levels. Now that range has broken on the upside with a small gap, and we are at the moment Nifty is trading above 20 and 40 daily moving average, which is a very good sign for the markets. The range has broken on the upside. However, overall, in the medium term outlook, I still believe that we are in a very broad range. The higher end would be around 24,500 and 24,600, which is very close to 200 daily exponential moving average. And on the lower side still remains same 23,200, 23,250, which is the previous swing low. And I'm not expecting this low to break on the downside for some time. Now, the lows which we have seen last week, which was around 23,500, 23,400 levels, again, that becomes a trailing stop loss from here. My view would be positive in the very short term, and I'll be expecting this upper end of the range to be retested, which is around 24,500, 24,600 levels. So positive. However, we should be focusing more on sector-specific rotations and stock-specific action. PSU banking has just started moving up, and also the smaller private sector banks have also started moving up. There are a few, spaces where things are going good in oil and gas sector. So I'll be bullish on those stocks as well, specifically BPCL, HPCL. So I have two stocks. One would be Union Bank. Union Bank, I think, has started a new move on the upside, taking support at 200 daily exponential moving average. And I'll be expecting this move to continue. The target for Union Bank would be 173, and my stop loss would be 161. The second stock I've chosen is the large cap, L&T. L&T is looking great as well. It was been consolidating in the last couple of weeks, and now that consolidation has broken on the upside, taking support at 200 daily exponential moving average, trading about 20-40 daily moving average. Great setup here. Stop loss would be 3,920 and targets would be around 4,200.
All right, Somil, thanks a lot for that. The market's broken up on the upside. We will monitor how it goes. We take a short break, come back on the other side. Market fundamentals with Christy Mathai from Quantum AMC.
Welcome back. Up 250 points on the frontline index. 23,970 is where we're at. Markets looking good. Let's invite Christy Mathai, Fund Manager Equity at Quantum AMC, to discuss market fundamentals and his top sectoral picks. Christy, welcome to the show. Thanks for your time here. Let me just start with the broader backdrop. I mean, we've seen this, what's been happening with oil prices finally below $100 a barrel. The rupee has made a bit of a recovery, but, the fact remains we don't really know when that peace actually happens in the Strait of Hormuz and things return to normal. With the fuel price hikes that have happened, there's been some chatter about concerns on inflation and perhaps that rate hike coming sooner than later. What would that mean from an earnings point of view? Would that mean some pain, some downgrades ahead? And if so, what are the sectors you think there would be safe havens that investors should look at?
Right. Thanks for having me. So as we look at the current juncture, we have seen some developments over the weekend, which sort of brought that crude below that 100 mark, as you said. But clearly, when we think for let's say about a year's view, if you were to just take, things are still sort of uncertain. And our sense is that the elevated input price, which includes a variety of not only crude, but broader materials, all of them possibly could be higher for the year. So that is the working assumption that, we are thinking about. And in that juncture, when we currently look at the earnings print for Nifty50, there is marginal change that we have seen as, the 4Q has sort of ended. And we think there are downsides to these earnings print as you grow ahead. So there is the expectation reset that it would be just about a first half phenomena to possibly longer. And in that light, we would have to recalibrate the earnings assumptions for a few sectors. So some of the most impacted sector, in our view, could be consumer discretionary, which broadly had a fairly good run in the recent past. But then slowly the demand may feel a pinch, even as the input cost sort of increases, and you would have to pass on this impact. So there is not many sectors which are really shielded. Possibly one could think about telecom, where there is a ARPU hike story sort of that is playing out, but that too with a lag. You might have some benefit in IT services, which is not so directly impacted, which would possibly benefit from falling rupee, but the demand sort of looks uncertain. And maybe even the banking side, you might have some sort of impact on credit growth, but banks are well placed, at least on the asset side, with adequate provisions. So that's what we think could happen as you go ahead.
In that light, Christy, firstly, thank you for joining in. Where is it that you are putting money to work, especially considering the fact that you believe that the time horizon over the next 1 year, the outlook or the situation is still fairly uncertain despite the optimism that we are seeing currently?
Right. We continue to add to positions where we think we are thinking sort of slightly longer, because this external shock would sort of normalize at some point in time. There would be a rolling forward impact on, let's say, FY28, 29 earnings, given where we are. But some of the places that we have added is, say, life insurance, where there have been some struggle with respect to the regulatory changes. There is these GST reduction, which has caused a headwind in terms of input cost, that some of these companies would have to pass on. So the growth has sort of suffered. And also there is some distribution channel changes that we have had. So we think a lot of them is in the price, given where the valuations are. So if you were to take a longer term, we have sort of added into some of these life insurance plays more recently. We've also added some bit to the real estate play, where we still think that the real estate cycle will continue to be strong. Now we have seen a blip in the recent past. But as things normalizes, there should be a pocket of opportunity here. And of course, our mainstay remains the private banks, which in our view should see now material differentiation with respect to the PSU pack also. And the earnings could be much better going ahead.
Christy, what about the data center play that you've spoken about in your note as well? How would you play that here in the Indian markets, and also on the power space, if that's something you're looking at for opportunities?
Right. So these are some of the new themes that have sort of evolved over the past 2-3 years. But unfortunately, when we really look at, the fundamentals of these companies in terms of valuations, they do not sort of fit our sort of framework, which is more value in nature. But these are, themes which could last multiple years. And we have seen especially the power sector, which sort of drives the whole cap goods in our view. The acceleration that we see, even in the government pipeline, be it, the thermal or on the, renewable side, that continues. And, traditionally, we have liked the power, the T&D companies as well as the power producers. But given where the valuations are at the juncture, we have sort of exited out of them some time back. So at present, it could be there is no direct play in our view in these pockets, primarily for the valuations.
All right, Christy, a pleasure having you today. Thank you so much for sparing time and joining us. Looking forward to having you more often on the show. Yes, the markets are doing well. Yes, we are still up 250 points, but the 24,000 level still continues to remain elusive. Is that turning out to be a barrier? Mangalam has hopped over to the FNO desk to tell us just that. Mangalam.
Well, 24,000 may not be a barrier, but it's definitely a fulcrum for the market right now as we speak. The indices are higher. The Nifty is higher by almost 250 points, led higher by both the Nifty Bank as well as the IT index, which is higher by 0.8% as well. Now, one would wonder, what is it that, the market will take going forward? If you look at the broader markets as well, both the mid and the small cap indices doing extremely well. All of that, coupled with the fact that the India VIX is lower, makes bulls feel fairly good ahead of expiry tomorrow. The Nifty, after today's move, has crossed both the 20 and the 50-day moving average, marks which were earlier proving to be a bit of resistances in the past for the frontline index. And that's actually because of the Nifty Bank's inability to do so. With a 1,000-point uptick, the Nifty Bank too is fairly above an important congestion zone of 54,500 to 54,600, which housed both the 20 as well as the 50-day moving averages. We need to watch out for the IT index. While it is up by 0.8% in today's trading session, will the strength in the rupee weaken this segment or not? Because while we're above 29,100 on the IT index, 500 points from here, we have the 50-day moving average, which is resistance for the IT index. And a couple of, 15, 20 rupees above Reliance as well are both the 100 and the 200-day moving averages for that index. May series expiry tomorrow, 24,000, like I said, is the fulcrum. That's why we've seen action at both the 24,000 put and the 24,000 call. The 24,000 put comes up for you, premium of 100 rupees. The 24,000 call comes up for you, a premium of 86 odd rupees. Add both of that together, you're playing for a premium of 200 rupees. Telling you that the market's position for 23,800 to 24,200, which is a notable shift in the range upwards from 23,200 to 23,800. The range on the Nifty has moved higher to 23,800 at the lower level to 24,200, 24,250 at the upper level as well. That is further confirmed by the 23,900 put writing that we've seen for about 63 rupees in premium, which tells you that 23,800 to 23,850 is now the next support zone for the frontline index. Also houses the 20-day moving average. So those are important levels on the way down to watch out for. Is there room for upside? From a put-call ratio standpoint, definitely. 1.13 versus 1.06. Typically, the put-call ratio tops out between 1.2 to 1.25, if extends a little to about 1.3. So we do have room for upside. The bulls must feel a lot better on this Monday morning than others.
Mangalam, thank you for summarizing that for us from the FNO desk. We're at 23,990 now, still heading towards that 24,000 mark on the index. Take a short break. Back with more on the other side. Stay tuned.
Welcome back. Well, the rupee, let's focus on that. That opened today at a two-week high of 95.34 against the dollar versus Friday's close of 95.69, but has since strengthened even further. It is now trading at about 95.19 against the greenback. Now, a couple of reasons for this relief rally that we're seeing on the rupee. Of course, the oil prices, that's the big one, coming below $100 a barrel for the first time this month on the back of news, of course, over the weekend of a potential easing of tensions between US and Iran. Brent crude prices now at $98 to a barrel. That's more than 5.5%, almost 5.3% as we speak. What's also helping sentiments is the RBI governor's comments that have come in an interview to Mint, saying that the central bank will do whatever is required to ensure that there is orderly price discovery in the forex market. He also made it clear that the RBI is not defending any specific level, but it will step in to curb any excess volatility and speculative moves in the forex market, adding that India has enough firepower with nearly $700 billion in the forex reserves. Sanjay Malhotra even suggested that the recent rupee depreciation may actually mean that the currency is now undervalued both in nominal and real effective exchange rate terms, and that it could appreciate from here on once tensions in West Asia begin to ease. Now, on the balance of payments front, the governor acknowledges that there is pressure from higher crude prices, but he also said services, exports and remittances, they still remain resilient, and that keeps the overall BOP situation manageable, in his words. He also pointed out to improving capital flows. He expects repatriation-related outflows to also moderate as equity valuations correct. So let's bring in Jayesh Mehta, Vice Chairman and CEO of DSP Finance, for more on the outlook for the rupee, which has now seen, fair bit of recovery from the kind of levels that we saw on Friday. Jayesh, thanks very much for your time here. To begin with, your view on whether the markets actually believe the rupee is undervalued now, and what your takeaway from the RBI governor's comments were, that they'll do whatever is required, essentially, I believe telling the speculators, don't bet against the rupee.
So I think this comment was very much required. Maybe we will need more of reinforcing of that comment, which followed by the action. So you see, last week we saw 1 rupee move in 5 days and stuff like that. I think that kind of situation definitely it will kind of curtail. Also, it was reinforcement that they have enough tools if they want to, when they want to intervene. And I think from these 2 points of view, it's a pretty good, at least that kind of communication is required, but there is more communication required. That's the point. Of course, today is because of the US West Asia war, as well as the crude being down. And right now, the market is into more trading zone, that dollar rupee is more into trading zone. If you really look at it microly, it's actually kind of following tick by tick what is crude doing, right? So to that extent, in last 10, 15 days is actually following the crude trajectory. But having said all of that, maybe if the West Asia war gets over, we see that crude getting priced back to maybe 80, 85 or something, it will be a good relief for currency. But at the same time, we have our capital flows, which is a continuous outflow that were continued even before the war, and that's something will start tripping in once we get over the West Asia war.
But, Jayesh, do you read a bit of a hawkish sort of, bent in the comments that are coming in from the governor? And what does that mean, combined with the fact that we've now seen fuel price hikes, over the course of the last few weeks, a couple of times or more, the worries about pass-through and inflation, are you pricing in a rate hike sooner than perhaps the end of the year or so that the earlier consensus seems to have been, as early as June? Is that a possibility at all?
So I think that there was a fear, there was a thing, and there are people who say RBI should do rate hike for currency, and for India, rate hike for currency really does not work because we don't really have debt flows from foreigners. What we have is equity flows from foreigners, and therefore we did the same mistake raising rate into 2013. If you really raise rate, does not help the equity market, and therefore right now our problem is capital outflow from equity market. If that goes more, that actually creates problem. Now coming to inflation versus rate hike for inflation, definitely because of the crude price and this quarter itself also, there'll be a pass-through impact on the inflation. Now, of course, RBI will have to gauge where that inflation impact is. If you think before the policy, we may see some great positive news on the war side. Then if they are still below 6%, I wouldn't think they need to raise the rate or anything at this juncture. Of course, there are all economists and traders have been pushing them that they should raise rate for inflation, but I would still say even in COVID, when we crossed almost 6%, that time we more supported growth. And when we have supply side impact, supply side inflation, and if it is temporary, maybe we should support growth. So that, of course, will depend on the MPC policy, what they do it. But yeah, 0.25 or 50 basis point here, there does not really matter.
But, the simpler question, Jayesh, is part of this relief rally that we've seen in the rupee, is some of it coming because the markets are reading these comments as hawkish? And if we don't see a rate hike, does that stability go away to an extent? And also, this increasingly interventionist strategy of the RBI at a time when, the rupee has been in a slide. We've heard from the likes of Arvind Panagaria, D. Subbarao publicly talking about, the futility of this kind of a policy. What did you make of the comments?
So I would say right now RBI is just targeting is the usual statement that we are targeting the volatility over excessive volatility. Naturally, they are not targeting a level. So that's the statement. But the underlying is I don't think, and I would genuinely request. I don't think it's a great idea. It's when people, economists and others, start talking about it like depreciating rupee is good. It's not good for the country, right? We are a current account deficit country. How can depreciating a rupee be good for us? So I think main mind frame we have to have towards appreciating rupee. That's the main mind frame the government and RBI should be convinced about. And I think at some point of time. But right now, I think our worry is crude. And once the crude settles down, the next worry, we are still not out of the woods because we still don't have control on the FDI outflow and FDI selling and IPOs. So I think these two outflows is really, really hurting. I would say actually, if you really look at it, this is actually hurting more. And then, oil crude price just became aggravated the things. Otherwise, if you look at, we were 120 and 14, 15. We didn't go through this kind of pain because equity outflow was not the way it is currently. I think the crude impact and equity outflow impact is more or less the same. And I think unless we stop that, we are in for problem.
Well, it's a difficult one to answer, Jayesh, but can't not help but ask. 96 is the level that we saw on the currency. Fair to assume or stick your neck out and say that with all the comments that have come in from the RBI, the remarks made by the governor, the steps taken by the central bank so far, and with more potentially in the offing, are we done with that kind of depreciation for the year, and we see that that level of 96 no longer gets tested, even though if we still remain above 90 for the rest of the year?
So I think if the crude does not grow from here, I think we have more or less seen the low for rupee for the time being. But as I said, once the war settles down, we need to really look at it. I think, I've been making point this, but of course, equity is not my market, but I've been making points, one needs to really look at it. If the equity outflow is the sell outflow or is the trading profit which is going out. So I think, and if it is trading profit which is going out, it's not going to stop, right? So it's not completely like we don't have AI and we are overvalued and all that. I think there is something more to that. Till we fix that, till we plug that, the daily 2,500 crores plus minus 500 crores outflow is a problem.
Just a final question before we let you go, Jayesh. This is on the overall growth outlook, the impact that this crisis has had on growth for this entire year, and what is it that can be done about it? Because you can't cut rates largely because of the rupee and inflation, but at the same time, higher inflation could have an impact on overall growth. Jayesh, would you? Okay, I think we've snapped that connection with Jayesh. So there's a question for another time that we'll ask him when he comes back. But no problems for the market right now. A 270-point uptick is what we continue to hold on to the frontline index. Nearly 3 stocks advancing for every stock which is declining. As we speak, Titan has suddenly moved higher. A lot of the Tata Group companies, actually, Titan has moved to the high point of trade. We're seeing some traction in Tata Consumer as well. And Trent, that's the one that should come up for you as well. So Titan has moved higher. Tata Consumer is the other one which has moved higher. And pull up Trent. The intraday chart of Trent comes up for you. You'll see a bit of a spike on that counter as well. But alongside all of this, when the market mood is a lot better, we see these platform companies bounce as well. You did speak about Urban Company doing about 5% in terms of gains. Look at Eternal. That stock's spiked, and how? Up around 3%, giving company to other Nifty top Nifty gainers, among the top gainers on Eternal right now. And finally, the Nifty Bank, 1,000 points. We have Kotak Mahindra Bank, which is leading the pack out there with a 2.6% gain. Most of them in just the last 15 minutes or so. Kotak Mahindra too has spiked up. But with that, I think we've run out of time on this edition of Trading Hour. You stay tuned to CNBC TV 18 as halftime report comes up next. From Ritu, me, Hormaz, thank you so much for watching.
Stocks rally after Trump points to a likely US-Iran deal, though not in a rush. Financials, autos and oil and gas marketeers are leading the charge, while we have metals and healthcare, which are lagging.
Aisha Motors rides healthy volume growth and a price hike to deliver better than expected sales and profit for Q4, even as margins come in line. Near-term capex and resolution of labor issues bode well for the future.
Oil and gas marketeers cheer as Brent falls below $99 per barrel on a likely US-Iran deal. Two quick revisions in fuel prices also help trim losses for OMCs. Rupees 35.50 per litre on diesel and 10.5 rupees on petrol.
A sharp fall in oil prices and a softer dollar buoy the rupee. RBI Governor Sanjay Malhotra, in an interview to Mint, says the rupee may be undervalued in nominal terms and could gain once the West Asia crisis normalizes.
And US State Secretary Marco Rubio meets Prime Minister Narendra Modi with energy high on agenda. Says US was keen to sell India as much energy as they will buy. He also adds Iran is still a work in progress.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motibala. Well, it is turning out to be a session where we are seeing good gains come through on the markets. So if you put it into perspective, in fact, the Nifty is up around 3% from the lows that we've hit on the 13th of May, which was a low of around 23,262. We have the broader markets which are outperforming in today's trading session. So that too is a source of a source of at least some kind of confidence coming through. Bank Nifty up around 1.8%. Just want to point out that the rupee has been the other source of confidence which has come through. So the rupee hit 96.96 on Wednesday, 20th of May, which was the record low for the rupee. And since then, the rupee has appreciated almost close to 2% from those levels. At this point in time, the rupee levels should come up for you as well. So a good trajectory is what we are seeing for the rupee, currently at around 95.22. Hi, Vinny.
Hi, Ekta. Good afternoon. So obviously, rupee, crude falling, all of that is supporting our markets. Green coming in across the screen. And like you mentioned, banks doing well, and specifically PSU banks, that's trending. So most of the sectors today are trading in the green. But we have a very exciting lineup for you all on the show as well. And we'll be first up focusing on the buzzing stocks and big movers in the trading session. Then we'll also put the spotlight on Q4 earnings with the management of Rainbow Children's Medicare as well as Sarda Energy and Minerals and Sun Pharma to talk about the outlook of these companies going forward. And in our commodity segment today, we have Rajiv Chakrabarti of Soluble Fertilizers Industry Association. So Manisha will take that conversation forward as well. But first up, let's go across to Vivek to take us through all the stocks that are moving around in the trading session. Afternoon, Vivek. We've opened up on that positive note for the markets. Which are the stocks today that you're putting the spotlight on?
Well, thank you so much. Another session where we're seeing very good advance decline ratio. Market breadth is very much in favor of the advances. And in terms of individual names, Aisha Motors is one particular name that stands out despite the fact that the company has called out commodity costs as a challenge. The robust volume outlook is something that the street is cheering. In terms of Spark or Sun Pharma Advance, that particular stock, one of the top gainers on the NSE 500. A strong up move continues post the Q4 results. Priority review voucher sale is something that aided that particular quarter. All of the OMCs, HPCL, BPCL as well as ISCL, OMCs rally. Price hikes cumulatively have been quite significant, and the losses that these companies have been taking will now go down. So the street likes that as well. Glenmark Pharma, that particular name, one of the top gainers as far as the F&O side is concerned. Remember, on Friday it fell almost 6%, but today up by 4%, and overhang goes away in terms of multiple class action lawsuits that the company was facing.
All right. Vivek, thanks very much for that. But we really need to cut across to the finance minister speaking at the 37th Foundation Day celebration of SIDBI. Let's cut across.
Has been very calibrated. And it is calibrated to absorb the shock where citizens and businesses are exposed, support MSMEs and exporters where working capital is under stress, and preserve the underlying growth momentum. During the budget session itself, and that is on 1st February itself, government provided over 1 lakh crore for the Economic Stabilization Fund. That was much before the Strait of Hormuz problem came. Just to make sure that we are not caught by some unforeseen events. We had made the provision in the budget, and this was an emergency cushion created before the full impact of the West Asia situation, and so that India could respond quickly to global shocks, supply chain disruptions, and also sudden stress in any sector. For MSME exporters, credit guarantee support has been provided through the Credit Guarantee Scheme for exporters, and collateral support under the Export Promotion Mission is also being provided. This helps small exporters get formal credit even when they do not have enough collateral. It protects export orders, jobs, and foreign exchange earnings. When Indian export cargo, this is very important, when Indian export cargo was affected by disruption in West Asia shipping routes, customs procedures were simplified. Why did they have to be simplified? Exporters were allowed to bring back the cargo, reroute them, or store them, and transship stranded cargo were also that way supported with fewer formalities. All formalities were brought down to the bare minimum. Rerouting, bringing back are all normally very, very painful exercises in terms of the rigors that they have to follow. Fees for amendment or cancellation of export documents were also waived in force majeure cases. This ensured that exporters were not punished for disruptions which were beyond their control. For micro enterprises, a special micro credit card provision has been introduced under the CGT MSC. That's what you saw today being distributed to the beneficiaries. I would have wanted it to be done even earlier because more than 12 months have passed, but never mind, we are seeing the light at the end of the tunnel. Udyam registered micro enterprises can access revolving credit up to 5 lakhs backed by 75% guarantee coverage and without mandatory primary security. So the government has, since the day of Mudra, guided by Prime Minister's absolute commitment to ensure that the smallest of small businesses, which have no collateral strength, will be supported and will continue to be supported. So we didn't just do it for Mudra. We didn't just do it for that Swanidhi scheme. We didn't just do it for Vishwakarma. We are continuing to do it even now for the microcredit which is being given.
Okay, so that's the finance minister talking about a whole host of statements with regards to the West Asia crisis, what kind of steps they've taken. For example, the Indian export cargo, we saw custom procedures which were simplified, but they have pointed out that high gold and crude are creating challenges, along with the fact that it is putting pressure on working capital at this point in time. But private sector investments, for example, are picking up. That's what the finance minister is saying. But let's talk about Rainbow Children's Medicare. It is the first management on the show. The company reported revenue growth of around 24% on a year-on-year basis, and occupancy was a little subdued. To talk more about the results, we have with us Mr. Ramesh Kancharla, who's the founding chairman of the company. Dr. Kancharla, thank you very much for taking the time out and speaking with us. Well, if you could just start by talking about the occupancy this quarter, it's coming at around 45%. Just give us a sense, was there any kind of seasonality which came through? Because there's a little bit of a dip which came through this time.
I think the occupancy is actually the trajectory of this year has been fairly low. The 45% of occupancy we have to see with the background of the number of beds we have added. So we have added almost 500 beds in the current year. So because of that, you see the new hospitals coming up, commencing, your occupancy was reset to 45%. When you look at the growth side, we have kind of managed to grow very well on the revenue side and the EBITDA side.
Okay. So going forward, can you give us guidance on both the occupancy, because you have these 500 beds which have come through, along with the average revenue per occupied bed, which in fact was up around 8% year-on-year and 7% Q-on-Q. So what is FY27 looking like on both these parameters?
I think we are expected to do our occupancies about, on matured cluster will be about 60%, blended occupancy somewhere around 56%. So when we do that kind of occupancies, we will deliver every single number, both in terms of top line, CBTAs, or RPOPs, everything. In terms of RPOP, I think we have been growing around, we have come to about 60,000 now, the RPOP. I would expect that RPOPs to grow kind of at 6% basis as we move forward. That dominantly decides, based on the case mix which we see. I think as we move on, actually we are trying to come out of a kind of seasonal dependency, more on strengthening our clinical offerings, and also the obstetrics getting more and more stronger, and also fertility is getting stronger. And we do see a kind of a trajectory to improve the RPOPs as well as the overall profitability.
Sure. So RPOPs and profitability, you're talking about improving that. What is the RPOP expectation that we could have? Any number that you have, internal target there for FY27?
Rather than talking about RPOPs, we blend always with the ARPP, because when you have a lot of seasonal business, your RPOPs will go down. You may do a lot of revenue on EBITDA, but RPOPs go down. I think when we look at RPOP along with the ARPP, which we guide around about 5-6%, that's how we look at it. So with that kind of a combination of looking at ARPP and RPOPs on the top lines and the base underlying seasons, we can see about 5-6%.
Okay. So there's a lot of M&A, it seems, which is taking place in the entire fertility space. We saw Apollo combine their fertility and mother care business with Cloud9. That took place just a couple of weeks ago, along with HCG as well, which is now selling its Milan fertility brand and looking at its oncology business more. How would you react to these two incidents or steps being taken place in the fertility business? And what is your sense in terms of the growth trajectory for that? Do you think that there's too much competition now entering the space?
No, actually, as you know, that we are dominantly a children's healthcare player. Also, we do a significant maternal care as well. Almost we do about 20,000 deliveries in the maternal care. Our business is about 30% in maternity care. We have started the fertility services about a couple of years ago. The growth has been very good. Our play of fertility is dominantly a kind of our own in-house under brand reputation driving the growth, plus B2C, being a Rainbow, being a popular hospital, as well as a strong obstetric background. So expect our fertility grow very organically, both B2C and also within the hospitals, through the doctor's referrals. So B2B unlikely to come because we are a major obstetric player. In terms of acquisitions, of course, we would be open to look at acquisitions. May not be particularly in the IVF states. If something is very aligned to our philosophy, we will definitely be open about it.
Okay. Just want to ask you a little more about maybe the complex work that you're doing, because since your RPOP is up or your average revenue per occupied bed has risen 7% and 8%, how much of that is also being contributed by maybe complex work that you're doing when it comes to surgeries, outpatient, inpatient?
Okay. So when you look at the pediatric space, and your complex work comes from the ICUs, and your complex works come from the pediatric super specialty, and also things like, the bone marrow transplants, organ transplants, things. as the mix going up of the specialty care, intensive care services, and the super specialty care, your ARPA will go up. Plus, combining with obstetrics.
So, I also want to understand in terms of your ramp-ups, new hospital ramp-ups, timeline over there, as well as I believe Coimbatore now is pushed to second half of FY28. It was expected to be at the end of FY27. Any specific reason for that delay as well?
So we had to go for the re-permissions to kind of have a little larger space. And I think that took a long time because Coimbatore being a little away from Chennai, it did take time to get permissions. So now it is a big space. I think we are very clear that it will be in H2 after 28.
Okay. Can you provide some specific guidance in terms of FY27? Say, for example, you closed FY26 with a 12.5% revenue growth, margins of 32%. Considering that you do have CapEx coming on board, what would your guidance be both on revenue as well as margins?
I think, now we have completed most of our kind of bed additions in the last 2 years' time, almost about 700 plus beds we have added. So now purely this year goes on for execution, service excellence, and also the doctor engagement. Obviously, we are looking for a big growth this year. I would expect that 20% growth is very, very achievable. And the margins have always been, we guide about, close to 25% margins. With so much of bed additions, still we will continue to maintain the margins around 25%.
Okay, Mr. Kanchala, thank you so much for joining us this afternoon, giving us the outlook in terms of the company going forward as well, expecting occupancy at 60%, blended occupancy at 56% as well, though as of now, the stock is a bit muted in the trading session, down 1.7%. But thank you, sir, for joining in. On that note, we're going to step into a very short break. After the break, we'll have Nilay Joshi of Sarda Energy and Minerals, who will join us to discuss their Q4 FY26 numbers, as well as the outlook of the company. Welcome back to Afternoon Report in CNBC TV 18. While the Nifty continues to hold on to that bright green in today's trading session, 23,960 levels around the day's highest point is what is continuing to trade at. But let's bring on board the second management for today. We have Nilay Joshi, Executive Director and Head of Group Corporate Finance at Sarda Energy and Minerals, to talk to us about their Q4 FY26 earnings as well as the outlook of the company going forward. Nilay, good afternoon. Thank you so much for joining us on the show. While obviously Q3, Q4 saw that impact coming in of some of the shutdowns that you all had in terms of planned maintenance, what is the outlook now in terms for Q1 FY27? Has that normalized now, or could that come into Q1 FY27 as well?
Yeah, so good afternoon and thank you for having me over. The power plant shutdown got over in mid of early Jan, so that both the turbines are functioning normal now. That was a planned shutdown, and the 30 megawatt captive unit, that will become operational from June, but for the full year it will not impact the production. So as of now, the power plant is functioning normal, and the other 30 megawatt will come on board by June.
Okay, so it will come on board by June. So you're not expecting, then maybe some bit of an impact will come in, right, in Q1?
For the full year, for the steel, we don't expect any impact for the full year.
Okay, what about EBITDA, right? Q1 FY27, is it going to be the best in terms of EBITDA? Will you reach 600 crores again?
While I'll not give a number, but see, the nature of the business is that normally Q1, because of the energy demand, Q1 is a strong quarter. And we expect it to remain a strong quarter.
So expected means last time you did 600, so we can expect around that level, right?
Again, I mean, we don't give quarterly guidance, but yes, Q1 is a strong quarter because realizations are stronger in power.
Just talking about that, how much of your power is in fact sold on a merchant basis? And can you just give us a sense in terms of how exactly rates might have changed?
So, see, as of now, we have the total power IPP capacity is 600 megawatt. We have medium and long-term PPAs to the tune of 300 megawatt, around 5.5 in term per unit. As on date, we are supplying power out of the 300 megawatt PPAs. We are supplying power for 200 megawatt. The balance 100 megawatt, we have entered the PPA, but the power supply will start from 1st April 2027. So compared to last year, where we had only 100 megawatt under PPA, as of now, we have 200 megawatt under PPA, and balance we are selling either on short-term PPAs or on the exchange. And exchange realizations are, of course, the strongest in Q1.
Okay, just circling back to FY27, we spoke about the EBITDA. But just tell us about the balance sheet. What are you estimating or guiding for in FY27? For example, is the company going to generate enough cash to be debt-free?
So on a standalone basis, we are already debt-free. Even on a console basis, if you must have seen that we have very, very strong liquidity, almost 2,400 crores of liquidity on the balance sheet. And effectively, we are about net debt free only. The net debt has gone down by 85% at the console level also, from 1,500 levels to hardly 200 crores as on March. And by June, hopefully, it will be a debt-free operation. Yeah.
Okay, you'll be debt-free operations by June. Okay, but you have plans
to... console level, standalone, we are already March, we are...
Yes, that you all are already there. But, I just want to understand, Nilay, that because you are talking about EBITDA doubling as well, would that indicate anything in terms of increase coming in later on, or how will that be in terms of...
Coming in EBITDA? What? I didn't get the question.
You all are talking about EBITDA doubling, right? You all have spoken about that. So what does that indicate in terms of peak debt going forward? FY27 Q1 you may go in, but any concerns that come in going forward?
No, so see, most of the capex that is happening as on date, like the mining capex and all that we have guided, that is all happening out of internal accruals. The only capex where we see the debt coming on the balance sheet is the doubling of the SKS power plant. So that, but at the same time, we have very, very strong internal accruals. So I don't see any deterioration, so to say, in the capital structure.
Okay.
While debt will, at a gross level, will definitely come on board, but then cash generation is also happening.
Okay.
And for the mining projects, we are not taking any debt.
On this SKS expansion, which you just mentioned, of doubling it from 600 megawatts to 1200, is there any issues with regards to turbines?
No, so as you see, you must have seen the domestic. There are two power suppliers, right? L&T and BHEL, power equipment suppliers. So there they have sort of the order books are tight. So we are trying to see what best is possible.
Okay.
Yeah.
So no issues on that front, right? And you can look at doubling it as well in terms of your capacity there. You've spoken about it. In 5 years, you're looking to double. So that's on track.
Yes. So by the guidance that we have given for FY30, so we are looking to double things by that time. That is the aspiration. And if you see, this is a brownfield expansion. So we have large part of the balance of plant and land, etc. Everything is in place. And so the land, the coal infrastructure, the railway infrastructure, water, evacuation, grid connectivity, all that is there already, right? So compared to a greenfield, that is why we expect shorter timeline.
Okay, I'm expecting shorter.
Right now we have applied for EC as we speak. DPR is going on. We have applied for EC, and we are hopeful of positive outcome.
Okay. Just one quick one. Pellet expansions also, you've said your approximate investment of around 500 crores that you're looking to make there. Could you talk to us about the revenue expected here as well as EBITDA contribution going forward?
So it will be hopefully in the line of what we are doing. We already have about a million, 9 lakh tons capacity annually. And basically we are doubling it. We are going to 2 million. So you can simply double all the numbers on the pellet side.
Okay. All right, Nilay, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Sarda Energy. That stock is down around 3.5% in a market which is quite strong today. So we have the mid-cap index, which is still holding with a gain of around 1% and the Bank Nifty, which has been outperforming from the get-go, is up around 1.7% at this point. The advanced decline ratio holding steadily at that ratio of around 2:1. 2 stocks advancing for every 1 stock which is declining. We'll take a short break, but up next in our commodity segment, we have Rajiv Chakrabarti of Soluble Fertilizer Industry Association. Stay tuned for that conversation. Welcome back. Well, for the markets, it's holding up quite steadily at this point. Just want to point out that a couple of the indices which are doing well in today's trading session, besides the Bank Nifty as a whole, which is up around 1.7%, is the Nifty Auto Index, which is up around 1.5%. So there is some amount of traction in a couple of these rate sensitives. The Oil and Gas Index is up around 1.4% at this point in time. And even the PSU banks. So we've been talking about the frontline banks, but the entire PSU bank index, in fact, is outperforming at this point with a gain of around 2%. So great going for a couple of these indices in today's trading session. Lot of traction which is being seen. The Nifty Auto Index is obviously supported by stocks such as Eicher Motors. So that stock is your top gain on the Nifty. It's up around 5%. We also have a couple of others which are managing to hold up quite well. So M&M is holding with a gain of around 2%. In terms of other stocks within the entire financial space, we have HDFC Bank, which is up around 2.2% at this point in time. So doing well. Adani Enterprises, which is now up around 16% for the month, is putting on some more weight. So up around 3% currently for Adani Enterprises. We'll do one thing. We'll take a quick short break and we'll get you that promised chat on our commodity segment once we're back. Stay tuned.
Welcome back. Joining us now is Rajiv Chakrabarti of Soluble Fertilizer Industry Association. Rajiv, thank you so much for joining in. the import dependence that India has of various fertilizers doesn't even start or begin with DAP or ammonia. It continues on to the soluble fertilizer as well. First of all, your sense on the kind of imports India does of soluble fertilizers and the price rise that we've seen in various other components, has that rubbed off to this one as well?
Yes, India imports 100% of its soluble fertilizer from other countries. 80% of it comes from China. And we have two major issues that is affecting the soluble fertilizer industry as a whole for a very long time. Initially, it was China's borne supplies of water-soluble fertilizer. And now it is war, the Middle East war, that is stopping WSF from coming to India. This has caused a very, very big price hike, almost 50% hike in all the products. And we are now more dependent. As the season has now started, so we can see the effect only at the importer level. But as soon as the consumption starts and the cropping season proceeds, there will be a big impact on the soluble fertilizer.
Rajiv, is it about the affordability, or do you think availability is also a concern?
Availability is definitely short, and affordability is dependent on the availability. If there is a 50 to 80% hike in the prices, of course farmers won't be able to afford it. But there is a good thing about this. This price unaffordability, because farmers are now looking for other alternatives. So many alternatives are now growing. That is one thing that we are seeing, that people are farmers, the end users are shifting and trying to shift from the traditional conventional fertilizer, urea, DAP, to the specialty fertilizer or the nearest combination of the popular fertilizer.
Rajiv, also, what is the overall market share when you look at soluble fertilizers in India, and how big is this market? How is it growing?
Market share with soluble fertilizer look a bit small as compared to the kind of volume the soil application fertilizers or you must say subsidized fertilizers are used. But the conversion ratio, we look into the conversion ratio, means how many kgs of specialty fertilizer replaces how many kgs of subsidized fertilizer. As the conversion ratio is almost 1:50, so the volume, actually the impact of this volume is very big. As on today, last year we imported almost 400,000 tons, that is 4 lakh tons of water-soluble fertilizer. We don't only consider water-soluble fertilizer, but we consider the entire SOMS range of fertilizer, that is soluble fertilizer, organic fertilizer, micronutrients, and the stimulants. So all these together are actually replacing the subsidized fertilizer, and the replacement ratio is somewhere between 30 to 70%. So the impact is very big, and this would definitely, the market is really big, and the adoption is also very fast now.
Rajiv, what areas, or rather what crops or states do you see a higher sense of adaptability onto this one?
Usage-wise, Maharashtra is on the top. Then comes Gujarat, Karnataka, Madhya Pradesh, part of Andhra Pradesh, Punjab. And then other states, like most of the southern states and the northern states are also seeing the adoption very, very quickly. Staple crops like field crops like wheat is now under water-soluble fertilizer treatment, or this, the SOMS package of practice. It will spread further to the eastern states also, because we see new markets in Chhattisgarh, then further to Odisha and West Bengal. Okay. So the spread is very big now.
And final question then, what is the market growth that you're looking at into this one? Because when you look at year-on-year numbers that seem quite encouraging, what is your sense?
Until last year, it was growing at the rate of 18%. I believe that with the kind of shortage happening in this year, the kind of if at all there is a shortage of urea and DAP and MOP, then the growth would be further higher. So I expect at least 18 to 20% growth this year also.
All right.
Okay, all right, Manisha, thanks very much for bringing us all of that perspective. Well, for the markets, like we've been pointing out, it's been a stable session. So just let's talk about specific stocks that did come out with their numbers. Sun Pharma was one of them, which came out with what was a good set of numbers overall. What really did well for Sun Pharma this quarter was the $354 million revenue that they managed to generate in their innovative business, innovative medicines business, which was up around 20% on a year-on-year basis in Q4. And if you look at it on an FY26 basis, it generated $1.4 billion in terms of revenue and was up around 16 to 17 odd %. The street is going to be looking at what happens with the Organon or acquisition. They do have funding tied up. That's what they've indicated. So that would be the next trigger point in terms of where the company is headed. In fact, let's listen in to the Sun Pharma management. I did have a conversation with the company's CFO, Jayashree Satagopan, and began by asking her about the quarter gone by and the guidance. Listen in.
We are looking at a high teens in terms of growth guidance for the revenues for the coming year. As we also mentioned, there are these macroeconomic environments, whether it is geopolitical environment, there are uncertainties relating to tariffs, and also slowdown that is sort of expected overall. Given these conditions, we believe that while we continue to focus on our growth, the growth could be in the higher teens, higher single digit.
Okay. What is the chance that you could possibly exceed this guidance?
Look, we always try to perform to the best of our potential. And therefore, if there are upsides, definitely that will flow in. But at this point in time, we think higher single digit growth is something that we are comfortable with in terms of guiding the street.
Can you tell us what you are guiding when it comes to margins? Because your margins were under pressure both Q-on-Q as well as year-on-year in the quarter gone by. Tell us what can we expect in terms of a range going into FY27?
No, normally we are not giving any guidance for the margins. But as I have indicated earlier, endeavor is always to try and get to the maximum potential.
Would it be fair to assume that you would be within this 27 to 28% range?
I would give it a pass.
All right. Let's talk a little bit about your innovative business. That did very well. It was $354 million for the quarter gone by. It was up 20%. Which were the key drugs in the portfolio which really led this growth? And according to you, which would possibly be the key growth driver in FY27?
Almost all our products in the innovative medicines portfolio had registered a good growth during last year as well as the last quarter. Starting from Ilumya, we had seen good growth in US as well as the non-US markets. Ilumya is now commercialized in 40 countries and we are seeing traction across all the markets there. Apart from this, our other products like Cequa, Odamzo, Winlevi, all of these have done pretty well across US and other markets.
Okay. So can we assume that you'll probably track this 17% growth that you did in FY26 for the innovative portfolio, which got you to $1.4 billion in terms of total sales?
No, we are looking at a double-digit growth, but what is the percentage is something that we have to wait and see.
Okay. So you're looking for double-digit growth. Can we assume that you'll at least cross $1.6, $1.7 billion in terms of total sales for this portfolio in FY27?
We are not comfortable giving a specific guideline in terms of numbers for innovative business.
Okay. Well, the US FDA has also accepted Ilumya's, possible usage for psoriatic arthritis, and the target action date is set for October 2026. What is the kind of potential from this condition?
I think the market seems to be attractive. As we get closer to the launch date, we will be able to share further details on this.
Okay. The US generics portfolio has seen price pressure. It was down 1.1% in terms of total US sales. Tell us how much was the US price pressure this quarter? What are you guiding for?
No, the US markets for generics has continued to see price erosion over the past few years, and that's something which is common across all the generic pharma companies. As and when we are able to bring in new products and launch in the market, I think that acts as a counter to some of the price pressures that we see in the generics market. So I do not see any major shift in terms of the pricing pressures that we have seen in the past in the coming year.
So your incremental dollar of capex and investment will now possibly go into your innovative drug portfolio when it comes to, say, the US business?
It is a combination of both. Our in-licensing will be for the innovative medicines business, and that has been the approach that we have been taking in the past. At the same time, we are setting up a new greenfield facility in India that will be to cater to both US as well as EU-related export markets, as well as some in the country.
What is the status of the Halol facility?
We are waiting for the FDA inspection to come in. We still do not have a timeline when they are going to be visiting us.
Okay, but the remediation is complete from your end?
We have done all that is required, and we are hoping for the FDA inspectors to come in and look at the facility.
Any timeline that you can provide us?
We do not have a timeline at this point in time, as I just mentioned.
Okay. Well, Sun has seen the maximum gain in terms of market share since the Ranbaxy acquisition in India. What is the guidance for domestic growth in FY27, considering that you closed FY26 with a healthy 14%?
Our endeavor for the domestic market has always been to grow the market above the industry. So we will continue to focus on that in the coming year as well.
Okay. How is semaglutide performing in the Indian market? Is it in line, better, or maybe poorer than your expectations?
I think Sema is performing well in the Indian market. Having said that, it is only just a couple of months since the product has been launched. We should give it, say, about 6 months' time to really see its full potential.
And the plan to launch semaglutide in other markets?
At this point in time, we are focusing on the launch in India. As and when we get approvals, we will come back to you and share the details.
Canada is in the pipeline?
No, we are looking at a couple of markets. We will get you details as we get closer to the approval timelines.
All right. On Organon, the company expects the acquisition to be completed by Q4 of FY27. So the numbers are not possibly going to be integrated before FY28. When can we see the operational synergies possibly come through?
The operational synergies should take about 2 to 3 years. This is what we had guided earlier on. We are looking at overall $350 million of operational synergies to come in. As we start integration post day one, it could take a couple of years for us to start realizing this benefit.
Okay. Can you update us on what the funding looks like right now? How much of the funding has been tied up, as well as the approval status?
The funding, as we mentioned, the interim funding has been totally tied up. We had the committed letters from the banks for $12 billion. Since we are looking at $2 to $2.5 billion to be funded out of our own cash reserves, for the balance, we are currently in discussion with the bankers, either for a term debt or for bonds, or also looking at some options in terms of swapping the existing bonds. All of these would be completed in the next 3 to 4 months time frame. As far as the regulatory approvals are concerned, the HSR filings are in progress.
Okay, all right. So that's the management of Sun Pharma. They are guiding for a double-digit growth in the innovative portfolio. Don't know what the double-digit growth would be. And they're targeting high single-digit growth for the entire business going into FY27. That's Stock in Focus. We have some important comments coming in from the Iran Foreign Ministry. So just watch out for that. We need to take a short break, but we'll get you a lot more on the markets once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. Nifty at 23,940 levels, approximately around that. Slight bit off from when we started the show. We started at around 23,990, around that level. So slight bit, it's come off from that point. IT continues to do well. Banks continues to do well. Pull up Nifty FMCG. Seems like that's seen a bit of a fall coming in as well. So that's something that we'll watch out for in the trading session. Nifty FMCG as of now seems like it's trading with slight and mild bit of cuts in the trading session. Like you can see, now it's in the red, down 0.2%. Individual names like Blue Jet Healthcare, that's buzzing in trade in the last 1 hour. They reported their numbers as well, so keep an eye out on that. We have Suven Pharma, we have Adani Power, Hunasa Consumer, among the names that have seen a bit of a run-up, specifically in the last 1 hour. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next to Business Search.
Stocks rally after Donald Trump points to a likely US-Iran deal, though not in a rush. Financials, auto and oil and gas stocks, the marketeers more importantly, lead the charge, while metals and healthcare stocks lag. Eicher Motors rides a healthy volume growth and a price hike to deliver better than expected sales and profit for the fourth quarter, even as margins were in line with expectations. The near-term capex and resolutions of labor issues bode well for the future. The finance minister reiterates the Prime Minister's call to conserve foreign exchange as fuel, fertilizers and gold imports are all paid for in dollars and other currencies. She adds that domestic economy continues to stay resilient. A sharp fall in oil prices and a softer US dollar buoy the rupee. The RBI Governor Sanjay Malhotra, in an interview to Mint, says that the rupee may be undervalued in nominal terms and could gain once the West Asia crisis normalizes. And US Secretary of State Marco Rubio meets Prime Minister Modi with energy high on the agenda, says that the US was keen to sell as much energy as they'll buy. He also added Iran is still a work in progress. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormas Fatakia. It started off on a positive note, is this truncated week for the markets, although the 24,000 mark still continues to be a bit of a barrier for the Nifty, but the bulls will take a 220-point advance with both hands, especially considering the on and off developments that you have witnessed over the weekend. And we, of course, had some flashes coming in from the Iranian from Iran via Reuters, and they said that just because they have reached conclusions on various subjects does not mean that they are close to signing an agreement, and they do not have any plans of sending a delegation to Pakistan just yet. But that, of course, besides the point, because the oil prices are still lower. The crude is down below $100 a barrel, recovering some lost ground. At one point were down around 6%, both Brent and WTI, now down around 4% each after those remarks that have come in from Iran. Yet Brent is down below 100. That has bode well for our own markets, especially for the currency, and of course for and therefore the impact on the markets as well. The Bank Nifty, though, is the principal contributor to the Nifty up move that you're seeing in today's session. It closed above the higher end of the trading range on Friday, and it has added another 1,000 points to its tally in today's session as well. So from 53,000, the index closed at 54,000 on Friday and is now above the mark of 55,000. But let's begin with the fallout of the West Asia crisis. The finance minister, addressing a gathering today, elaborated on the multi-front challenges faced by the Indian economy. Listen into what she had to say.
Honorable Prime Minister giving a call to conserve foreign exchange as far as possible is very important in this context. I will dwell on that for a minute because that's led to a lot of narrative all around the country. We need to understand the context in which the PM made this call. It is because of high international crude prices, and the high crude prices are ever changing. It's seriously dynamic. One rate at one point in time, within a week another, within a week another, and so on. Like that it has been for over now 80-90 days. So high international crude prices and very fluctuating one. High international fertilizer prices. Unimaginable increase in the fertilizer prices, high gold prices, that is creating some challenges on the external front. GST revenues, which indicate economic activity, have remained strong even after rationalization, the rate rationalization which happened in September 25. In these times of uncertainty, high-frequency indicators also show broad-based domestic demand.
And based on the developments over the weekend, as we just mentioned, oil prices are trading sharply lower. Both Brent and WTI down over 4% each after President Donald Trump signaled progress in talks with Iran. Manisha is here with more on this. Manisha.
Oh, well, absolutely. Last week was no better. We did see prices come off from the kind of highs that we've been trading at. And this week as well, it started on a weaker note yet again. 6% of a decline and just about trading at around 97 to 98 between those levels. So it's not just the Brent which is trading at a 2-week close. You have heating oil, gasoline prices trading at a 4-week close as well. All of this on the kind of statements that we seem to be reacting to on the weekend there, where the potential US-Iran deal that could reopen Strait of Hormuz is something that the market are working with. But in sense of statements, the US is saying that there is a framework for a peace deal with Iran that is largely being negotiated. US also has said that there's no hurry really for a deal and that after a deal only the blockade of Iran will be open therein, and until then it will remain in place therein. If you look at the key price movements, really the last 2.5-3 months have seen big volatile moves come in for the crude oil prices. On 28th of Feb, that is when we saw the instance of US and Israel attack on Iran. That is when we saw prices gain up anywhere between 10 to 13%. And then on 31st of March is when we saw the peak cycle coming in for the crude oil prices, when $120 a barrel came in on the chart as well. This was after the closure of Strait of Hormuz. Until then, it was only a conversation, but 31st March is when Strait of Hormuz got shut. 7 to 13th April also has seen a lot of movement come in for the prices. We did see prices decline by 18% on ceasefire news, and then it came back above $100 a barrel after the US blockade of the port in sense of Iran there. 20th to 22nd of May, the prices have kept on above $110 a barrel, even as the peace negotiations were getting on and then falling apart therein. And then we are looking at the markets today, where we're looking at 5 to 6% of a decline coming for the crude oil prices. So even as there is a decline in the international markets, Indian prices have been hiked in sense of fuel for petrol and diesel as well. A fourth instance really, when you look at the last 10 days, between 15th of May and 25th of May, we've seen 4 instances where Indian petrol and diesel prices have been hiked, coming to the total of around 7.5 to 8 rupees for both of those varieties there. Looking forward, when you look at the price forecast, most banks and brokerages believe that we're looking at higher prices in this year and much lower or perhaps status quo in 2027 as well. EIA says $89 of an average is what we will look at this year, but cuts it down by $10 to $79 for the next year therein. JP Morgan talks about 96 of an average this year, 75 again on the lower side. You have 70s being talked about from Morgan Stanley as well. But Barclays and Goldman Sachs believe that 80 to 100 could be an average for crude this year and the next year as well, because most of the statements coming in from major crude producers and traders is that it would take by the end of 2027 before we see normalization or full resumption of crude production and exports coming in from Middle East.
Manisha, thank you for that update there. And of course, the fall in crude oil prices has had a direct bearing on the oil marketing companies. They are continuing their recovery after the sharp sell-off that was seen earlier when the oil prices were on the rise. Both HPCL, BPCL, IOC, all three of them doing well. But the fall in oil prices is not just the factor why these prices are higher. There is another factor behind that as well. And of course, another round of price hikes coming in earlier in the day. Sudarshan is joining in with more details on this. Sudarshan.
So today, all three oil marketing companies, IOC, HPCL and BPCL, are seeing buying. All the three names are sharply higher. It has reasons to it. First, this sharp downtick that we have seen in crude prices. Brent is still trading below $100 per barrel, and it's holding on to those levels. So that is being taken positively. Second is the fuel price increase. Government has announced, or basically oil marketing companies have announced another round of price increase. Both petrol and diesel prices have been increased in the range of rupees 2.61 to rupees 2.71 per litre, and now in last 2 weeks, or say in last 10 days, there's a price increase of little more than rupees 7 per litre. And after the current round of price increase, OMCs are incurring rupees 35.50 per litre loss on diesel and rupees 10.50 per litre on petrol. We also have certain information through sources, and they are saying that after this increase also of more than rupees 7, India prices petrol and diesel at or below most of the developing world, and that most of the other developing economies are now pricing petrol at around rupees 150, while in India the prices are still around 100. So this is the information that we are getting through sources, but major reasons for the sharp increase in OMC shares are because of fuel price increase and sharp downtick that we have seen in crude.
Darshan, thank you for those updates there on the oil marketing companies, all three of them gaining up to 4% each. The other positive factor today has been the currency, and the RBI governor in an interview to Mint also said that the rupee was not overvalued and that the balance of payment situation was manageable. Lata has read between the lines of the interview, and she's here with what she's interpreting from that. Lata.
A governor's interview 2 weeks before an important monetary policy which falls on June 5th means that the entire market parses the interview only for rate hike hints. Now, what the dealers say is the governor uses the phrase, we will do whatever it takes to keep inflation under control. A whatever it takes phrase is usually indicated as hawkishness. But more specifically, the governor says at one point in time that we will set policy depending on data. We are data dependent on what the inflation is, but also what the inflation outlook is. Now, that is hawkish, because if the outlook is 5%, then a 5.25% repo rate can be considered inadequate. So those look like hawkish signals, but he goes on to say, and that's a very dovish signal, that we will look for only second round impact of the fuel price hike. A fuel price hike is because there is a supply side shortage. It's not because there is a rise in demand in India. But if that hike gets translated to higher wages and then a generalized inflation, wage price spiral as we call it, then only you call it a second round of increases. So the governor seems to indicate that fuel price rise itself is not reason enough for him to raise rates. That is the dovish signal. So all told, what is the market taking away? The market's taking away is that the crude price fall is a positive, and recent hikes do lead to second round increases in inflation at a future date. So monetary policy at the moment will be cautious, but the conviction for a future rate hike goes up, but not immediately. That is the main takeaway that the market has taken from this. They will pencil in more hikes, later in 2026, but people are not penciling in a rate hike on June 5th, going by this interview. Just a word more on the rupee. Most of them are motherhood statements. He has not given away anything. He says that, the rupee has become undervalued, that we all know because that the data of the REER, as we call it, real effective exchange rate, the real jump in the rupee compared to competing currencies, that has been undervalued for quite some time now. He is not telling us anything new. The balance of payments is not an undue concern just yet, but it requires attention. Again, looks more motherhood. I'm quite optimistic about having a manageable balance of payments shortly. Again, optimistic. So, what the market wanted to hear was, will he use interest rate to defend the rupee? That question was not asked. There was no answer on that.
We obviously look forward to that answer next week when the policy is announced. But Lata, thank you for summarizing that for us. We'll take a short break. More news and updates on the other side. Stay tuned. Welcome back. Let's get you the latest on the US-Iran deal. The United States and Iran appear to be on the brink of a landmark agreement, though significant gaps still remain and the deal is not yet done. President Donald Trump said on Saturday that a broader agreement between the two nations has been largely negotiated and that the Strait of Hormuz would be reopened, signaling potential momentum towards ending this 3-month-long war. But on Sunday, he told his negotiators to not rush into a deal and that it is not fully negotiated yet. He wrote on Truth Social, and I quote, "If I make a deal with Iran, it will be a good one and a proper one, not like the one made by Obama," end of quote. Now, according to a Syria administration official, Washington and Tehran have developed a memorandum of understanding framework that would extend the ceasefire by 60 days, while the two sides work towards a final deal to permanently end the war. Now, in latest coming in from the side of Iran, Iran's foreign ministry said that the potential MOU has no specific details about the management of the Strait of Hormuz. Iran's Baghei said that both sides have reached conclusions on many topics discussed, but that does not mean we are closing to signing an agreement. Currently, there is no plan to send a delegation to Pakistan as well. Meanwhile, Israel's Prime Minister Benjamin Netanyahu expressed his appreciation about the progress being made. In a post on Truth Social, Netanyahu wrote, and I quote, "Any final deal with Iran must eliminate the nuclear threat. That means dismantling Iran's uranium enrichment facilities and removing enriched nuclear material from its territory," end of quote. He also said that Donald Trump has reaffirmed his support for Israel's right to defend itself against threat on all fronts, including that in Lebanon. Now, as both sides work towards an agreement, the U.S. holds its ground on the nuclear weapons. Speaking to reporters in New Delhi this morning, U.S. Secretary of State Marco Rubio alluded to a real significant time limit on the nuclear matter. Take a look.
Pull it off. It has a lot of support in the Gulf. It has a lot of support globally. Every country that we've walked through it understands it's not just very reasonable, but it's the right thing for the world to get done. As the president said, he's not in a hurry. He's not going to make a bad deal. I mean, the president's not going to make a bad agreement. So let's see what happens. We're going to give diplomacy every chance to succeed before we explore the alternative.
As we take a short break, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC TV 18's all-new app, where you get breaking news, in-depth articles and financial world updates at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that's right up on your screens. Take a short break. Back with more on the other side. Welcome back. Now, the H-1B visa approvals for top Indian IT service companies fell as the Trump administration cracks down on work visas and green card applications. Let's go across to Rima for more details on this. Rima.
Thanks so much for that. We're talking about a 35% drop in the new H-1B approvals for the current year. So the total 2026 approvals stand at 11,000. The comparable number last year was more than 17,000. So we're looking at a drop of more than 35%. And this is data from the top 6 major IT companies: TCS, Cognizant, Infosys, HCL Tech, Wipro, and Tech Mahindra. There are multiple factors driving this, but predominantly it is a strategic reset by the way the companies are delivering work. There has been a very conscious effort by the Indian companies to reduce their dependence on H-1B visa, and every year the numbers are telling you the same story. They are focusing on local hiring, nearshoring, offshore delivery centers from India. But it's also a story about tightening immigration norms. There has been a $100,000 fee for H-1B petitions, which became effective last year. The move from random lottery system to make the approval has now moved to wage weighted. So they are focusing on people with higher skills, higher wages. So it's a combination of factors, but the numbers are telling you a story of a strategic retreat by the Indian IT companies and tightening immigration norms by the US. But separately, there was a lot of news flow over the weekend which caused panic, consternation amongst H-1B visas. So on 22nd of May, the US administration issued a directive which basically said that all foreign visa holders, this includes H-1B, that if you want a green card holder, if you want a green card, then you have to go back to your home country, apply at the US embassy there. Now, you know the process of converting your H-1B into green card can take months, it can take years. So there was a lot of panic because there are so many people waiting for years to get that green card permanent residency, and they face the prospect of leaving their jobs, families, homes in the US, and there was no guarantee that that approval would come through very soon. But then the clarification, some rollback came in from the USCIS, which said that people who present applications that provide an economic benefit or otherwise in national interest will be able to continue on their current path. So basically, H-1B visas holders, workers who add economic value can apply for their green card from the US. They don't need to go back to their home countries. So there is a clarification which has come through, but it's not a guarantee. Right? Earlier, it was pretty much, now it just seems that there is some more uncertainty and discretionary, but there has been a significant rollback on that green card directive, at least for H-1B visas. So that should allay some concern.
Rima, thank you for that update there. Now, the US Secretary of State Marco Rubio has landed in Agra on the 3rd day of his maiden trip to India. This, as the Quad Foreign Ministers meeting tomorrow, remains one of the most significant engagements of his 4-day visit. Rubio visited the Taj Mahal as part of his ongoing 4-day diplomatic tour. He was accompanied by his wife, Janet Rubio, and the US Ambassador to India, Sergio Gore, over the weekend. Now, Rubio also met with External Affairs Minister S. Jaishankar, and at the press conference on Sunday, he said that India-US relations have not lost momentum. The India-US relations will come out much stronger in the coming years. He further said that the US hopes that the long-pending trade deal between the two countries will be sealed soon, adding that both sides are strategically aligned on almost all key global issues. Rubio will also travel to Jaipur before returning to New Delhi tomorrow to attend a meeting of the Quad Foreign Ministers. Now, on the trade deal front, Marco Rubio told CNN News 18 that both US and India hope to finalize a trade agreement soon, adding that both countries share the same security concerns and they need to develop more on defense production. Listening to his views.
I view it more as a continuation of a very strong relationship and looking for new areas of opportunity. We hope to have finalized very, very soon a trade agreement that's going to make both of our countries stronger. We obviously share a lot of the same security concerns. We're also using India as the forum for our next Quad meeting for foreign ministers. In fact, it was the first meeting I ever did as the Secretary of State was a Quad meeting, and we were due for another one, and so we felt this was the right place to do it. We have a lot of commonality, obviously. There are a lot of investments in the United States by Indian companies. So I view this visit as much as anything else as sort of a continuation and just continuing to build on what we already have as a foundation and the progress that's been made in just the last year and a half in the second Trump administration. The Russian oil purchase issue obviously had nothing, it wasn't about India. It was about a desire to impose a cost on Russia because of the war in Ukraine. And India just happens to be a big purchaser, but it was never aimed at India per se. There's been some new dynamics in place nonetheless since that time. And so I think what you've seen, though, is that in the process of addressing that, we've also seen an opportunity for India to continue to its plan, its already pre-existing plan, to diversify its energy sources. And that includes the United States and potentially some other countries like Venezuela. So we want to continue to be a good partner in that regard. And so I don't think that issue is going to feature very prominently in the future because India was already moving towards diversification. And so, as I said, and hopefully the war in Ukraine will end.
That we take a leave on this edition of Business Lunch. We leave you with the market still near that mark of 24,000. But don't go anywhere. Mid-cap radar on the other side.
Good afternoon and welcome to Mid-Cap Radar, live from the CNBC TV 18 Motilal Oswal studio. I am Vivek Iyer and with me today is Hormaz Fatakia. Good afternoon, Hormaz. The session, we're actually seeing the market hold on to the gains. Advanced decline ratio in favor of the advances.
So the bulls will take that with both hands, especially considering we are heading into the monthly expiry tomorrow. So it's a positive start to the week. Oil prices are down. The rupee is doing well for itself. So it's a good start to the week. Of course, the 24,000 level still remains elusive for the index, but the bulls would hope that the last 2 hours bring about that level as well. But let's take a look at the headlines that we are tracking at 1:30 this afternoon. Stocks rally after Donald Trump points to a likely US-Iran deal, though not in a rush. Financials, auto and oil and gas marketeers lead the charge, while healthcare lags. Mid-caps relatively underperform.
Glenmark Pharma fires up in trade after its US subsidiary has agreed to enter into a settlement with state attorneys general for a total amount of $29.6 million payable in annual installments over 5 years.
Sterlite Tech bags an international contract worth over $1 billion from a hyperscale partner for multi-year supply of optical connectivity products for AI data center build-outs. The stock is in a 5% upper circuit.
And Anupam Rasayan approves the acquisition of majority stake in pharma formulation maker Bliss GVS Pharma. The management tells CNBC TV 18 that the acquisition will be funded through 300 crore rupees of debt and aims to improve margins to over 20%. Well, last week, as far as earnings are concerned for Q4, and we're seeing sharp reactions to earnings in terms of the large cap names. Aisha Motors is one particular stock that clearly stands out. And on the other hand, Divi Slabs, after a bit of a miss, has seen quite a bit of selling pressure emerge. And as you can see in the bottom of your screen, NBCC has just declared its Q4 results. The EBITDA is lower on a year-on-year basis, close to 3.5%, but the internals will be key to watch. And the management commentary on guidance for FY27 is something that the market will keep an eye out as well. But this is our special segment, Mid-Cap Movers. Sudarshan is standing by the big wall to take us through all of the mid-caps that are moving around in the session.
So in a broad-based buying, we are seeing some of the mid-cap names hitting the upper circuit. So I've taken those names which are at the upper circuit, Premier Explosives and Apollo Micro. Both these stocks have been moving higher over the last few trading days. And today also both these names you can see are at the upper circuit. Just Apollo Micro slightly off highs. Premier Explosives still holding to the gains, up almost 2%. Park MediWorld has come out with the earnings, and those earnings look largely better than expectations. And that's the reason up move of more than 7%. Hariom Pipe and Copran, though both these names are trading higher with healthy volumes, are currently up 20% each. And some of the other names that are trading higher with healthy volumes, Dynacon Systems. For the last few trading days, this stock too has been moving higher, and today also up almost 8%. Phenotex Chemicals, and remember these names that I have mentioned you on a monthly basis are up in the range of almost 35 to 80%. Phenotex Chemicals today also up almost 9%. Spark, following the nod that they had got for one drug, this stock today also it's up almost 6%. Mayur Uniquotors and Sandhar Technologies last week had come out with the earnings, and those earnings for Sandhar also was better than expectations. Today also it's up almost 8%. Some of the names that are down in the trade, InfoEdge, because of the concern related to its recruitment business. That's the reason after Friday's big up move, today it's down almost down 2%. Oil India, because of sharp downtick we have seen the crude price, OMCs are higher while upstream names are lower. Oil India is down almost 3%. Last one, Colgate, earnings were largely in line, but there are some concerns related to the outlook, and because of that it's down almost 2%.
Opened higher, trading lower is Colgate. Sudarshan, thank you for that update. Just one more addition to that list. Of course, Blue Jet Healthcare, it came out with numbers a few minutes ago. The stock had spiked around 10% despite the numbers being lower on a year-on-year basis. The stock has come off slightly from those levels, still holding on to gains of around 9%. Time for the first earnings conversation on the show. Electronics Mart reported a healthy fourth quarter. The revenues were up 15%. The profits were up almost 50%. We are now being joined by Mr. Premchand Devarakonda, the CFO of Electronics Mart, to break down the quarter gone by and, of course, the road ahead for the company. Mr. Devarakonda, good afternoon. Thank you for joining in. Before we get down to business, the first topical question that I wanted to actually ask you was that based on the current situation that you are witnessing in West Asia and with the current energy crisis, the rise in prices as well, are you witnessing a similar trend of rising sale demand in the induction cooktops and microwaves and other such products? And if so, what is the extent to which you have seen this go up?
Thank you very much for having me on your show. See, this induction cookstoves definitely had a pent-up demand sometime in the month of March. Now it is cooled down, so there will not be any further, would say, any expected demand for these cooktops. But the other categories like air conditioner, this is the season for, this is the season for cooling products, mainly air conditioners and coolers. I think they gain a lot of demand in the market and they're doing exceedingly well.
Okay. So thank you so much for joining us. Like you just mentioned about how demand has picked up in certain categories. What we want to understand from you is that as far as Q4 is concerned, margins surprised the street positively. Going into FY27, can you quantify your guidance in terms of same-store sales growth, a growth target in terms of top line, and what kind of EBITDA margins should the street work with?
Yeah. Since the summer started off very well, I think we will be very optimistic about this FY27, and we are targeting about 15% top line growth and maybe high single-digit SSG growth coming in from the markets where we have been operating.
So 15% revenue growth and high single-digit same-store sales growth, right, Mr. Devarakonda?
That's right. Yeah.
What about margins?
See, margins will be, EBITDA margins will be between 6.5% and 6.8%. So that is the range for EBITDA margins.
Okay, so margins you expect to maintain, but in terms of SSLG growth, from Q4, you're expecting a bit of a moderation. Q4, it was very strong at over 12%. You're seeing a bit of a moderation. So what is the reason for that? And the other question is, so analysts are a little worried that the pace at which you're adding fresh stores has moderated quite significantly. Is there a reason that you're going slow?
For the last couple of years, definitely our store addition year on year has been quite significant. That means in percentage terms, we were adding almost 25 to 30% stores year on year. Whereas this year, we are going to be little conservative in adding the new stores as we have been targeting the other states also, because currently we have been operating only in AP, Telangana and NCR. Okay. And now we are looking towards eastern part of India. So when we enter any new market, we want to be little conservative. As a result, at the same time, we have to focus on stabilizing the existing stores which have been opened in the last couple of years. So there the productivity needs to be improved. So we are working in tandem with both these strategies.
Okay, so you're looking to go ahead and improve the profitability metrics as far as the other stores are concerned. So going into FY27, FY28, what is the kind of growth assumptions that the street should now work with, given the fact that there will be moderation as far as store growth is concerned?
See, if you look at our store mix also, more than 50% of our stores are yet to mature. So those stores keep on growing over the next couple of years. And this year we are targeting 15% top line growth, and the similar trend is expected. It will be between 12% and 15% depending on the summer season performance. And if summer is good in the next, FY28, definitely we are going to have similar growth rate in FY28 as well.
Clubbing two questions into one, Mr. Devarakonda. First, of course, is your product mix. Large appliances from 61 have come down to 42 now, with mobiles taking a bigger share of that. Does that product mix remain the same going into this year as well? And part two, if you can give us a scenario on the working capital days as well. It has remained between 70 to 80 over the last 3 years. Does that also remain the same this year as well?
See, last year summer was not really favorable to us. So we had to take the beating. As a result, that large appliances mix has drastically dropped down. Whereas this year summer is very good. So as a result, we will again come back to that 50% contribution coming in from the large appliances, and we are quite confident of achieving that. Coming back to the other part, what is the second part? Of the question?
About working capital, Mr. Devarakonda.
Yeah. Working capital, normally what happens, this is before start of any season. Obviously, our working capital days looks to be very high because we stock lot of products before the start of the season. The inventory levels go up. As a result, the working capital days look little on the higher side. But when you look at like end of Q1 or Q2, where the by the end of the season, definitely it will drop down to again below 60. So that is the trend, and it will continue in future as well.
Okay, coming to the good part of the business, when you're looking at the NCR region or the North cluster, that's grown almost 31% on a year-on-year basis. However, margins there continue to remain slightly subdued compared to, especially when you're looking at the South market. So going forward, sustainable rate of growth in NCR region, and where can you bring margins up to?
Yeah. See, compared to Southern cluster, NCR operating costs are little higher. As a result, when the stores mature, we may expect, say, if South cluster is contributing 7.5%, North cluster will be 50 bips lesser. So that is our expectation. And because of the higher cost of higher operating costs, that is the only reason. And in the next couple of years, we are going to, I think, reach to whatever the targeted EBITDA coming in from NCR.
Pleasure having you today, Mr. Devarakonda. Thank you so much for spending time and joining us today on the show. Wish you good luck for FY27 as well. Take a short break from one management to other. The management of Neogen Chemicals joins in on the other side. Stay tuned.
Welcome back to Midcap Radar. Well, one particular company that saw a steady quarter was Neogen Chemicals. The company's revenue saw a 21% uptick, while profit rose to 11 crore rupees in the March quarter. However, the stock did see quite a bit of volatility post the results. We are now joined by Mr. Hareen Kanani, MD, Neogen Chemicals, to discuss more. Good afternoon, Mr. Kanani. Thank you so much for joining us. Well, three key questions that the Street wants to know and get more clarity on. Number one has been the capex as far as the battery project is concerned. It's been up from 1,500 crore to 1,800 crore. The second question, of course, has been the delay as far as the Dahej phase 1 plant is concerned, as well as the Morita plant is concerned. So on the back of that, can you give us clarity, and when can we expect all of this to come on stream?
Hi, thank you for having me. We had a very nice quarter last quarter, and overall, in spite of the problem we had in fire, we were very happy that the team was able to deliver more than like 10% kind of growth year on year in the last financial year. We have made also good progress in the battery business development. So we also received key approvals for the battery business, especially for our electrolyte salts in the US market, with 3 out of 5 electrolyte companies approving it, as well as a second customer also approving our electrolyte facility. When it comes to the capex, broadly speaking, there are 3 sections. So we have in Dahej, we are building 2 plants. So the first plant has already now come online. We already started trial production. And as we received customer approvals also, very soon we will start commercial supplies from that.
Can you give the timeline for that?
So that has already come online. We already started trial productions.
Okay.
So that is about 1,500 metric tons of our salt capacity out of 2,500.
Okay.
And 1,000 ton. And that is already online. And maybe in Q1 or early Q2, we should start commercial production from this. Already electrolyte is online and we are selling to electrolyte, but the salt additional capacity that we added will come online by end of Q1, early Q2. The second bit is where we are adding additional 1,000 ton of additive capacity. And we also decided to add 500 metric tons of intermediate LIF capacity. So this is expected to come online sometime in Q3. Although the banks have given us time up to February, but we expect that in Q3, this will also come online. This is on our Dahej plant. When we think of our bigger capex, which is our future battery plant, which is Pakhajan, the original plan 2 years ago was to start by end of FY26. So against that, the first half, 2 quarters ago, we had announced that the electrolyte section will start in the first half, and we already announced that we are starting trial production. So before September, the electrolyte plant should come online. We are on track to deliver that. And the Morita plant, because of the JV, we had to adjust to the technology, which took a little bit more time and also a little bit more money. So I think that plant is now, we have targeted for H2. This was already announced 2 quarters ago. And in H2, we are targeting by Q3 to start trial production. So end of Q2, early Q3, we will start trial production. And we expect commercial production to start from Q4. So in the current financial year, by the end of current financial year, mostly by Q3, majority of all the capacities will be running online. And already what has come online is now getting approvals. So we should see higher revenues also come in this year, especially in the second half of the current year.
But Mr. Kanani, firstly, good afternoon. What's causing this bottleneck or the delays that you have witnessed? That's part one. And despite all of these delays, you are mentioning the fact that it will come online in the second half. Yes, but you've still maintained your battery chemicals revenue guidance between 2,500 to 2,900 crore, despite all of these delays, both in Dahej and in Pakhajan. What's giving you this confidence that despite this delay, that there will be no impact on the customer ramp up and so on?
So, this delay was already envisioned 2 quarters ago, and we had already also shared this information with the street. And the main reason for the delay, again, for the electrolyte, it's only 2 months delay. So we are targeted by end of Q4. Instead of that, in April or May, we are starting, the electrolyte trial in the Pakhajan facility. And just the main delay, 6 months delay, is on the salt because we were shifting from our technology to Morita technology. The 2,400 to 2,900 crore target is for FY29. So the main ramp up for electrolyte salt is expected to be in 2027 calendar year, where the US requires the electrolyte producers in the US to go from China to a non-China or non-FEOC based like supply, foreign entities of concern supply. So that shift will happen our Q3 and Q1 next calendar year for them. So that's the reason there is no impact on that. And with 6 gigafactories in India currently getting, in different stages of startup, ramp up, and commissioning, we see a very strong demand for electrolyte in FY29, and therefore the full utilization target remains the same. So whatever we had projected about 1 quarter ago, we are maintaining the same guidance. There's no change in the guidance.
Okay. So lastly, FY27, can you quantify the guidance that you're expecting, or top line growth in excess of 300 crores? Is that something that you're working with? And is it expected to be back-ended? And while your FY29 targets for the battery segment remains on track, FY27, can we expect a little bit of a downgrade as far as that particular guidance is concerned?
No, so I think the 300 crore guidance, remains the same for our battery business.
Okay.
We had basically last year, we had missed some targets first time since we got listed. So we've been more careful. We have built in, some redundancies that in case if the salt is delayed, there will be salt electrolyte, or if there's no electrolyte, there can be more salt. So we basically kept those things in our mind so that we can still achieve the guidance for this year. So there's no change in that. And yes, for FY27 overall, we are looking at around, let's say 1275 to 1350 crores kind of revenue coming into the current year on a consolidated basis, both battery and our base business, which is also growing. And our plant, which was impacted by fire, is also coming online middle of this year. And we are seeing a very strong demand on organolithium and inorganic lithium prices. So I think overall, we should be able to meet that.
Thank you for sparing time and joining us this afternoon, Mr. Kanani. Wish you good luck for FY27. Looking forward to having you more often to talk more about the industry trends and the business, of course, as well. Neogen Chemicals, 4.5% higher as we speak. Take a short break. Back with more on the other side. Stay tuned. Still a 950-point up move on the Nifty Bank, although the Nifty is still struggling to cross the mark of 24,000. Although the bulls will not complain for the fact that the index is still up around 250 points as we speak, as we enter into the final 90 minutes of the trading session. The currency continues to do well as well, and oil prices still hovering around that mark of $99. Take a leave on this edition of Midcap Radar. From Vivek and me, thank you for watching. Your stocks on the other side.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. And a better start to the week is what we're seeing coming in for the markets. And the Nifty continues to hold on to that level as well, right? Not much of a worry that's coming in here right now. 23,963, it's holding on to that. We're not seeing any upside, downside that's coming as well. So, yes, good gains in terms of today's trading session. Broader end of the market, that also continues to do well. Advance decline ratio today, obviously in the favor of advances versus declines. Then in terms of sectors, now FMCG at one point of time was holding on to green. That's come off and is trading in the red since the last hour or so. So FMCG muted performance as of now, trading slight cuts of 0.25%, so 0.2% of decline there. Pharma, that too has slipped into the red as well. Mild cuts coming in for the Nifty Pharma as well. So these are the two sectors that are not doing too well. But PSU banks, banking, financial services, all of that, as well as autos and realties continues to do well, holding on to very, very strong gains in the trading session. But let's move on now and get started with the show, right? This is a show where we solve all your stock-related queries. We're going to be doing just that with Gaurang Shah, Senior Vice President at Geojit Financial Services, as well as Vaishali Parekh, Technical Research at Prabhudas Leeladhar. Vaishali, as well as Gaurang, good afternoon. Thank you so much for joining us on the show. Let's get started with the first query for today. This one is coming in from Kevin Sylvester, who's writing to us from Kerala. He's holding 500 shares of Infosys. This is at a price of 1,200 rupees per share, as well as 100 shares of Kalyan Jewellers. Price is 390 rupees per share. So for Infosys, making some bit of a loss here right now as well. And Kalyan Jewellers also, they bought it at 390 rupees per share. Wants to know, should they continue to hold or should they book their losses and sell both these stocks? Gaurang, good afternoon. First up, what's your view coming in for Infosys, IT? Everyone's talking about it for a while, but finally, is it time we'll see IT come back? And for Kalyan Jewellers, is that a better bet, or maybe you would look at something like a Titan?
Sure, Vinny. Thank you so much for having me on your show. Good afternoon to all your viewers, to Vaishali and to you as well. A small disclosure. All recommendations that I'll be sharing with you this afternoon on your show, Vinny, they are part of our fundamental search stream recommendation from a long-term point of view. Our company, Geojit, or myself, we do not have any kind of personal holdings, no financial interest, no conflict of interest. But we share similar investment ideas with our clients. They might have their investment interest. So I will keep my initial comments restricted to Infosys because that is where we have a positive coverage from our fundamental team. The only thing is that the golden year returns that we used to get from IT maybe a couple of years back, that may be a little bit skewed downwards, but yes, we remain positive from a long-term point of view on Infosys. There are challenges, but I think stronger companies will be able to reinvent themselves and reposition themselves. As far as Kalyan Jewellers are concerned, well, we are positive, like you rightly mentioned, on Titan Company because of the diversified business that Titan has, not only focused on gems and jewelry, they've got a lot of other wristwatches. They've got premium platinum offering when they took over CaratLane. And of course, they have eye care, backpacks, personalized perfumes, etc., accessories, etc. So if I have to pick a choice in the gems and jewelry pack, it would be Titan.
Okay, gems and jewelry pack. Preference is Titan, but positive on Infosys for the long-term story. On the technicals, Kalyan Jewellers and Infosys, what's your view, Vaishali? Infosys, do you expect it reaching their buy price anytime soon? And Kalyan Jewellers versus Titan, what would you pick?
Very good afternoon to Gaurang, Vinny, and thanks for having me on the show. So I would say actually IT sector on the whole has been really beaten down. So from a perspective, I would say Infosys, TCS, all these stocks are good levels to start accumulating if long-term is the view. Because for trading, there is still no clarity, but for long-term, one should start accumulating at these levels. And as far as Kalyan Jewellers is concerned, I would take this as a trading bet because it's just showing signs of revival. We've seen good correction and now showing signs of bottoming out. So I would say 330 would act as a stop loss. And if this view goes right, if the bounce continues, then this can go towards 380 to 390. So take a calculated risk and go for a buy.
Okay, that's a word coming in there for Kalyan Jewellers as well as Infosys on technicals. Let's move on then to the next query. We have Adi Narayan, who is writing to us from Andhra Pradesh. He is holding 150 shares of Network Technologies. Price is 2,300 rupees per share, making a good profit on this one. And, he wants to know whether he should add some more shares or book his profits now, partial booking, complete booking. Gaurang, your view for Network Technologies, this is one of the stocks in the last 1 year has seen a sharp uptick, right? And that AI, the slight bit of a divergence that they have versus other companies, that's leading the trend. What's your view?
So no specific coverage on NetWeb, but I would say that yes, the opportunity, like I mentioned for Infosys, Vinny, that companies which are able to reinvent themselves and reposition themselves with the ever-changing environment of technology. And our sense, Vinny, is that innovation and inventions in form of newer platforms and tools will pick up speed as we go into the future. So NetWeb happens to be a well-positioned company, and in terms of earnings and performance and the commentary from the management, it looks strong. However, I won't be in a position to give buy, sell and hold since we don't have a coverage.
Okay, that's a view there on NetWeb. On the technical front, Vaishali, what's your view? Stock is up 102% almost in the last 1 year. Do you think it's, peaked right now for a bit? Maybe we'll just see it move in this range, or should they add more or book out as profits?
So as a disclaimer, this has been one of our technical buy recommendation to our clients. And actually, the stock is doing pretty well. It did retest the previous high of 4,400, 4,500. And from there on, we have seen a regular retracement. So currently, I would say it's again an opportunity to add more. Say 336, 3,400 is a good support band. So keeping that in mind, it makes a good buying strategy. And it can again retest 4,400 and perhaps even higher. It can go towards 5,000 levels also. Because I'm looking at the longer term horizon also, the trend looks pretty strong.
Okay, keeping an eye out on that long-term target as well. 5,000 there for NetWeb is what is possible. Let's move on then to the next one. And this has also been one of the sectors which has been in focus, renewable energy side. Now, Amrish, who's writing to us from New Delhi, he's holding Vari Renewable Technologies. Price is 1,272 rupees per share. Wants to know if you should continue to hold this or sell at the current levels. He's bought it at higher levels versus what it's trading at, right? Gaurang, this as a sector has picked up a lot of pace, or there's a lot of interest coming in here as well. Renewable energy side, what's your view on Vari Renewables? They bought it and they're making a loss right now. So what should they do?
So this is a tricky one for me, honestly, because we have positive coverage on Vari Energies, Vinny. Vari, this one we don't have a coverage, so I won't be able to give you specifics in terms of whether to buy, hold on, or add or buy on Vari Renewables, since we don't have, but the space looks quite attractive. We are positive on the sector overall. And the best part, Vinny, is that the government focus to give a push in terms of new addition that is coming and in terms of power generation is going to be focused on clean and green energy. So the opportunity is a huge opportunity for the company. Unfortunately, since there is no coverage on Vari, this specific company, positive coverage on Vari Energies, like I mentioned.
Okay, that's a view there. Vari Energies is what, we have the view on. Vari Renewables is obviously it's a concern of the company as well. But let's move on. And on the technical front, Vari Renewables, do you have a view on this one?
Definitely. So technically, I would say the stock has seen a good correction. It showed signs of bottoming out at 800. Now, currently, it is at a make or break level. 900 acts as a very good support level. So I would take this as a buy suggestion because risk-reward ratio turns out to be very favorable at these levels. And once you see a pickup and crossing over 1,020, this is ready to go towards 1,200 levels. So 900 below is a stop loss, and go for it. Look for a target of 1,200 to start with.
Okay, we'll keep an eye out on those levels over there. Just a quick note in terms of the numbers that are flashing at the bottom of your screens. We have Yatharth Hospital that reported its numbers. Net profit is up 23%. We have the stock that's actually down 3.4% in the trading session as well. It's seen a bit of a dip coming in from the green and sharp fall post the numbers were reported. Seems like Street is not liking something. The revenue is up 47% YOY. EBITDA is up 37% as well. So we'll wait out for more internals that come in on this one. But as of now, the stock has seen a sharp fall. And margins, that's where it is. Margins have seen a contraction as well. 23.3% versus 25%. So more in terms of internals, we're seeing that the stock is trying to make a bit of a recovery. 3.45% decline to now 2.9%. But we'll have to see in terms of internals. But let's keep it going then with the next query for today. We have this query who's, this is coming from Srinivasan, who's writing to us from Chennai. He's holding 2,055 shares of HDFC Bank. Price is 787 rupees per share. Almost say the buy price is what the stock is trading at, right? And he's accumulated over a very long time. 20 years is what he's highlighted. So he's been accumulating this. Wants to know if he should remain invested or maybe switch to some other stock. HDFC Bank, a large private bank, but Gaurang, your view on this one? Their average price, even though over a long period of time, is just been 787, so more on the higher side. What should you do?
Well, so when you see, if you got invested in a strong fundamental company or a bank, and if there are certain concerns which is there in public domain, known to you and me in terms of the recent, news flows, there are going to be issues in terms of underperformance. But from a long-term point of view, if you actually look at the track record of the bank, it has never disappointed long-term investors. And since this investor is having a long-term view and has been invested over a period of time, so from a short to medium term, it doesn't matter whether the stock is down from your acquisition price. If you're a long-term investor, we have a positive coverage on HDFC Bank as a disclosure, and I would request him to continue to hold on.
Okay. Continue to hold on there. But on the technicals, HDFC Bank, what's your view, Vaishali?
In fact, I would recommend a buy to those even who have not got this stock right now, because since 2 days we are seeing that private sector banks as well as the PSUs, they've now started getting into momentum, and these stocks have really not participated in the recent up move last year also. I mean, they are at a deep oversold zone, and I think it's time for them to participate in the rally whenever Nifty has to take a U-turn. So I would say that yes, continue buying HDFC, ICICI. These are good stocks. When going is good in the banking sector, this will give good returns.
Okay. That's a word coming in there on HDFC Bank on the technicals as well. But on that note, we're going to slip into a very short break. But here's some good news for our viewers, right? India's business news leader is now a click away, introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on the screen. Welcome back to your stocks in CNBC TV 18. We still have with us Gaurang Shah of Geojit Financial Services as well as Vaishali Parekh of Prabhudas Leeladhar. Nifty as of now continues to hold on to 23,960 levels. Not much of a move there. But keeping it going with your stock-related queries, the next query for today is coming in from Ram Iyer, who's writing to us from New Delhi. He's asking if he can buy PNB at current levels. Gaurang, your view coming in on PNB, is it something that you would be looking at in the PSU baskets as of now, or would there be some other name?
Well, so Vinny, PNB happens to be in our positive coverage, but since the question is whether he should buy PNB, and since he's not bought, there are options available. In fact, in the PSU bank stocks like, for example, State Bank of India, our largest bank, numbers on one or two fronts were tagged below expectation, and the stock has corrected. We find there is a lot of opportunity to get into it. Bank of Baroda, Bank of India are the other two names that feature on our positive side, but PNB is also there. So if you have a little bit of elevated risk appetite, you can definitely go for PNB. The reason why I say this, Vinny, is because numbers for PNB are both ways. Some quarters are extremely positive and some quarters are a little bit disappointing. So the choppiness and volatility is a little bit higher in PNB.
Okay. That's a word coming in there on PNB on the fundamentals, but on the technicals, what's your view? Are current levels attractive to enter PNB, or Vaishali, you are looking at some other names as well on the PSU basket side?
Well, of course, it's a problem of plenty, but yes, PNB is one of them. And if you have to buy, I would recommend a buy. 97 is the support level, and that's what we have seen the stock bouncing back from those levels. So I would say keep accumulating, because our target, even as a trading strategy, is around 120 and then 140. So yes, this is one of the stocks. And besides this, of course, it's Canara Bank, Indian Bank, and SBI, of course, to start with. So I would say it's good to have a basket of these stocks.
Okay, that's a view there on the technicals as well. Let's move on then to the next stock. We have Bharat, who's writing to us from Mumbai. He's holding and asking if it's a good time to actually enter Amara Raja for the medium-term perspective. Amara Raja batteries, is that the one you would look at on the auto ang side, Gaurang?
So yes, Vinny, we have a positive coverage, and we as a brokerage house believe, I think that if one is positive on the auto sector, Vinny, then you need to also keep your eyes on auto ancillary, tire and battery manufacturing companies. And with the kind of push that the government is planning to do with the EVs and the innovation that some of the battery manufacturing companies have lined up, long term, not medium term, Vinny, of course, I won't give advice to get into Amaraja mobility from a medium term, but long term, yes, definitely we have positive coverage.
Okay, long term, you have positive coverage on this one. And on the technical front, good time to enter this one, Vaishali?
I would say so, actually, because again, same story, 1800 was the high, and then we see a good corrective move. So right now it is on a road to recovery. I would say keep buying with 800 as support. And there is a technical hurdle at around 900, 920, which is a cluster of resistance levels. Once you see the stock moving past that, this can go towards 1050 to 1200 levels. So yes, this is a good buying opportunity.
Okay. That's the word, buying opportunity there that you can look at is Amara Raja batteries. Next query for today, we have Anuj, who's writing to us from New Delhi. He's holding 1,000 shares of Phenol-X cables, and he's bought it at 1,000 rupees per share. So making a little bit of profit on this one. Short-term view and short-term targets for this one, but he's also asking if it's a good decision to hold it for the long term as well. He wants short-term targets, but long-term story, is that intact? Gaurang, on the long-term story, what's your view?
So first, my humble request is don't sit on the fence. Either it is long term or short term, right? So long term, we remain positive. Yes, this sector, Vinny, has seen elevated levels of new competition coming in. But at the same time, we strongly believe that the Indian market, as far as cables and wires are concerned, the opportunity is huge. And there is plenty of room for all the competitors to coexist together and complement each other. Continue to hold on from a long-term point of view.
Hold on from the long-term point of view. And Vaishali, your view, short-term target is also what they're looking at, and long-term also. They're making a little bit of profit from their buy price, but targets for both of these.
So definitely to start with short term, 1020 acts as a near-term support. It's currently at 1069. Short term view is the target. Look for a target of around 1150. And if you're looking at longer term perspective, once we see the stock going above 1150, it opens space for 1350 and so on. So yes, this is my view.
Okay, we'll keep an eye out on those levels over there. Let's move on then to the next query for today. We have Subramanian, who's writing to us from Bangalore, holding 49 shares of Suryodaya Small Finance Bank. Prices 305 rupees per share. Wants to know the long-term view on the stock, asking if he can hold, sell, or even look to add more. He's bought it at 305, very high price, so making a significant loss on this one. Gaurang, your view?
So first of all, my advice is try to limit your losses, because if your investment goes down 30, 40, 50%, 60%, then the recovery of your capital becomes a big question mark. Forget about making profits on your investments. No specific comments, Vinny, on this one, because we don't have coverage, but we do like certain small microfinance and related companies, for example, AU Small Finance and Credit Access Grameen.
Okay, that's a word there coming in on the fundamentals, but on the technicals, what's the view? You know, is average an option right now for Suryodaya Small Finance Bank, especially?
So I would say there's no damage to the trend. I mean, we've seen the corrective move, but currently, as per the current scenario, 150 should act as a support. The view gets negated below 150. So I think you can average it out, keeping this in mind. And I think the target that one can look at is 190 to 220. So I guess at least you can lower your cost and get returns if possible.
Okay, lowering your cost, that's the suggestion there, right? But that's the last query for today. So Vaishali as well as Gaurang, you know, thank you so much for joining us as always, helping answer all those stock-related queries our viewers have sent. And, you know, thank you so much for joining in this afternoon. But in terms of the markets, where is it? 23,960, not moved from that level as well, right? Since we started the show, 1% uptick, it continues to hold on to that. But individual names, what's done well in the last 30 odd minutes? Sai Life Sciences, that's seen a bit of an uptick. We have Jupiter Life, that's seen an uptick. AstraZeneca, so some of these pharma side names have seen a bit of an uptick coming in the last 30 odd minutes. So that'll be something that we'll keep an eye out on. While in terms of the trends for, you know, sectors which are doing well and not doing well, pharma again has moved back to the green. So watch out for that one. Now it's again switched on the green side as well. But with that, we're absolutely out of time on this edition of Your Stocks. Thank you so much for tuning in. Last hour of trade is still left. And for that, you have closing bell up next.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
For most of the markets that are open, it is a positive tilt.
The goal here ultimately, the ultimate goal is that Iran can never have a nuclear weapon.
Is it getting better? And if you look at prices, it looks like it is getting a little better. The Nifty Bank is up about 1.3, 1.4.
Profit has seen an increase of 12%. Revenue was higher by 16%.
You have heating oil, gasoline prices trading at a 4-week lows as well.
Estimate is Q1 to Q4 will be another 5% increase.
A new week with a renewed hope of peace. The market's reflecting that.
I think this comment was very much required. Maybe we will need more of reinforcing of that comment, which followed by the action.
We are looking at a double-digit growth, but what is the percentage is something that we have to wait and see.
And the high crude prices are ever changing. It's seriously dynamic.
The session, we're actually seeing the market hold on to the gains, advance decline ratio in favor of the advances.
Well, that is the day so far. Markets so far holding on to the gains of the morning, 260 odd points. That's the Nifty, but there's enough and more action in the broader market space as well. We are coming to you from the CNBC TV 18 Motilal Oswal studios. This is Closing Bell, last hour of trade coming up. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good afternoon.
Hi, afternoon. And it's good to see the banks providing that leadership. While frontline indices are up more than 1%, and the Nifty is very, very close to that 24,000 mark. It's held steady. We had a gap up opening. We built on it. The high today was 23,995, and we are pretty much there. 250 points up on the Nifty. Sensex up nearly 900 points. And the Nifty Bank, that's the one. It outperformed on Friday with a gain of 1%, and it's added on a near 2% in today's rally. 55,000 is the ticker on the Nifty Bank.
Well, that's right. Actually, it's quite a good-looking screen, right? We started off with gains, and we've only built on from there. Number of stocks advancing better than the number of stocks declining, and the rupee, some strength out there. So all in all, a good start to the week. And as we pointed out earlier today, the FI participation could be relatively lower today because there are a couple of markets that are shut. That said, what should you do from here on? If you were brave enough to buy into the volatility in the past week, what should you do right now? Mitesh joins us to help us out with that answer. Hi, Mitesh. Good afternoon. Good to see you win. Markets holding on to gains. We're a little shy of the 24,000 mark. But what's good is both the Nifty as well as the Nifty Bank, they've taken out the 20 and the 50 DMA. What next?
I think, very clearly, the market has, managed to get past the 23,800, 850 zone, which was a very stubborn kind of a level. And while, the gains today on the Nifty, after the gap up, there hadn't been much gains, but the Nifty is sustaining. I think that's very important. So my sense is that there's a mild pivot at 24,100 spot once that is cleared, but the overall view is that we are heading towards 24,350, 400 to begin with, and in a good case scenario, we were 24,600. So the immediate directional bias remains on the upside.
And on the Nifty Bank, today we've crossed the 20-day moving average. We've crossed the 50-day moving average. What's the next level?
Yeah. Similarly, like the Nifty, I think the Bank Nifty also, was getting it tough to get past 54,500. It's doing that. I think I'm looking at a target of around 56,000 to about 56,150 on the Bank Nifty. So again, there's some more trading upside left over here.
What about stocks, Mitesh? What are you recommending? 1 hour to go?
Yeah. One is Tata Motors personal vehicle, which is TMPV. That's a buy with a stop at 367, targets of around 388, 390 on the upside. And the other one is Zydus Life, which I would recommend buying with a stop below 1,050 for targets of 1110.
Got it. Okay. All right. Thanks a lot for that, Mitesh. We'll come back to you for another call at around 3 p.m. odd. Well, Hindalco, that's the stock in focus. The stock is a little under pressure, though it's recovered a goodish bit from the lows of the day. First, what did the management say to CNBC TV 18? We spoke to them earlier today. They said everything positive. Aluminium prices should hover around $3,500 per ton, though they mentioned that the next year the street is actually factoring in lower prices. They said the rupee depreciation is good for them. Costs are in rupees, sales are in dollars. That helps them out. The input cost, they said in the past quarter it was up by close to 2.5% in quarter 4 on a sequential basis, but will also increase by 5% on a quarter basis in quarter 1 FY27. So you have a listed stock like Grain Industries that spiked up because they are the one that makes CPC as well as coal tar pitch, that's CTP. So explains why we're seeing some excitement on that particular name. Aluminium EBITDA per ton in quarter 1, they said, will be better than quarter 4, which is already elevated at $1,750 per ton. So they're citing that prices are up, input costs are up, but higher prices will offset the higher input costs. So they're guiding for better times ahead. The copper quarter 1 FY27 EBITDA as well will be as good as quarter 4 FY26 EBITDA because they have a byproduct, which is sulfuric acid. Those prices will drive the copper EBITDA in the near term. So from doing around 650 crores odd, now they're bracing for around 900 crores on a quarterly run rate, which is good. But you'll say everything is good, then why is the stock down? Let me pull up 4 reasons which could probably be weighing on the stock. One is since the onset of the Middle East crisis, you have Hindalco that's up 20%. The metal index itself is up 8.5%. So that's point number 1, giving back some part of the recent outperformance that we have seen. Second, yes, they'll gain in terms of higher aluminium prices. However, 29% of their FY27 volume is hedged at around $3,013 per ton. That's a little bit higher than what the management normally hedges, around 25% of the volume. So they won't get the full benefit because 29% is hedged at a price that's lower than current levels. Point number 3, various brokerages, well, they like the numbers, but they're citing various reasons why they can't go ahead and be even more positive from here on. Jefferies has a hold rating. They remain concerned on the multiple fire incidents that have occurred at Novelis. They also find risk-reward unfavorable now at current elevated aluminium prices. And they're saying valuations are not cheap. The stock trades at around 1.5 times price to book, and the ROE is around 15 to 16%. So the ROEs are higher than what the historic average has been, around 11%. But on a price to book basis, at 1.5 times, it's higher than the sub 1 times that it normally trades at. Citi, they have a neutral rating. They have a target price of 1,170. They're saying there's limited upside from current levels, and that's why they're keeping the neutral rating. Kotak, they have a reduced rating on the stock. 1,100 rupees is their target. They say execution risks remain in the medium term. And finally, MK went ahead and they downgraded the stock to add from buy. They say valuations remain relatively demanding. So brokerages, though they like the numbers, they're finding reasons why they can't get even more optimistic from here on. And point number 4 is the war premium can reduce on aluminium. Because if the war is called off, then that premium that is being priced in, that will get called off. However, the fundamentals remain strong because the deficit on aluminium is likely to continue since those smelters that have got hit, they could remain shut. So commentary was good, numbers were good, but maybe valuations run a little ahead of themselves and the stock has outperformed. So that's why it's giving back some part of that outperformance. Let's, in fact, let's play out that bite. I spoke to Mr. Satish Pai, the MD of the company earlier today. He told us about how he sees aluminium prices shape up, as well as how input costs are spiking up.
Nearly 2.5 to 3 million tons of Middle East aluminium has gone off the market. So I think that it'll be fair to say for the rest of this year, we are looking at an LME that could be in the 3,500 range. But you can see it's in a very steep backwardation. So next year prices are $400-500 less because people are expecting that Middle East aluminium will come back on the market by the end of this year. So input costs are going up. Q4 to Q3, the costs were up 2.5%, and we are expecting another 5% increase Q1 to Q4.
Okay, let's get in Deepan Mehta, Drexel Alexa Equities, who joins us on the show. Hi, Deepan. What do you make of Hindalco? 20% run in 3 months, outperformed not just the markets, but also the metal index. Numbers look good, but the stock is down close to 0.5% because it's had such a big run. What's your view on Hindalco? And if you have any view on a stock like Grain Industries, that's up 14-15% after Hindalco's commentary on CPC and CTP prices.
Janaji, good afternoon and thank you for having me on your show. I think I saw a coverage on Hindalco, but I think what was missed is the massive expansion coming on stream over the next 2-3 years or so, and that should support very strong volume growth. And many of the expansions coming in Hindalco, the Indian operations, and Novelis as well. So I tend to think that when I look at the complete picture, that Hindalco's earnings may positively surprise for the next 2 years or so, maybe not like a straight line every quarter, but you'll have some fantastic quarters also in the next 2 years or so. And whatever decline which we may be factoring into the prices will more than get covered up by the volumes. And basically the company is becoming far more efficient also, as I understand. So I would remain invested in Hindalco and look at maybe buying opportunities if there's a correction. And that can certainly happen, I think, if the sentiment for aluminum metal just becomes negative post-war, then it's a good entry opportunity at that point of time in Hindalco as well. But I think it's a good story for the next couple of years or so.
But you would not buy fresh, right?
Maybe at a correction, maybe a 10% correction or so could be a good entry point, and you would have some at least margin of safety, and the risk return profile would favor you.
Okay, all right. And just on Hindalco, as Deepan said, they'll get volume growth, but volume growth will be coming in only in FY28 for the India business and then FY29. For FY27 will be more or less flattish because Bay Minute will come only towards the end of this year. That is for Novelis. The India business is already at optimal levels. But let's focus on the Royal Enfield, thumping along in today's trading session. The top gainer on the Nifty, Sudarshan joins us to break those numbers down for us. Sud.
So it's been a good day for Eicher Motors after Q4 FY26 earnings were largely in line. Revenue growth has come in at 16%, aided by the volume growth that company has seen of 12%. There were concerns related to the margin that company may disappoint on margin front, but margin too has come almost in line with expectations. Our expectation was 24.9%. Company has reported 24.9% as well. But the incremental move in the share price has been seen mainly on the back of the commentary that company has given on mitigating the margin impact on margin from commodity price increase. So in Q4, because of commodity price increase, margin impact was 90 basis points, mitigated by the price increase that company has undertaken. For Q1 FY27, commodity price increase is going to be significantly higher. It's going to be in the range of 3 to 3.5%, of which 1.75% price increase company has already taken. For remaining part, it's going to take certain measures like cost control and something else. And because of that, it believes that entire impact of commodity price increase can be mitigated. Second concern was if you go and look at the Wagon data, there were concerns related to the volume for the month of May. It was underperforming the peers. On that, company has said that they were facing certain issues related to manpower and LPG shortage. And because of that, production was lower against the previous few months. And that's the reason that this month data can be, or retail data, even wholesale data can be lower against the same month last year. On that, company is saying that that issue is almost resolved. So these were the major two reasons why that has provided the incremental move in the share price. And also company is looking at the capacity addition. It has already bought the land parcel in Andhra Pradesh, in Tirupati, and also in Chennai plant also it's adding the capacity. So because of inline earnings, but the incremental move has come mainly because of the commentary, and today it's seeing a bullet move.
Bullet move. That's rightly put. So thanks very much for that. Deepan, any thoughts? Aisha, it's like huge, big wealth creator over the years and continues to dominate basically created the category and continues to dominate it.
Yeah, that's right. And I could add a couple of points to your coverage. One is that the market share of Aisha Motors for March quarter is back to its all-time high. See, the stock was underpinned for a few quarters when it saw emerging competition from Harley Davidson and some of the other players. But now the category also has grown, and Aisha Motors' market share within its category and overall motorcycle market has gone back to its all-time high. That is point number one. Secondly, I think the focus is on exports. Already in many of the countries, it is one of the top 2 or 3 producer sells the highest number of top 2 and 3 in terms of volume in some of the export markets like Brazil, maybe USA as well. And this rupee depreciation is going to certainly give a great fillip and a boost to export volumes. And once export volumes start to pick up and gets established over there, then, that's another growth engine for Eicher Motors. So I'm very positive on the company. I've always been so. Nigel knows about it. It's a company we've invested in for the last almost 20 years or so. Again, usual disclosure. And it's been a great value creator and continues to be amongst the best and fastest growing company within the Nifty.
What's your entry price, Deepan, in Aisha?
It's more like 170 or so, but that's a long time ago. It's a 50-bagger stock for us. But you have to wait patiently for it for a very long time and resist the temptation to sell when the chips are down.
Imagine I've been enjoying the ride, Deepan, on the bike, and you have made all the wealth. But some things I think, don't want to sound like the grapes are sour, but some things are, you just enjoy the ride all across the coast, South India, North, etc., all over.
Even I have enjoyed the ride.
Yeah.
And, so what can I say? I mean, if I may just take a minute to explain what happened over here.
Yeah.
So actually, many investors bought, whoever bought 15 years ago, we all bought because of Volvo tie-up. And Volvo has become such a small portion of the business, and it's the Royal Enfield which has done so well. Nobody expected when you looked at the stock 15 years ago, 20 years ago, nobody expected that this would be a kind of story in Aisha Motors where the Royal Enfield motorcycle would do as well. It was all about, the Volvo tie-up and how they would take on Ashok Leyland and Tata Motors.
It's like, the the one and only Rakesh Jhunjhunwala bought Titan. Titan was still making watches, right? And of course, I mean, then that portion of the business became very small, and it's of course transformed into something else. But of course, I mean, you got to stay with it through the transformation, and that's where the wealth has been created, no doubt. 270 points, 275 points, 23,994 is where the index is trading at. Let's just address one more space. Titagarh and Jupiter Wagons, both are doing very well. And looks like there is a big tender which the government's going to come out with. Vinny is joining in with details. Vinny, take us through it.
Hi, afternoon. So in terms of obviously the railway orders that they're expecting, this is according to a Mint report that around 40,000 crore wagon tenders are expected to come in. That is around 1 lakh freight wagons planned over the next 3 to 4 years. So big opportunity that comes in for Titagarh Rail, Jupiter Wagons, Texmaco Rail, all of them. Now, annual orders expected out of this is going to be 35 to 40,000 wagons. First order is expected as early as Q2 FY27. So we'll wait out whether this actually comes in during that time. Now, like I mentioned, these beneficiaries will start seeing some improvement coming in terms of order book. But let's look at the order book or what is coming in terms of order book in Q3, Q4 so far for them. Texmaco, they reported around less than 10% of the total order book in Q4 was for freight railway order book. For Titagarh, they've not yet reported their numbers. Numbers are expected on 30th of May. 25% in Q3, less than 25%, around 25% was the order book for freight railways. And Jupiter Wagons, it was around 35%. Now, especially for the themes of wagon, what is a concern? That in the last 1.5 years, wheel set issues, that challenge still continues, right? So we'll wait out for more commentary that comes in from Titagarh Rail in terms of their numbers on 30th of May, whether that has actually gotten sorted out, because last time they highlighted that in April, they would start some productions of these wheel sets. Without that, their execution has been slower because of this, all these railway companies. So that will be key to watch out for from here on. Even if these orders come in, what's going to be the pipeline for wheel sets, which are availability? That's the major issue. But as of now, thumbs up if these orders actually come in and wheel set issue actually gets sorted out.
Thank you very much for that. Dipan, railway stocks?
I think long overdue in terms of the order flow, and railway companies have been kind of underperforming in terms of at least the financials for last 3-4 quarters or so, and this will certainly be a shot in the arm. Companies like Titagarh and Jupiter will benefit also from increased proportion of revenues coming from metro, because expansion of metro network across India is growing very well. And both these companies have these kind of aluminum wagons which go into the metros as well. So that also, I think, works very well for these two companies. So generally positive. I think they are retracing loss count. They are covering the underperformance of the last few quarters or so. And if this order actually happens, then it'll give very good earning visibility to the entire industry.
Deepan, what about these other two names, Sterlite Technologies and HFCL? They have been the stocks of the past 35 days or so. Not stocks for the faint-hearted. At times, we've seen these stocks see a sharp correction. But what a spectacular rally. Your view on them, missed the bus, or there's still room to get on?
I think Sterlite Technologies is on our radar, and we are studying it quite closely and trying to understand the data center opportunity for both these companies. And that certainly is a big one. And I think the companies have pivoted towards also exports and data center market. Valuation-wise, also still reasonable, but somehow, on corporate governance standard and all in terms of volatility of earnings is something which one needs to understand better. So, I mean, we're looking at these companies closely, but not yet got to a point where we feel that they are thumping buys and looking at entering at these levels also.
But it's up 350% since the start of the year, more than 500% in the last 1 year. And just over the weekend, the company announced an order win of $1.1 billion. That is nearly a 10,000 crore order for building AI data structure infrastructure for a US hyperscaler. And in the conference call, what the company said, this is Q4 conference call, they said that data center plus enterprise is about 19% of their revenues today. And that will go up to 30% by the end of FY27. So that's a sizable increase. They haven't given the split between data center and enterprises, but that is clearly the narrative which is dominating Sterlite Technologies, and it's showing up in the numbers as well. So if you see the order inflow for the company last year doubled, and even the contribution of North America, which is where the entire data center play is, that has also gone up significantly. So that's Sterlite Tech, active today because of that very large order win of $1.1 billion. Dipan, we'll come back to you once you've done the studying of Sterlite Tech. The other one is Anupam Rasayan and Bliss GVS Pharma. What have you made of this acquisition?
Well, I think it's a great acquisition for Anupam. And, at some point of time, once the integration takes place and valuations are reasonable for Anupam, because numbers were quite disappointing for Anupam Rasayan. But once we have a better clarity on the assimilation of both businesses, I think it is very positive. And I think Anupam is getting transformed into a more of a complete, specialty chemicals pharmaceutical company. And that certainly will give a great deal of, I would say, certainty to their earnings. But as I said, I think valuation is a bit of a barrier at this point of time. But I think that it's a great buy for Anupam Rasayan. I mean, I'm surprised by the Bliss GVS management sold off, especially when the company is doing so well.
Yeah, Rima, though, just one point on Sterlite. I think Sterlite has gone from
300 to 470 in 30 days.
Yeah, but I think it's gone from 100 to 400 basically this year. Right, I think. I mean, I remember looking at this. So actually, the 5% today, the $1 billion order, the stock. I mean, if you step back a little bit, the 4x move is on the back of the $1 billion order. It's just getting confirmed today that the order has come. I mean,
it's just confirming the AI data center narrative.
I mean, so it moved from 100 to 400 because of the pivot to data centers away from telecom. And that's how it works. I mean, it didn't move for nothing, right? I mean, it didn't move for. So I'm just saying that a $1 billion order has come now, and it kind of sort of locks in the reason why it went up 4x. So it is fresh news in that sense, but the price has already moved. That's all I'm saying. So if you're looking at this, getting excited, it's great news, and maybe we'll get to see more orders, but the price has already moved. So you must remember that. It's not about where the news flow is now, but where the news flow will be 6 months, 12 months down the line. That is what markets are trying to figure out. And in that sense, we've already seen a large move.
And besides the fundamental news about the data center and the other, fundamental news on it, the promoter entity went ahead and they took warrants on convertible. It'll be close to around 5% of the warrants at close to around 110 rupees. So if you just pull up the year-to-date chart, at the start of this year, the stock was in that vicinity. The promoter entity coming in and putting in money, and as I always say, when it's the Vedanta group, just keep an eye out on what the promoter is doing. And when they are putting their own money in there, that's when the stock actually took off. It was around 80 to around 110 rupees.
Sometime in February when they had announced, and they had announced 110 rupee warrant conversion.
All I'm saying is, for viewers, they need to be careful that the price is more. All the news flow is, etc., coming now. So I'm not saying it can't do, well from here, but it's moved because the order is a confirmation of why the price moved in that sense. Any thoughts, Dipan? Sterlite, HFCL, these are all this sort of play into data centers and their entire AI trade.
You could even add MTR Technologies to it. I think no stopping these companies. I think massive investment in data centers in India globally as well, and very few direct stories from an Indian investor's perspective. I think we can't buy Nvidia. We can't buy any of the Korean or the Chinese companies. So we have to work around like this only when it comes to data center as an investment theme. I mean, there are very few choices available over here.
Yeah, that's the critical part. Very few choices available here, which is listed here. Lots of stuff outside, though. Just one more name, if you will, Dipan. I don't know if you've looked at this one. Barbecue Nation. it's gone up, I think, about 130-140% this year, Barbecue Nation. Still a long distance away from where it was. I mean, a high was about 1,900. Stocks are about 500. I don't know if you've looked at this lately, Deepan?
No, Prashant, I think the entire quick service restaurant space and the restaurant chains like Barbecue Nation, I think there's specialty restaurants also, the Chinese restaurant company, all of them have just fallen off the radar since we have seen the emergence of Swiggy and Zomato. And their business models have been completely, kind of stressed out because of the kind of choice that Zomato and Swiggy give to its users. And there's more and more ordering in because of the convenience. So I would be a bit skeptical about the long-term prospects of both these companies. And it's a very tough business to ensure that you have the right restaurants in the right place. And now I think they'll have to deal with higher inflation as well. Maybe consumer sentiment also may get a bit dampened because of, what is happening in the Middle East. So I'm a bit skeptical about all these quick service restaurants as well as all these restaurant chains. And I would rather place my bets with the likes of Swiggy and Zomato. Having said that, Eternal is a company in which we and our clients are invested, so our views could be biased. But the entire industry has been disrupted by these two companies. And now they've got quick commerce also. That's another industry getting disrupted by Swiggy and Eternal. So I would say that I would prefer to go with the disruptors rather than the companies which they're disrupting.
Barbecue used to be, quite popular at one point. I think it's still popular. Maybe it's, I think pioneered the live grill at your table kind of concept, right? Eat all you can concept and across the restaurants. But you're absolutely right. I mean, there's the macro larger overlay that Swiggy, etc. has opened up the choice. So all these individual brands have suffered maybe, but along the way, each of these businesses perhaps also see, I think that's what's happening with Barbecue Nation. Maybe they're, at least that's what I understand, that some new strategies, the CEO is looking at it to try and turn things around. And at the margin, it does make a difference. So it's come off. I mean, of course, I think Barbecue was the biggest bombed out name, even in the bombed out QSR space. So in that sense, from the lows, it's come up from about 170, 180, it's come up to about 500 odd rupees right now. Deepan, thank you very much for joining us. Campus Activewear numbers are at the bottom of the screen. 18% margins compared to 17.6%. And revenue numbers and profit numbers, etc. will all are there as well. 26% growth in profits. And I think revenues also will be coming up right now. Revenues are up about 12%, a modest 12% growth. Time for a quick commercial break here. We'll come back with Deepak Shenoy of Capital Mind Mutual Fund on the other side. Stay tuned. Okay, welcome back. Markets are up a little more compared to where we were when we started, closing bell. We're up 315 points. So now we're at the day's, almost at the day's highest point. 24,036 is the high. We're about, we're there at the high point. The Nifty Bank is also up at the day's highest point. It's a full 2% gain for the Nifty Bank. And the mid and small cap indices, let's just sort of do a quick recap there. Not at the day's high for the mid cap index. And I think for the small cap index, we are up 1.45%. Yep, we are at the day's high here as well. So as we wrap up things, the market's holding on and maybe adding on a little bit more to the strength so far. Deepak Shenoy is with us of Capital Mind Mutual Fund. Deepak, hi, good afternoon. Slightly here and now question. US markets are shut tonight. There's still a lot of back and forth and around what will finally happen with this US-Iran thing. So maybe the mice having some fun when the cat is out? Or what's your sense?
This is an interesting part. You know what? If the the problem with the current markets is that we're driven more by these tweets that talk about, oh, we'll close this, we'll not close this, the deal's happening, the deal's not happening. Price of crude also jumps like $5 up or $5 down or $10, and that's more impactful on some form of the equity markets than anything else. But I feel there is genuine fatigue right now in pretty much the war rooms also. There isn't any meaningful reason why, America should go back to war, put troops on the ground or do whatever it is that might be more harmful. So at best, either it's a phased withdrawal from the war or it is a deal that suddenly ends the war. Either ways, this seems to, all parties seem to want to at least disengage from this whole war scenario, looking for face-saving exits or whatever it is. But if you look at the, the implications on markets, that means oil prices should come down by the end of the year, that things should get more normal in terms of supply, the disruption should go away. There are some big IPOs planned in the US on the AI/space front in the next few months. There are those that potentially can cause changes to existing portfolios in America itself. Within India itself, I think a lot of the earnings visibilities would get better once once this thing is kind of behind us. So in that sense, I think more forward-looking. End of the year to next year, I'm probably more bullish or in a way more confident that things will return. But in the near term, you can't predict. So, one day will be up 1%, another day will be down 2%. It's just, more temporary reactions than something permanent. Because neither you nor me can say what one side of the fence will tweet and therefore cause a change in sentiment on both markets.
Yeah. No, you were saying that there is fatigue in war rooms. There is certainly fatigue in newsrooms, Deepak, tracking this, not just on weekdays, but sometimes weekends as well. Thankfully, that's not been the case recently. Deepak, tell us, how are you sort of thinking about generating alpha? It's in your fund, in the mutual fund side, for example, right? What are you got to do something different, right? I mean, actually, everybody's got to do something different because otherwise you'll all hug the index in that sense, as they say. So what is the thought process and how are you kind of sort of driving it at Capital Mind?
So we're doing something, and what we're trying to do at Capital Mind, Prashant, is just adopt a quantitative approach where the data actually tells us where to go. And interestingly, the data does not look negative. In fact, all the data that we're looking at on the ground actually looks quite positive. If you look at earnings, which is one way to look at how we're doing, this March quarter has been one of the outstanding quarters in terms of performance. Median Nifty earnings performance is more than 15. In fact, if you look at the median stock performance on the Nifty in terms of profit growth, Nifty 500, that is, you're still talking about 18, 19%. You're looking at small caps, you're still talking about, again, 19%. The large caps are doing relatively badly in terms of profit growth, and that still means 12 to 13% on profit growth. And the mid caps are actually doing about 20% on median earnings growth. So there is a reasonable return to earnings growth that's happening. You're looking at credit growth from the banks and the macro side of things. Credit growth is above 15% on industrial credit from banks, which is the highest since 2014. You're looking at capex coming back into the picture, which is something we haven't seen for nearly 10 years now. We're seeing overall consumption not getting hit too badly. There is some microscopic hits, but not as bad as one would have assumed. With 2 months of potential LPG supply shortages and so on, there is not that much of an impact on the economy. We're not looking at none of the near-term data sources from a macro or from an earnings perspective gives us room for negativity. Our algorithms are actually, asking us to invest more than less. So in that sense, that way it's a positive.
But you have 30% cash, Deepak?
Not anymore. In fact, end of April, which is the last fact sheet that we've released, we were at about 15%. In cash. We had reduced from 30% to 15%, and investments keep happening on a regular basis. So the numbers will keep changing, but suffice it to say, we have invested more. There are reasonable opportunities in the markets. Even in these times, some of the defense stocks are actually up 40 to 50% even in the last 2 months. So I think even in what are relatively bearish times, you do have opportunities that can give you alpha generating returns. And to that extent, there is, I think there will be more opportunities coming along as well. Specifically industrials, specifically within those areas, manufacturing and defense. These are areas which I think even fundamentally show a very, very strong picture. Some of the commodity players are actually showing good moves. There is a lot more interest now in some of these names, and even the names themselves are diversifying, whether it is some of them moving to, say, data centers, some moving to semiconductors. There is a lot more action happening on the ground, and these capex opportunities are actually going to bring in perhaps results in the future. So both ways, I think there are pockets of opportunity. As a broad market, I think we still have to live through these, lousy global macro news times for at least a few more months. But in the long term, I'm reasonably positive that India will do well.
Fair enough. But although these lousy macro headlines has not really kept us from doing what markets want to do, right? Earnings are being rewarded. And as you said, so many things are up 40, 50% in short order. So yeah, I mean, that makes you wonder, when the war ends, what will you see? Maybe you'll see a big bout of short covering, maybe 1,000 points, and then you halt there. I don't know. But it's not as if the war itself has kept markets very, very depressed or anything.
It's foreign investors selling that's kind of countered all the buying by domestic funds to that extent. And I think, a lot of the news is kind of saying that, it's the SIPs that have caused foreign investors to exit. The point is about freedom is when you get freedom to exit is when you get freedom to enter, you want to enter something that you can exit easily. So in the long term, all of these mechanisms will kind of play out against each other. It'll attract more flows eventually. These are, 2 years ago, India was the best place to be. Today, India is the worst place to be. Tomorrow, it will change. The story is always somewhere in between. There will always be some players that will give you really outsized returns. And it's our job as fund managers, and perhaps all our job collectively as investors, to find and reward them for future earnings growth. Yeah.
Okay, all right. Deepak, we'll leave it there. Actually, that's the topic I wanted to bring up, but that needs a full, people are blaming SIPs. But, it requires longer time. Maybe we'll do that. Thank you very much for now, though. Appreciate your time here on CNBC TV. Deepak Shenoy at Capital Mind with a perspective there. Well, let's look at technicals and the F&O data. Nigel, take it away.
Well, it's a beautiful trading session. The setup was good today, and the Nifty's gone ahead and conquered this crucial resistance mark of around 20 and the 50 DMA, and that should come up for you on the screen. The Nifty Bank as well, we had mentioned earlier today, it was 500 points away from the 20 as well as the 50 DMA, and it's taken both of them out. So that's good. Mildly so, but it's taken that out. The PCR has moved up to around 1.2. Remember, we have the monthly expiry that plays out tomorrow. And the bulls, they feel that they're back in the game. Remember, after today's move, actually for the series, we have turned mildly positive, because otherwise we were actually negative for the series, both on the Nifty as well as on the Nifty Bank, which is good going. And the broader markets have actually outperformed. So your portfolio will actually be feeling good. Take a look at the 24,000 put. The premium out there has come down to around, close to around 100 rupees approximately, from around 312 rupees. So that's a sharp decline that we're seeing out there, as is the case with the 23,900 put as well. The premium has come down sharply. Now, going by both the kind of writing that we're seeing at both these two strikes, the 50 DMA now becomes a bit of a reference mark on the downside, because that's where we were seeing some bit of resistance, ballpark around 23,650 to around 23,700. That's going to be important. But in case really the war is called off and things get back into full mood for tomorrow, some bulls are going ahead. They're taking a bit of a punt. They're buying the premium at around, the 24,300 call. It is around 13 rupees. So all you lose is around 13 rupees. But in case the markets go for that 500,000 point rally, then you make good money on that out of the money call. So that's why you're seeing some kind of out of the money call buying. Keynes has been a big underperformer this series. That's coming for a bit of a short covering bounce. So the open interest is lower. There are some short rolls as well. That stock is up 3%. Inox Wind is the other one that is seeing a bit of a short covering bounce in trade. While Eternal, a stock that's corrected close to around 30% from the recent peak or a little more, that's seeing actually a bout of fresh buying. Big buying in the cash market, delivery-based buying, and there is some fresh long build-up as well. So net, F&O positioning looking good. And when you have a net short market, it's a blessing in disguise, going home at the highs of the day. By the way, keep an eye out on the bottom of your screen. Suzlon's numbers come in there. Net profit number is mildly lower, but the revenue number has moved up because execution is likely to have picked up. So it's up close to around 45%. And I saw some margin expansion as well. Top line growth of around 45%. EBITDA number up 67%, telling you there is margin expansion. So something below the operating profit could be the cause that the net profit actually hasn't grown that much. But otherwise, the street is applauding these numbers. Stock up 2% as we speak. Slip into that short break. You come back. Mitesh is waiting for us. He'll tell us what to buy today for a reverse trade in the coming days. Stay tuned. Welcome back. Well, let's get in Mitesh Thakkar from Bonanza Portfolio, who's joining in to give us a couple of his fresh trades. Mitesh, take over.
Well, a lot of individual stocks have given some moves on the upside, along with the fact the market is done well. So I think we'll go with long positions or BTST calls. So 361 is the first stock. BTST with the stock group 1130, look for 1160-65 as a possible target for tomorrow. And Adani Energy Solutions as well as BTST with the stock at 1390 for targets of 1425.
Okay. Which is the first pick? We missed that.
361.
361. Okay. Thank you, Mitesh, for that. Let's invite Ambrish Balika, independent market expert, on the show now. Ambrish, afternoon. Thanks for joining in. Strong is getting stronger now. But let's talk about one pick of yours. You always share one, and I think today it's Archean Chemicals. Why is that?
Yeah, it's Archean Chemical Industries, which is a leading specialty marine chemical manufacturer. Largest exporters of bromine and industrial salt. About 98% of the industrial salt by volume is exported by them. They have about 36 global customers in 15 countries, 41 domestic customers, and exports is about 78% of their total revenue. And this business has a lot of entry barrier, which in fact acts as a huge moat for them. And they have an integrated production facility at Hajipir, which is in Gujarat. Have been expanding the derivatives product portfolio, which in fact should start playing out now onwards. In the recent quarters, the EBITDA margins had contracted to about 22%. Earlier, they used to be about 35-40%. The stock, because of which the stock had underperformed, but now it's expected that it should get to those levels of 30-35% by FY28. Alongside chemicals, the company has entered into the semiconductor space through its subsidiary 6M, which is putting up a silicon carbide semiconductor facility at Odisha with an annual capacity of about 60,000 wafers and a packaging capacity of about 96 million units. So next 3 years, expected revenue CAGR is about 20%, EBITDA CAGR is about 42%. So expected EPS for FY28 is about 22 rupees, and with this, my target price is about 660.
Got that. Ambrish, request you to stay on. Let's just get in some more opinion. Envision Capital's Nilesh Shah is vouching for steady growth in the platform companies. The likes of Eternal, Honasa Consumer, Swiggy, all of them are the stocks that he likes. But what's the rationale behind being bullish? Listen in.
Be it Eternal, a Paytm, a PB Fintech, an Angel One, a Grow, I mean, all of them. We pretty much, because we clearly believe, I actually think this is pretty much like the 90s of India, where there used to be this whole new economy, old economy, new economy used to be the IT services companies, but all of us thought these were really the technology creators, the Brahmas, all of them, and they continue to grow at 50, 60, 70% CAGR for years together. And that was a bull market which pretty much lasted for about 8 to 9 years, from the early 90s all the way up to 2000. If I were to kind of really use that as a playbook or some kind of a benchmark, I clearly believe this collection of platform companies pretty much resembles that. Obviously, not across the board you're seeing that kind of 50, 60, 70% growth, but I think all of them are growing at a hyper pace. And all of them have now started to realize the importance of cash flow. So most of them no longer are burning cash. In fact, one of the companies which IPO 2 years, 3 years, Honasa, for example, we own Honasa as well. I mean, while in most of the cases there's somebody selling out here, the promoter is buying, performance has been rock solid, cash flow is positive, and most of all, they're paying out dividend. I think it was a maiden dividend that they declared. Now, these were the complaints which the market had 2, 3, 4, 5 years ago, right? Saying no cash flows, cash burn, all of that. All of that has been put to rest, and it's now growth. And on top of that, prices coming off, I think it's a great place to be.
Okay, all right. Well, I think let's get in Ambrish's view. Ambrish, what's your view on some of these new age themes?
As far as the platform companies are concerned overall, the biggest issue in the market right now is the cost of human resources, which will keep moving up. Whereas when you look at the platform companies, I think they should be able to utilize AI much better. So overall, going ahead, I mean, their costs will keep coming down, and for those non-platform companies in the same sector, the cost of human resources will keep moving up, and that's where I think the margin pressure would be there on the old economy companies, whereas these platform companies will continue to do much better. And if you look at the Gen Z, I mean, clearly, I mean, they prefer platform companies as compared to brick and mortar. So I think the future clearly is there, and we need to invest, and we need to invest and remain invested in these platform companies.
Anything you own there, Amrish?
Yeah, in fact, I mean, Grow is one where I was not too bullish earlier. Now we started, buying into that. The other one which you have is Honasa, Eternal. So these are a couple of them which are there.
Ah, okay, warming up to them. All right, Amrish, just stay with us. I'll take a quick commercial break here, but just leave you with thoughts from Eurasia Group's Pramitpal Chaudhary. I spoke with him earlier on this entire the US Iran situation, and whether this is the real one, the real deal, and after lots of false starts, whether we'll get something done this time around, and what that would mean. Listen and take that break. See you on the other side.
So what we have now is basically a negotiating structure, which basically would initially have the Hormuz Straits opening up, which, as you pointed out, is de facto happening anyway, followed by an interim agreement on the nuclear issue, which would incorporate the question of what to do with an existing enriched uranium and a potential uranium enrichment freeze by Iran. And then over the next 30 to 60 days, a further set of negotiations which will be designed to finalize various other elements of that, including an unfreeing of assets of Iran, desanctioning Iranian economy, and so on. Where we are stuck right now, it seems, is the nuclear issue, as we've been stuck for a while. The interim agreement on nuclear, basically, how much uranium does Iran have to surrender, and how long is the enrichment freeze, continues to be the stickler for the sticking problem in this agreement. What we're seeing, however, and which is one of the reasons why I think the markets are responding so positively, is that for the rest of the world, the real core issue is the Straits of Hormuz and the passage of oil and gas through the Hormuz. That seems to be sort of happening on its own. In other words, Iran is quite happy to allow them through as long as these ships and these governments involved acknowledge Iran's new Persian Gulf Authority. And the Americans are not enforcing their blockade. So you're seeing ships basically slowly going through. Now, on average, we're seeing about 30 ships passing through every day through the Hormuz Straits.
Welcome back. We're ending strong. We started strong, ending even stronger, above the 24,000 mark. The decline in crude prices, the appreciation in INR have all provided the bulls some ammunition today. And the fact that US markets are shut tonight on account of Memorial Day has taken the supply pressure off the market. The FIs have been consistently selling in the market, and that perhaps will be absent today. The advanced decline ratio is strong. We've got about 2,200 stocks advancing for less than 1,000 stocks declining. 5 minutes to go. Amrish Baliga is still here with us on the show. Amrish, lots of positive earnings reaction. So you've got an Aisha Motors in the frontline space. You've got a Green Lamb. You've got Narayana Health. The list is long. Poly Medicure numbers are up for Uniscreen. Big margin disappointment. 20% margins versus 26, 27%. Profits have declined 27%. You want to quickly share some of the results, earnings which stood out for you?
No, Aisha clearly stood out, and even going ahead, I still, believe that the monthly numbers also would outperform what we have seen in the recent past. Narayana Health, as well as the other hospital stocks, are the ones where I continue to be bullish, including Apollo Hospitals. I think at least the next couple of quarters, we should see better numbers coming from most of them. So I think one should remain bullish on them.
This Poly Medicure's margin performance is disappointing. And I remember even in Q3, there was a sharp margin contraction. So the company seems to be facing this growth versus margin dilemma, because growth was very strong even in Q3. We'll wait by for the Q4 revenue growth, but the company's margins in Q3 had disappointed. Now, even in Q4, there's been a sharp decline.
Well, that's right. And I've never seen any margin close to 21%. I'm looking at the last, close to 15 quarters or thereabouts. It's not actually come below the 23% odd mark, which was the previous quarter. So on a low base, we're seeing a bit of a decline out there. But you might think, bulk of the revenue is coming from exports. So they could have had some kind of, operational problem on that front. There's a 21% growth on a year-on-year basis, but there could have been some kind of consignments that could have been stuck since they have such a large exposure to the export market. And also input cost had spiked up. So we'll have to keep an eye out on this one. As the management says, the longer term, they see a big runway. But in the near term, there appears there are some supply constraints and probably some kind of impact on them as well. So stock as is, I think, has corrected from 2,800 rupees to around 1,500 rupees. We'll try to get in the management and get, further clarity on this maybe in tomorrow's trading session. Amrish, you want to comment on this one? Poly Medicure, one of those stocks that have a big runway. We know the kind of, focus that it is in terms of domestic supply of medical equipment. But for the time being, margins corrected to 21%. What do you make of it?
Like you rightly said, Nigel, I think there would have been some issues with the exports, because quite a few export consignments have got stuck, and there also could be among those, because of which we are seeing this issue currently. But then I really don't see the stock, hitting the March lows which we had seen about 1,200. I don't see it going till there. Possibly levels of about 1,350, 1,400. I think those are the levels to again start buying into this, because we should remember it had fallen from those levels of about 2,400, 2,600 levels.
Thank you. Amrish, we'll connect with you on Markets Forward. For now, wrapping today's trading session, 24,050 on the Nifty. The Sensex has surged more than 1,000 points. It's 1,130 points on the Sensex, a 1.5% strong rally led by optimism of an Iran peace deal. The FIs perhaps are absent today on the back of US markets being shut. Sharp decline in crude prices. Brent is below $98 per barrel, and the rupee too has appreciated to levels of 95.2. The Nifty Bank led the rally today. The Nifty Banking Index ending up with a gain of 2.5%. HDFC Bank strong, 2.7%. SBI, ICICI, Axis Bank also inching up more than 2%. Aisha Motors was the big gainer, 6.5% up on Aisha Motors. The company is confident about managing margins despite the inflationary pressures through internal measures and some price hikes. Adani Enterprises saw some buying. Bajaj Finance, autos across the board. You had Tata Motors passenger vehicles up and about. M&M and L&T too had a good day. On the way down, Max Healthcare, ONGC Oil India under pressure. Hindalco, good numbers, stock seeing some pressure, and IT took a backseat today.
Okay, all right. Well, so I think on that note, though, we'll wrap up on this edition of Closing Bell. You stay with us. The team of Markets Forward comes up next post a rocking trading session. Stay tuned.
Markets end at the day's high with benchmark indices closing in the green for the second straight session. The Nifty reclaims the 24,000 mark while Bank Nifty outperforms, surging more than 2% amid strong buying in financials.
Fuel prices have been hiked for the fourth time in 11 days. Prices have now risen by over 7 rupees a litre since the 15th of May. Sources say that India's fuel price increase is the smallest material hike for any major economy outside the Gulf region. Stocks like HPCL, BPCL and IOC rise.
A sharp decline in oil prices and a weaker dollar lends support to the rupee. RBI Governor Sanjay Malhotra, in an interview with Mint, says the rupee may be undervalued in nominal terms and could appreciate once the West Asia crisis eases. Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear up for the next trading day. I'm Ritu Singh. With me is my colleague Hormaz Fadakia. Hormaz, we finally conquered that 24,000 mark. It's been a good day of trade after the last week's volatility we saw.
Indeed, and the bulls will be very happy with the fact that we have finally closed above the mark of 24,000, and it was this last hour surge yet again that propelled the index higher, of course, of the fact that it kept meandering all through at and near that mark of 24,000 ever since we opened gap up this morning. And it is for the first time after the 8th of May that the Nifty has closed above the 24,000 mark. So the bulls will be happy, and the bulls will also be happy for the fact that the index has ended at the highest point of the day. So that's another positive that we go into tomorrow's weekly or tomorrow's monthly expiry session. The principal contributor of this move was the banking names, and the Nifty Bank, after closing above the mark of 54,000 on Friday, added another 1,200 points to its tally today and closing convincingly above the mark of 55,000 in today's session as well. That too ending at the highest point of the day. So no reason to complain whatsoever. The index conquering key levels near that mark of 20 DMA now on the Nifty, and propelled by a lot of these heavyweight banks, Ritu.
Yes, nothing much to complain. Even the oil prices are below 100. Rupee has recovered, so it's looking good all around. So let's get you a lineup of what we have in store for you today. We'll start with the top movers and shakers of the day with Vivek Iyer. We'll also decode why OMCs and defense stocks were buzzing in trade, along with some key earnings report cards. And last but not the least, we'll delve into the key market events, as always, to watch out for in tomorrow's trading session. So with that, let's get to our first segment of the day. Vivek Iyer joins us now from the big wall with the top movers and shakers.
Well, thank you so much for that. Absolutely nothing to complain, especially as far as bulls are concerned. A sharp bounce back across all of the risky assets is something that we've seen since morning today. Now, in terms of individual names that we are tracking, Aisha Motors, one particular name that clearly stood out, over 6.5% higher, open gap up and then built onto its gain. The street has looked past the margin worries, and there has been a significant volume growth outlook, is something that this company has shared with the analyst community. In terms of Spark or Sun Pharma Advanced, amongst the top NSE 500 gainers today, higher by 11%. Q4 results, up move continues. Priority review voucher sale is something that the street believes has actually gone ahead and aided FY26 performance. In terms of the OMCs, HPCL, BPCL and IOCL, remember price hikes have been taken by all of these fuel retailers, and this is something that the street believes will go ahead and help reduce their marketing losses. So all the stocks significantly higher in the session. Glenmark Pharma, remember on Friday, was one of the top drags, almost 6.5% lower, but now an overhang has been lifted. Multiple class action suits have been gone ahead and dismissed by the company and have been settled by the company rather, and the stock ended higher by over 3%. And in this last hour of the trading session, the entire PSU banking basket, most of these names ended higher, anywhere between 3 to 6%. Union Bank, Canara Bank, PNB, all of them doing very well in the session. On the other hand, very few laggards today. NTPC Green stands out, significantly higher finance costs dented the PAT performance. Oil India, falling crude oil prices doesn't bode well for some of these upstream companies. So those names are under a bit of pressure today. Max Healthcare, some follow-on selling seen after a muted Q4, down 2% today. Hindalco and Nalco. Hindalco was one of the names that actually had a very strong quarter, but seeing a bit of profit booking, both Hindalco as well as Nalco. And lastly, Bellrise. Now, this particular name saw a little bit of selling pressure today on the back of a loss that saw in the operational performance in this particular quarter.
Fallen bond yields boosting the fortunes of PSU banks. Vivek, thank you for summarizing those movers and shakers for us. Of course, as Vivek was highlighting, the oil marketing companies were the big talking point through the day because of the fall in crude prices in the international market and, of course, the latest fuel price hike as well, the fourth in the last 10 days. Sudarshan is here to explain both of those factors. Sudarshan.
So today, all three oil marketing companies, IOC, HPCL and BPCL, are seeing buying. All the three names are sharply higher. It has reasons to it. First, this sharp downtick that we have seen in crude prices. Brent is still trading below $100 per barrel, and it's holding on to those levels. So that is being taken positively. Second is the fuel price increase. Government has announced, or basically oil marketing companies have announced another round of price increase. Both petrol and diesel prices have been increased in the range of rupees 2.61 to rupees 2.71 per litre, and now in last 2 weeks, or say in last 10 days, there's a price increase of little more than rupees 7 per litre. And after the current round of price increase, OMCs are incurring rupees 35.50 per litre loss on diesel and rupees 10.50 per litre on petrol. We also have certain information through sources, and they are saying that after this increase also of more than rupees 7, India prices petrol and diesel at or below most of the developing world, and that most of the other developing economies are now pricing petrol at around rupees 150, while in India the prices are still around 100. So this is the information that we are getting through sources, but major reasons for the sharp increase in OMC shares are because of fuel price increase and sharp downtick that we have seen in crude.
All right, Sudarshan, thanks very much for bringing us that update. On that note, let's invite in Ambrish Baliga, independent market expert, who's joining us now. Ambrish, you know, these creeping fuel price hikes that we've seen 4 times now, good for the oil marketing companies, not so good for the others that are dependent on this as a raw material. So, you know, with that in mind and, you know, what's happening with the macro fundamentals, you think some sectors are you know, earning downgrades in the offing, not good in the near term?
See, I mean, whatever increase has happened, it is much lower than what should have otherwise, to keep that parity. So as far as the OMCs are concerned, I think it is sentimentally positive, but all of us know that they are still incurring losses of 10 rupees for every litre of petrol and nearly 35 rupees for every litre of diesel. So every litre bought is being subsidized by these OMCs. And unless you have the oil prices coming below $75 or maybe $70, I really don't see the OMCs really making money. So they would be, they would continue to lose as long as, the oil prices are above those levels which I've just mentioned. And we should also remember that the rupee also has depreciated. So I think this will also have an effect on the oil marketing companies. When it comes to the user industry, yes, I think because of this hike of nearly 7.5, I think finally we should have a hike of about 10 to 12 rupees before it starts, stabilizes. I think that effect would be felt clearly on the logistic players because, they would be incurring that, they would pass it on. So you'll have that cascading effect on most of the industries around because everyone uses logistics and that will lead to inflation. So clearly this is inflationary.
Right. You know, Ambrish, the other results that have come in all over the weekend, the one name that stands out this time around is Eicher Motors, and the results were fine. The companies also, most of the analysts who track the stock also have a buy recommendation, see targets of anywhere close to around 9,000 rupees. Would that be your preferred play within the two-wheeler space, or valuations have now become demanding considering the run-up that the stock has seen?
No, the valuations are rich, but the sort of earnings they've been declaring, I think there's still a decent upside left for the stock. So I would be with like the analysts who are expecting levels of about 8,800, 9,000 levels. Yes, I think that's very much possible in the next about 9 to 12 months.
To hold on. Let's take a look at some of the other stories we focused on today. Railway stocks like Titagarh Rail, Jupiter Wagons, all of them surged in trade today on the back of reports of new mega tenders. Vinny Motiwala joins us now with the details on this one. Vinny.
Hi, afternoon. So in terms of obviously the railway orders that they're expecting, this is according to a Mint report that around 40,000 crore wagon tenders are expected to come in. That is around 1 lakh freight wagons planned over the next 3 to 4 years. So big opportunity that comes in for Titagarh Rail, Jupiter Wagons, Texmaco Rail, all of them. Now, annual orders expected out of this is going to be 35 to 40,000 wagons. First order is expected as early as Q2 FY27. So we'll wait out whether this actually comes in during that time. Now, like I mentioned, these beneficiaries will start seeing some improvement coming in terms of order book. But let's look at the order book or what is coming in terms of order book in Q3, Q4 so far for them. Texmaco, they reported around less than 10% of the total order book in Q4 was for freight railway order book. For Titagarh, they've not yet reported their numbers. Numbers are expected on 30th of May. 25% in Q3, less than 25%, around 25% was the order book for freight railways. And Jupiter Wagons, it was around 35%. Now, especially for the themes of wagon, what is a concern? That in the last 1.5 years, wheel set issues, that challenge still continues, right? So we'll wait out for more commentary that comes in from Titagarh Rail in terms of their numbers on 30th of May, whether that has actually gotten sorted out, because last time they highlighted that in April, they would start some productions of these wheel sets. Without that, their execution has been slower because of this, all these railway companies. So that will be key to watch out for from here on. Even if these orders come in, what's going to be the pipeline for wheel sets, which are availability? That's the major issue. But as of now, thumbs up if these orders actually come in and wheel set issue actually gets sorted out.
Vinny, thank you for that update there. Amrish, will come to you for these railway names in just a bit, but we're also being joined by Jay Thakkar of ICICI Securities. Jay, good afternoon. Now that the Nifty is closed above the mark of 24,000, finally, after weeks of consolidation, has the path opened for 24,500 on the upside, or do we take it gradually, step by step, or maybe even use this up move to reduce some positions?
Good afternoon to you, Ormaz. I think that it should be utilized as a buying opportunity and not reducing. The reason is that, see, Ormaz, I would say that one thing which was very clear in the April series, what we saw was the very sharp recovery in the index. From 22,200, we went all the way to 24,600 levels. That is almost 2,400 kind of a points move. And thereafter, for the entire May series, for this series, if you see, we have seen more of, first initially some correction, and thereafter since past 2 weeks, there was a consolidation within that 5 to 600 kind of a range. And finally, we have seen a breakout coming from this range beyond the levels of 23,850. I think everyone on the street must be knowing about these levels now. And after having closed about these levels, I think now until these levels are not broken, almost I think that 24,600, the previous recent swing high, should be reclaimed first, and thereafter I think in the June series we might even see the higher targets, probably near 25,000. So I am bullish. I think that till 23,800 levels now aren't broken on a closing basis, the risk reward is on the positive side, that is on the long side.
Jay, very quickly, what about the bank Nifty? We've broken above the 55,000 mark yet again. It did pretty well today. Near-term levels that you'd be watching out for?
Absolutely, Ritu. In fact, I would say that this was one of the sector which was underperforming in the May series. If you see that Bank Nifty had in fact fallen more than Nifty, but Bank Nifty had filled its gap around the levels of 52,700-800 levels, retested those levels for around 2-3 times, and has provided a breakout beyond the levels of 55,000. In fact, in today's trading session, if you see, like 24,000 for Nifty was acting as a very critical resistance ahead of this monthly settlement day, that is tomorrow. Likewise, for Bank Nifty, it was 55,000. It has comfortably closed above those levels. So I think for tomorrow, that is for the settlement day, monthly one, 55,000 is the immediate support. However, positionally, I would say, Ritu, that until 54,000 levels are not broken now, there has been a clear breakout on the upside, and I think it's heading towards the levels of 57,500.
57,500. That's a 2,500 point up move from current levels. But Amrish, to you now, to the railway names that Vinny was just highlighting. It'll just be in a couple of months from now, we'll be 2 years to the point in 2024 when all of these railway names are topped out. And since from there on they fell 40, 50, 60%, and since then they've done precious little. Are the valuations still on the expensive side because the earnings are not justifying these numbers? Is that the reason why the stocks have not moved moved anywhere. Do you still believe that there are still pockets of opportunity within this railway space?
No, I mean, there are those pockets of opportunity, no doubt. And something like a Titagarh Wagon, I think would be the the front runner in this space. I mean, going ahead, because I think one of the issues, like you just mentioned about, the wheel set issue which is there. I think that will be resolved once the production stabilizes for the JV with the Ramkrishna Forgings, and I think that should be the trigger for Titagarh Wagon way ahead. Because anyway, I think the order flows will continue. That would be the I think the second trigger for most of the railway stocks. But I think from that point of view, I think Titagarh Wagon would still be a buy at this point of time. Upside could be either say around 25-30% from here.
All right, let's focus on some more earnings that have come in. Speaking to CNBC TV 18 earlier, we had Sun Pharma's management that guided for single-digit revenue growth for FY27 after its fourth quarter numbers were in line with estimates. Meanwhile, Hindalco's MD Satish Pai also outlined the company's outlook amid the changing aluminium market dynamics and evolving cost trends. Listen into both of them.
We are looking at a high teens in terms of growth guidance for the revenues for the coming year. As we also mentioned, there are these macroeconomic environments, whether it is geopolitical environment, there are uncertainties relating to tariffs, and also slowdown that is sort of expected overall. Given these conditions, we believe that while we continue to focus on our growth, the growth could be in the higher teens, higher single digit.
Nearly 2.5 to 3 million tons of Middle East aluminium has gone off the market. So I think that it'll be fair to say for the rest of this year, we are looking at an LME that could be in the 3,500 range. Input costs are going up. Q4 to Q3, the costs were up 2.5%, and we are expecting another 5% increase Q1 to Q4. Our target is to maintain our EBITDA per ton around 500. It goes up and down depending on scrap spreads. So getting the Oswego volume back is our number one priority. And then, of course, to get Bay Minette commission, where the volume effect will not be seen in this FY26, but will be seen next year.
Well, we are into the final week of the earnings season for this quarter, and let's take a look at some of them that were reported during the course of the day. Ananya is here with that list. Ananya.
Hi, good afternoon. Here are the key corporate results that stood out today, starting with Suzlon Energy. So they delivered weak set of numbers for the quarter, while revenue surged 45% year-on-year and EBITDA grew 39%. Net profit declined nearly 6%. More importantly, the numbers missed street expectations, especially on the top line front. With the company falling short of its aggressive 60% growth guidance, margins also softened during the quarter. Moving to NBCC, the company delivered an inline set of numbers. Revenue and EBITDA remained slightly weak on a year-on-year basis, but net profit jumped 39%. The company largely met its FY26 guidance, with PAT coming in within the guided range. Now coming to Sundaram Finance, they reported inline operating performance. Asset quality also improved. AUM growth was also in line. Overall, it was a mixed day of earnings for the company.
Well, Ambrish, since, let's talk about Hindalco very briefly. It's talking about aluminium from West Asia going off global market. It expects prices to remain around $3,500 or so for the whole year. What sort of movement do you expect from here on the stock? Any opportunity there?
No, I mean, clearly, aluminum prices are expected to move further from here because there are a number of capacities which, are off, and I think it'll take a while for them to come back on track. So, from that point of view, overall, I would be bullish on the aluminum story as far as India is concerned. So, I think both Nalco and Hindalco would be on my buy list.
Ambrish, Jay, thank you for sparing time and joining us on the show with your views on the markets and, of course, on specific stocks as well. Take a short break. On the other side, we bring you all the top corporate voices along with the key events to watch on the other side.
Welcome back. Now here are some corporate voices of the day. Anupam Rasayan is all set to acquire a majority stake in pharma formulations maker Bliss GVS Pharma. The management told CNBC TV18 that this acquisition will be funded through 300 crore rupees of debt and that the company also aims to improve margins over 20%.
The management of Electronic Mart said that the demand momentum remains strong during the summer period, particularly for air conditioners and other large appliances. The retailer has guided for top-line growth of around 15% in FY27, supported by high single-digit same-store sales growth. The company expects EBITDA margins to remain in the range of 6.5% to 6.8% for the full year.
And the management of JK Cement tells CNBC TV18 that it expects double-digit volume growth in the grey cement business in FY27 and remains confident of outperforming the broader industry. The company also expects its paints business to turn EBITDA positive during the year.
And before we call time on the show, here's Ananya, who's here to summarize the key events that you need to watch out for going into tomorrow's session. Ananya, over to you.
So here are the key events to watch out for tomorrow, starting with the global markets. Investor will track Germany's business climate data, US consumer confidence numbers, and central bank meetings from Sweden and Hungary. Now, meanwhile, several Middle Eastern financial markets, including the UAE, will remain closed due to Eid. Now, back home markets will closely watch the RBI's 3-year $5 billion USD INR buy-sell swap auction aimed at injecting long-term rupee liquidity into the system. Now, traders will also keep an eye on the monthly FNO expiry, which could keep volatility elevated throughout this session. Now, on the corporate earnings front, key results to watch include ONGC, First Sky, Black Box, recently listed Fractal, IRCTC, APJ Park Hotels, Siemens, and AstraZeneca Pharma India. Now, other important events include Quad diplomatic talks in New Delhi involving officials from the US, Japan, and Australia, the Tata Sons board meeting, SEBI chairman's address at the KRG event in Mumbai, and the UBS Asian Investment Conference 2026.
All right, Ananya, thanks very much for bringing us that update. On that note, we've run out of time on this edition of Markets Forward. For the markets tomorrow, of course, it'll be key to see whether we hold on to that 24,000 mark. We've started Monday well, whether the rest of the week looks as good as the starting day. We'll wrap up this edition of Markets Forward. From Hormaz and me, it's a goodbye, but we'll be back with more news and updates right here on CNBC TV 18, so stay tuned.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The rupee ends at a two-week high of 95.23 against the dollar. The currency appreciates against the greenback for the third day, regains most of its losses that it incurred since the start of the month. The market also closes in the green. The Nifty ends above 24,000, led by financial heavyweights and Reliance. Nifty Bank outperforms, closes over 2% higher. Iran says progress has been made on several issues with the United States, but an agreement is not imminent. Also insists that charges for services provided to vessels crossing the Strait of Hormuz should not be described as a toll. President Trump says he has instructed officials not to rush into a deal. Oil prices fall below the $100 a barrel mark amidst hopes of a possible breakthrough. The U.S. Secretary of State Marco Rubio calls the Iran deal a work in progress, says Delhi does not have any issues with Islamabad's role as a mediator between Washington and Tehran. Also downplays racist remarks directed at Indians, says stupid people exist in every country. Fuel prices hiked for the fourth time in 11 days. Prices have now risen by over 7 rupees a litre since the 15th of May. Sources say India's fuel price increase is the smallest material hike for any major economy outside the Gulf region. OMC losses have now trimmed to less than 600 rupees a day from 750 crore rupees last week.
India cannot afford fear-mongering. We need to give confidence to the people with our words and with our action.
Finance Minister Nirmala Sitharaman calls for a sharper focus on the 3F, says challenges on fuel, fertilizer and forex are external, adds the Indian economy remains resilient, also hits out at naysayers for their pessimistic, cynical narrative, says India cannot afford fear-mongering. US H-1B visa approvals widely used by Indian IT professionals seeking jobs in the US down 35% year-on-year. Indian IT firms take a hit. The Trump administration clarifies that many H-1B visa holders who have applied for green cards may continue to stay in the US while their applications are being processed. VinFast-backed Green SM to launch all-electric ride-hailing services in Delhi next month. Plans a nationwide rollout later. Guarantees a monthly salary of 35,000 rupees for drivers in the initial phase. Let's go straight to the top story this evening. The rupee rebounding for the third straight day, touching a two-week high of 95 against the dollar. The Indian currency has now regained most of the losses that it recorded this month. This as RBI Governor Sanjay Malhotra told the Mint that the rupee may be undervalued in both nominal and real effective exchange rate terms after its recent fall. That is, Ritu joins us now with more on the rupee. 95.23 is where the dollar rupee closed for the day. Ritu, what did the markets make of the governor's comments?
Sharp recovery today, and there's a couple of reasons behind that move. First, and importantly, of course, crude oil prices have eased back below the $100 a barrel mark following reports of a possible de-escalation in tensions between the US and Iran, which is a key positive for India given our large oil import dependence. But markets were also very closely tracking RBI Governor Sanjay Malhotra's comments in an interview to Mint, where he struck a stronger than usual tone on the rupee. Now, he made it very clear that the central bank would step in aggressively to curb any excess volatility or speculative moves in the currency market. In fact, he said RBI would do, and I quote, whatever is required to ensure orderly price discovery in the forex market, adding that India has about $700 billion in forex reserves, along with other tools to deal with disruptive market moves. But what really caught the market's attention was the governor's remark that the rupee may now actually be undervalued after the recent fall. Remember, the rupee has weakened by more than 6% so far this year because of foreign equity outflows, higher oil prices, the global risk aversion linked to what's happening in West Asia. And the RBI governor now said that one could argue that the rupee is undervalued both in nominal terms and in the real effective exchange rate, or REER terms. Now, RBI data shows that rupee's real effective exchange rate index fell to 90.96 in April, which is its lowest level since at least 2014. And remember, a reading below 100 generally indicates undervaluation. Now, Sanjay Malhotra also suggested that if tensions in West Asia ease, the rupee could see some appreciation, which is similar to previous episodes of external shock-driven volatility. Now, on the external sector itself, he acknowledged that higher crude prices can put pressure on India's current account deficit, but he did reiterate that services exports, remittances and capital flows remain resilient, adding that the overall balance of payment situation remains manageable.
All right, Ritu, many thanks for joining us. The rupee ending at a 2-week high. From the currency market to the equity markets, the market's also closing in the green for the second straight session, starting Monday strong. The Nifty ending above the 24,000 mark. The Nifty Bank up over 1,200 points, a gain of over 2% there. The mid-cap index up by almost 1.5% higher there on the Sensex. Prashant standing by to wrap up the day's market action. Prashant, clearly the market's hoping, betting on the fact that there could now be a negotiated agreement between the US and Iran.
Well, flurry of headlines over the weekend that things are getting better. Perhaps a deal, a framework deal, a structure is in sight with regards to the talks between US and Iran. And all of that had an impact as far as oil prices are concerned. So from Friday morning rate of about $104 on oil, we started this morning at about 99. And through the course of the session, we saw oil prices dropping off a little bit more. So that showed up. I mean, the Nifty ending about 300 points higher. Last Friday, we ended about 90 points in the green on hopes, and it was backed up with today's 300-point move on the Nifty. But Bank Nifty also did well. I mean, actually 2%, and PSU banks did well. Private bank index was up about 2% or so. The other sectors were the auto space, which was up, even though we have the fourth price increase for petrol and diesel, which came through. The capital market index was the other one, which did quite well. If you look at sectors in that sense, VIX cooled off about 7.5%. But that's it. I mean, otherwise, except maybe an FMCG index, which was sideways, it was a good session all told. Let's just look at the Nifty stocks. Aisha was the big gainer after numbers, ended up 6% higher, so 7,400 on Aisha. Adani Enterprises was up 5%. Tata Motors Passenger Vehicle, Bajaj Finance, L&T, HDFC Bank, Eternal were some of the 2% moves. Actually, you had about 10, 12 names on the Nifty with gains in excess of 2% today. Max Health was down big on Friday. It was down another 2.5% today. ONGC was down about 1.7% and Hindalco was down about 0.8% or so.
All right, Prashant, many thanks. Now, the government has hiked petrol and diesel prices for the fourth time in 11 days, registering an increase of around 3 rupees a litre. With the latest hike, the standalone prices of petrol and diesel have cumulatively increased over 7 rupees a litre since the 15th of May. Now, the oil ministry sources suggest that the daily OMC losses have been cut to less than 600 crore rupees from 750 crore rupees. That was the number just last week. Sudarshan is standing by now with more on the fuel price hike and what it means for oil marketing companies. And of course, the prices on your screen tells you what it means for you and me. Sud.
Oil marketing companies have been in the focus for the last few days, and today also shares of all the three names, IOC, BPCL and HPCL, are sharply higher, tracking move in crude and the fuel prices. So over the last 2 to 3 days, we have seen a sharp downtick coming in crude price, and today Brent is hovering around $100 per barrel. It's a sharp downtick that we have seen against the recent surge that we had seen, and recent surge had taken Brent to as high as $126 per barrel. Second headline is the fuel price increase. Today, in another round of price increase, petrol and diesel prices have been increased in the range of rupees 2.61 to rupees 2.70 per litre, and following this round of increase, OMCs are incurring losses on diesel at rupees 35.50 per litre, and on petrol, it's rupees 10.50 per litre. It's a decrease of rupees 2.50 if you compare after the loss that they were incurring after the last round of increase. And the information we have from the sources, they say India prices petrol and diesel at or below most of the developing world. In majority of the economies, petrol prices have surged to as high as rupees 150 or say rupees 180 per litre, while in India, prices are still around rupees 100 per litre, even after the increase of a little over rupees 7 that we have seen in the last 10 to 12 days. But major surge in share prices we have seen mainly on the back of fuel price increase and also the crude move or crude downtick that we have seen over the last 2 to 3 days.
All right, so many thanks for joining us. And here is the latest in the West Asia conflict. US and Iran are still talking about a potential deal, but it looks like it will take more time, even though progress is being made. Here are the latest developments of the day. Now, President Trump continues to hint at a possible escalation while at the same time saying that negotiations are constructive. Trump posted an AI-generated image of a large bomb mounted beneath a military aircraft. The words, "Thank you for your attention to this matter," were painted on the side of the bomb. President Trump said that the deal is not fully negotiated yet, while adding that talks are underway. Earlier, Trump had posted an AI image of a U.S. military aircraft bombing an Iranian ship. Now, according to an Axios report, the White House says a deal with Iran could take days. Iran has tempered expectations as well, with its leadership saying that an agreement is not imminent despite progress being made. Iran's foreign ministry spokesman has said that two nations have reached a conclusion on a large portion of the issues under discussion. He also said that providing services to vessels crossing the Strait of Hormuz must come at a fee, but stressed that what is being charged should not be classified as a toll. President Trump and Israel's Prime Minister Netanyahu had a call. They discussed Hormuz and Iran's nuclear enrichment. Netanyahu said that President Trump reaffirmed support for Israel's right to defend itself against threats on all fronts, including from Lebanon. This as Israeli air attacks continue to target southern Lebanon. According to an Axios report, the U.S. president has urged Gulf counterparts to sign peace deals with Israel once a deal with Iran is reached. In the oil market, Brent crude prices fell below the $100 mark on hopes of a possible deal. The Iranian Revolutionary Guards claim that 33 vessels have passed through the strait in the last 24 hours after Iran's approval. According to shipping data from Kepler and LSEG, 2 LNG tankers bound for China and Pakistan have made their way through the waterway today. U.S. Secretary of State Marco Rubio in India says that Iran's deal is a work in progress. Here's the Secretary of State. Listen in.
Pull it off. It has a lot of support in the Gulf. It has a lot of support globally. Every country that we've walked through it understands it's not just very reasonable, but it's the right thing for the world to get done. As the president said, he's not in a hurry. He's not going to make a bad deal. I mean, the president's not going to make a bad agreement. So let's see what happens. We're going to give diplomacy every chance to succeed before we explore the alternative.
We are not collecting tolls. I believe we should be precise in our choice of words. We are not seeking to collect tolls. The actions taken by Iran and Oman to draft a protocol or a mechanism to ensure the safe passage of ships through the strait represent a responsible step that is in full compliance with international law. Naturally, the service provided alongside the measures to protect the environment of the strait, the Persian Gulf, and the Sea of Oman require costs to be covered. These should not be referred to as a toll or fees.
Well, that is the Ministry of Foreign Affairs spokesperson in Iran. The U.S. Secretary of State Marco Rubio, who's currently in India, has said that Delhi did not bring up concerns about Islamabad's role as a mediator between Washington and Tehran. Speaking to reporters, Rubio also downplayed racist remarks directed at Indians. He said, and I quote, "Stupid people exist in every country." End of quote. He added that sanctions on the purchase of Russian oil was not aimed at India.
They're concerned about the things they're always concerned about, obviously. India is always pointing to the fact that there are armed terrorist groups operating from Pakistani territory that target India. They're always concerned about that. But as far as the role they played as a mediator and a facilitator in the Iran situation, it never came up. I don't think that they would complain about that. I mean, their issues with Pakistan are different.
I view it more as a continuation of a very strong relationship and looking for new areas of opportunity. We hope to have finalized very, very soon a trade agreement that's going to make both of our countries stronger. We obviously share a lot of the same security concerns. We're also using India as the forum for our next Quad meeting for foreign ministers. In fact, it was the first meeting I ever did as the Secretary of State was a Quad meeting, and we were due for another one, and so we felt this was the right place to do it. We have a lot of commonality, obviously. There are a lot of investments in the United States by Indian companies. So I view this visit as much as anything else as sort of a continuation and just continuing to build on what we already have as a foundation and the progress that's been made in just the last year and a half in the second Trump administration. The Russian oil purchase issue obviously had nothing, it wasn't about India. It was about a desire to impose a cost on Russia because of the war in Ukraine. And India just happens to be a big purchaser, but it was never aimed at India per se. There's been some new dynamics in place nonetheless since that time. And so I think what you've seen, though, is that in the process of addressing that, we've also seen an opportunity for India to continue to its plan, its already pre-existing plan, to diversify its energy sources. And that includes the United States and potentially some other countries like Venezuela. So we want to continue to be a good partner in that regard. And so I don't think that issue is going to feature very prominently in the future because India was already moving towards diversification. And so, as I said, and hopefully the war in Ukraine will end.
Well, that's the U.S. Secretary of State Marco Rubio. He also flew to Agra today and spent 45 minutes at the Taj Mahal with his wife Jeanette and then visited Jaipur's Amber Fort. He is scheduled to attend the Quad Foreign Ministers meeting tomorrow before wrapping up his 4-day tour. Ashmit joins us now with the key highlights from Rubio's visit. A 4-day visit to India, Ashmit, plenty packed in there.
Well, indeed, 3 days in as a part of that 4-day visit. He's today, of course, as you mentioned, in Agra and Jaipur, soaking in the heat. And he's quick to point out that he's from Miami, so he's not new to the heat. But nonetheless, going forward, as a part of this 4-day program is concerned, he landed on Saturday. He, on day one itself, met the Indian Prime Minister, reaffirmed the ties between the two countries, even extended an invitation to the Indian Prime Minister to come to Washington later this year. But as far as some of the takeaways are concerned, bear in mind that there are multiple moving parts as far as this dynamic relationship is concerned. First, on trade. On trade, he's clarified that, yes, there is significant progress being made between two sides, even alluded to how a deal, at least an interim framework, could be only a few weeks away now. That's an important indication coming in from the Secretary of State. On oil, he's clarified that as far as the Russian sanctions are concerned, it's not aimed specifically at India, it's aimed particularly at Moscow, and that reaffirming the American position of wanting to supply greater energy to the Indian economy, to India. On the green card tightening, again, he's clarified that that is a broad-based approach. Again, India is not the focus of that tightening of the green card regime, and therefore should not be construed as such. On Iran, saying that there is a solid progress being made, that the negotiations are on a solid footing. Of course, we heard from President Trump himself when he said that he's pushing his negotiators not to push too hard as far as the timelines are concerned. And finally, of course, the Quad today, Rubio soaking in the sights and sounds and the heat of Agra and Jaipur. He'll be flying back to the national capital tomorrow. And tomorrow, 9 a.m. is when the Quad kicks off, and this will be critical. Rubio was quick to point out as a part of his first media engagement when he said that his very first meeting as taking over the Secretary of State was, in fact, a Quad meeting, pointing out now that India is the cornerstone of America's Indo-Pacific strategy. So clearly, stakes are high. Tomorrow, 9 a.m. is when the Quad meeting will begin between the foreign ministers of India, Japan, Australia, and, of course, U.S. Secretary of State Marco Rubio.
All right, Ashmit, many thanks for joining us. Now, H-1B visa approvals widely used by Indian IT professionals seeking jobs in the U.S. are down 35% compared to last year. This also includes 6 major IT firms whose H-1B approvals fell by 6,000 cumulatively. Rima standing by with the details. Rima, how are Indian IT companies coping? What kind of numbers have we seen?
Thanks so much for that. We're talking about a 35% drop in the new H-1B approvals for the current year. So the total 2026 approvals stand at 11,000. The comparable number last year was more than 17,000. So we're looking at a drop of more than 35%. And this is data from the top 6 major IT companies: TCS, Cognizant, Infosys, HCL Tech, Wipro, and Tech Mahindra. There are multiple factors driving this, but predominantly it is a strategic reset by the way the companies are delivering work. There has been a very conscious effort by the Indian companies to reduce their dependence on H-1B visa, and every year the numbers are telling you the same story. They are focusing on local hiring, nearshoring, offshore delivery centers from India. But it's also a story about tightening immigration norms. There has been a $100,000 fee for H-1B petitions, which became effective last year. The move from random lottery system to make the approval has now moved to wage weighted. So they are focusing on people with higher skills, higher wages. So it's a combination of factors, but the numbers are telling you a story of a strategic retreat by the Indian IT companies and tightening immigration norms by the US. But separately, there was a lot of news flow over the weekend which caused panic, consternation amongst H-1B visas. So on 22nd of May, the US administration issued a directive which basically said that all foreign visa holders, this includes includes H1B, that if you want a green card holder, if you want a green card, then you have to go back to your home country, apply at the US Embassy there. Now, you know the process of converting your H1B into green card can take months, it can take years. So there was a lot of panic because there are so many people waiting for years to get that green card permanent residency, and they face the prospect of leaving their jobs, families, homes in the US, and there was no guarantee that that approval would come through very soon. But then the clarification, some rollback came in from the USCIS, which said that people who present applications that provide an economic benefit or otherwise in national interest will be able to continue on their current path. So basically, H1B visas holders, workers who add economic value can apply for their green card from the US. They don't need to go back to their home countries. So there is a clarification which has come through, but it's not a guarantee. Right? Earlier, it was pretty much, now it just seems that there is some more uncertainty and discretionary, but there has been a significant rollback on that green card directive, at least for H1B visas. So that should allay some concern.
Yes, it certainly will. Rima, many thanks for joining us. Finance Minister Nirmala Sitharaman has called for a sharper focus on the 3 Fs, adding that the challenges on fuel, fertilizer and forex are external. Speaking at an MSME event, the Finance Minister also hit out at naysayers for, in her words, the pessimistic, cynical narrative, asserting that India cannot afford fear-mongering. Take a look.
Please understand the context of these 3 Fs. 3 Fs. Fuel, fertilizer and foreign exchange. And the foreign exchange is for, in this context, purchase of gold. So we need to understand this. And we also should appreciate that the challenges are more external driven. We must also recognize that India's domestic economic situation remains positive and resilient even today. Therefore, those naysayers who jump into the scenario, as it were, and say, oh my God, you look around yourselves, it's all falling down, it's crumbling, it's going to hit you. There is a section, I would think, of Indians who very quickly want to decry the achievements of our own people. And therefore, for all the good that is being done by the common people themselves, that is forgotten. And a pessimistic, cynical narrative is generated, which is just not right. It's not right is one thing, but it is wrong because it is fear-mongering. India cannot afford fear-mongering. We need to give confidence to the people with our words and with our action.
Well, that's the Finance Minister. We'll head into a break, but up next, Bengaluru startup Pronto has come under scrutiny after it admitted to using footage recorded inside customers' homes to help train physical AI and robotic systems. That and more when we return. Well, quick home services startup Pronto is under scrutiny after it admitted to using footage recorded in customers' homes to train physical AI systems. The company says the camera-based pilot was strictly opt-in and covered only a few users. Rachna is standing by now with more details. Rachna, take us through what has happened here exactly, and we're given to understand that the government is now looking into this.
That's right. Pronto is a home services startup founded by 23-year-old Anjani Sardana. Since its launch last year, the company has been on an extraordinary growth trajectory. It raised $100 million in Series B funding in March at a valuation of over $100 million. But this week, the company has hit a major scrutiny roadblock. Now, Pronto has been piloting a feature that involves cameras worn by workers during service delivery inside people's homes. The company's workers carry these cameras while cleaning, doing laundry, and handling other household tasks in customers' residences. This has triggered significant backlash on Twitter and other social media platforms, with critics arguing that this represents a direct breach of privacy as it records activities happening inside someone's home. The backlash intensified when Pronto's main competitors weighed in. Snabit founder Ayush Agarwal posted publicly that his company had been approached by several players offering the same technology. He said Snabit studied how this works but chose not to deploy it. Then there was Urban Company. Founder Abhirat Singh Behel made a similar statement, saying his company does not engage in such activities and has no plans to do so. Both the competitors are now positioning privacy as their core advantage against Pronto. When CNBC TV18 reached out to the company to understand what it was doing, Pronto provided a detailed response. The company told us that the camera feature is strictly opt-in, which means customers have to actively choose it at the time of booking. Less than 0.01% of Pronto's customer base has enrolled in this pilot. They also said that the feature of faces, there is a feature that will blur the faces and any identifying details, and they will be automatically blurred before the footage is uploaded. So all the video that is uploaded in their service is then automatically deleted within 48 hours from the service. The company also stated that it is not sharing this data with any third-party AI labs. But the broader privacy question still remains. Main privacy policy, which is on Pronto's app, contains language allowing indefinite use of aggregated household data for unspecified research or statistical purpose. So will this also qualify under that? All of that is unknown. Now, under India's data protection law, consent must be purpose specific, which means customers who book a cleaning service, they're consenting to the service and not to the indefinite research use of the data gathered. These are fundamentally different purposes. Now, the Union Ministry of Information and Technology is looking into Pronto's practices. So this is shaping up to be India's first major enforcement test of the Digital Personal Data Protection Act. So we'll have to see where this goes.
Yes, we will. Rachna, many thanks for joining us. And that's it then on this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. We're back in a moment after a very short break.
Hello and welcome to this very special conversation. I have with me Mr. Abhay Soy of Max Healthcare talking to us. Mr. Soy, thank you very much for joining in. And just to give it some perspective, we are at your Nanavati Hospital, which is your flagship facility in Mumbai in a newly launched wing just 2 to 3 months ago. I don't know if I'm in a hospital or in a motel at this point, but we'll discuss that in a bit. I want to start this conversation by asking you about the dismissal of the CCI order which has come through, which would be a relief for companies such as yours.
At the outset, a very, very warm welcome to come. You made the effort to come to one of our 3 new facilities. Let me do a quick plug. Nanavati is one of them. Delhi Saket, we've just rolled out our other flagship facility in Delhi, and Mohali, Punjab. Yes, with respect to the first, the question that you sort of asked me about the CCI order, which came out yesterday. So the CCI Commission has dismissed all allegations against private hospitals, and that they were overcharging. I think there was some comparisons which were alleged that the room rates at hospitals are equal to room rates at hotels, or for that matter, price of medicines or syringes at hospitals are more than what it is, people are able to source at pharmacies outside. I think very pertinently, the Commission has sort of ruled that hospitals are integrated services. We are not selling rooms. We are selling services. There are resident doctors, there are nurses, there are a huge amount of overheads which are incurred by hospitals while imparting services in the rooms. So it's not a direct comparison. Similar with syringes, I think, we don't sell syringes. The nurses or the doctors give injections. So, these are complete comprehensive services, and each item from that standpoint cannot be looked in its singularity.
I think the debate is on the markup that takes place. A lot of patients who come to private hospitals complain that maybe there is a higher markup for hospitals, which is eventually to also cover their margins. So if you look at the itemized billing, the syringe would be cheaper in a chemist outside as compared to maybe what you would get in the hospital. And similar to that, the bill would probably be cheaper if you source from outside
right.
as compared to the hospital. That's probably the debate. So your comment on that?
So I think first and foremost, when it comes to, there are 2 kinds of inputs that are required by a hospital, medicines and consumables. So if you look at medicines, I think the government has an MRP. In fact, most medicines are under capping. When it comes to consumables, there are margins. Let's take syringe, for example. And in this particular case, this particular syringe, which is available outside for, I think, rupees 20. But the hospital was selling it for 240 rupees. So I think, percentage margin is one thing, but you have to look at it in its value as well. Because behind that is a nurse, which is imparting that medicine. Behind that is being done under supervision of a doctor. And all of these sort of costs are loaded onto the syringe. Having said that, I think if you, take into account all the margins, all of these sort of alleged overbilling margins, etc., on hospitals, but eventually it percolates down to a 10 to 12% net profit margin, isn't it? Because, a majority, if not all, hospital chains, operate at either single-digit net profit margins or very, very low double-digit net profit margins. Do keep in mind, it is an extremely capital-intensive business. The cost of technology, the cost of absolence of technology, the cost of infrastructure such as this, because we have to cater today to a very, very aspirational India as well. People are aware, people are seeking the best in class, be it technology, be it infrastructure. We were talking earlier, even, the kind of airports, public spaces, the metro stations in Mumbai, people are used to, are aspirational about, or the airports for that matter. You can't really have hospitals or technology which lie far behind.
Yeah. Do you think that eventually the government will probably cap certain certain services by the hospital, certain equipment which is used by the hospital. It happened with the knee implants earlier. It's happened before from the government perspective. Do you think that could possibly be extended now?
So my belief is this, that, there's not a focus towards capping. The government, again, I've never held or seen or read a narrative or, gathered a statement from state or any central government or any body for that matter, which says cap the pricing of hospitals. These are determined by the market. But certainly, I think there is a push towards being transparent and being forthright. There is, or there has historically been, an opaque part of the billing, which is really, I think, high value implants or stents. They were high value items. So, in a procedure, in angioplasty, 60 to 70% of the cost was the cost of the stent. Or similarly in a knee implant. And I think rightly, the government perhaps said this is the opaque part of the billing, which a patient doesn't perceive the value, and you have to be transparent about it. And the way you're able to be transparent is if you cap the pricing.
Yeah.
But I don't think they've ever told a doctor, a clinician, or a hospital that you can't charge a certain amount for a single room vis-a-vis a multi-shared room or a doctor for his services or whatever. Because, I think, if you look at it, since 91, really, I think various governments have taken a step towards the right. I really haven't seen anybody take a step towards the left. This government more so. It is a free market out there. And I think, it's almost like saying we have malnutrition, but five-star hotels can't charge.
Yeah.
By the end of the day, there are services which are being provided by hospitals. And I personally don't see that forthcoming, but I do see, and rightly so, a push and perhaps a focus towards transparency and forthrightness.
Has this transparency increased in the past 10 years, you would say?
I think most certainly. If you look at the amount of scrutiny, firstly, awareness. I think awareness, whether it is from a patient standpoint or their scrutiny of the bills, and that's really what keeps hospitals honest. Do keep in mind, no hospital really has monopoly. If you look at Max, we perhaps operate at the highest occupancy. Yet, 30% of our business is institutional business, which is less than half. At less than half of the cost of the price of what a regular patient charges. There are other hospital chains which are operating at 60 to 65% occupancy levels, more or less. So each hospital competes against another hospital at the margin for the patient. You compete vis-a-vis the value proposition. A very important component of the value proposition is the pricing. It's almost like hotels and restaurants for that matter, right? At a good restaurant, you probably won't get a reservation, but people don't want to go to a bad restaurant. So you can imagine, with respect to your health, the whole sort of comparison is so much more profound.
Yeah. Well, let's just talk a little bit about the quarter gone by. It was a bit subduing in terms of the revenue. It grew 10%, Street was anticipating 14%. There was a little bit of pressure on the margins as well. This whole issue with regards to this oncology drugs, which which you stopped supplying in the CGHS scheme. Just take us through what kind of impact it had.
So I think 2 or 3 things here. One is, if you actually see the Bloomberg consensus, I think we're pretty much on the margin over there. So, but having said that, I think, you had many quarters of perhaps outperformance of street expectations. And this time we were as per expectations, or perhaps a little shy of it, but and rightly so. We expect more of ourselves as well, and so should the street. But do keep in mind, we've added, we started commissioning of 20% capacity over the last 3 to 4 months. You're standing in one, we've commissioned a part of the hospital, yet the rest is being commissioned. Yet you see it's staffed, the clinicians are already onboarded. So your cost structure sort of moves up when you do that. The clinician expenditure moves up. So that has an impact on your margins to some extent. I think other than that, we've had increase in institutional pricing after 14 years. The CGHS rates have been increased. But as a part of this increment, there was also a capping of margins in oncology drugs. So to about the margins have been capped to hospitals have to provide a 30% discount on MRP. But some drugs, some medicines, Keytruda, for example, we operated, I think, 16 or 17% margins. So we've been unable to kind of supply that at a 30% discount. Patients are free to purchase or to get the same, obtain the same from the CGHS pharmacy and dispensaries. But because this has been, it's been about 200 plus crores of sales in the past, we've had to discontinue, and therefore sort of the top line gets impacted.
Sure. So this took place in the previous quarter as well. This is a continuous issue which you face for 2 quarters.
Well, it started in October.
Yeah. So, is there any resolution to it?
So there's a net improvement because of the CGHS rates. The total impact of positive impact of CGHS, including the net impact, including the reduction of the top line as well as the margin we were getting from these drugs, was about 200 crores.
Yeah.
But then we had another negative impact because of GST rates. So I think the net benefit is still 140 crores, of which about 100 crores has come through. And 30 to 40 crores is yet to come through on an annualized basis, because some of the super specialty rates, etc., I think still being worked out by the government. They are impaneling hospitals one by one. 2 of our hospitals have been impaneled and the rest are in queue.
Oncology is now 21% of your total revenue or your specialties.
That's right.
It used to be, what, 24%, and it used to be even higher.
That's right.
It's probably one of the most profitable segments of your business. How much is it possibly going to stabilize at?
So if you actually see the occupancy has remained the same. So it's not as if other specialities have not supplanted that. And with respect to margins, again, you've seen the margins were 27.2, but now it's come to 26.8. So, it's not a big sort of change. Considering this big rollout of 20% capacity as well, which supposedly, previously most analysts felt would have massive impact on margins when we rolled out this capacity. And yet we see it's only a 0.3, 0.4% impact. So I think that's worked out well. We've always guided to the fact that this new capacity rollout will not impact our margins. And I think, that is something to which we will be able to demonstrate again.
Yeah. So oncology will be how much in terms of a percentage share?
So I think it'll be 21, 22. About 2% revenue you lose because of this whole med-onco. Okay. But we don't see any impact on the bottom line really, because like I said, it does get supplanted by or substituted by other businesses and the margins are the same.
So how is the other section of complex therapies doing for you? Say cardio, ortho, nephro, neuro. How is all of that panning out for you at this point?
So other than oncology, all other specialities across all of Max.
How much are they growing?
They grew by more than 15% in this quarter, year on year. So that's a big sort of growth of about 15%. Do keep in mind, even the occupied bed days, that means the total number of new patients which have been admitted in the hospital has grown by more than 8% year on year. This is based on a quarter basis.
Okay. So complex therapies now, how much is it as a percentage of your revenue? How much do you want it to possibly grow to?
So I think eventually we all, kind of pray in the temple of science, medical science in this case. And, the complex therapies is something that every hospital network, every clinical program wants to serve, because that's really, I think, that is the part of the excellence of what people aspire to kind of reach. And eventually, I mean, today we have about 60% of our business is surgical business, within which we've seen growth in robotics by quite an extent in the last couple of years. And, going forward, I see actually with the advent of AI, with the advent of a lot of innovation, huge amount of innovations are happening at the clinical level, both in medical as well as surgical, robotics as well as immunotherapy. AI does sort of allow you to innovate much faster. So all of that will come through. So it's a little difficult in terms of me to pronounce that what kind of numbers we are looking at.
The focus that you have.
Absolutely.
Robotics, for example, how many robots do you have at Nanavati? How many are you acquiring in FY27?
So believe it or not, 2 years ago we had 2 robots and now we have 28 robots. So
across India.
Across India we have about 3 or 4 at Nanavati itself. We've got, so all are essentially we are, this is a Mumbai based hospital. And, the patients, people from all over the country, because the best clinical talent does reside in the metro cities of Delhi, Mumbai, Bangalore, and so on and so forth. The people also seek the best of technology, and we cater to that. So I think there's never been, any shying away from that part because, there is no real import duty on it. And whatever you find anywhere in the world, you find in India. We get people from 145 countries who come to India for our clinical talent and technology that we're able to kind of...
In fact, your international patient revenue did very well. It's 9% of your sales now. So, and you're probably one of the leading chains when it comes to international patient growth. Any hiccups with regards to the West Asia crisis? We had some issues with Afghanistan earlier, I think.
Well, Afghanistan was our biggest business. It's 12% of our total international business. Yet, I think with the geopolitical situation there, India, we haven't been issuing visas, so we lost that. In spite of that, there's been a huge growth because we've been able to set up, we have 25 offices overseas for medical tourism. It's been growing at a pace of more than 20% for us for now a few years. West Asian crisis happened, but Central Asia kind of made up for it because we made some more inroads over there. But we always have some geopolitical issue in some part of the world or the other. It's about us making inroads in newer geographies. My belief is if you kind of spread the pie, you spread your net wider, the geopolitical issues become mere aberrations. If you actually we get people from 145 countries, literally the poorest parts of the world. So people from Ethiopia, people from Sudan, people at the bottom of the pyramid worldwide where it is self-paid. These are countries where either the clinical skills are not available and, other than that, the ability for them to go to any other part of the world, isn't there. I mean, India, in terms of value, in terms of the cost, in terms of skill sets, the comparative advantage that we have, no other nation in the world has even close. But I would also want to point out, there are other developed countries, where the governments have been kind of this thing. But aging population, rising costs have, created huge amount of stress in their systems. I mean, take UK, for example. Yeah. And for the first time, we started seeing people come in from the UK because, the waiting list for, let's say, a knee replacement is 28 months. Wow. So it was unimaginable in the past that people from developing countries...
On that point, how much of an opportunity is medical value travel for India as a nation, say the next 5 to 10 years?
So I think it's a massive opportunity. This is one industry where the comparative advantage that we have as a nation, no other country in the world has. Firstly, we have the demographic dividends. We're the largest producers of doctors, nurses, medical technicians in the world. We are perceived as competent. We are part of the popular culture. I mean, you won't see any television show on healthcare, ER or anything like that without Indian doctors and nurses. Everybody's been exposed to that. Look at the cost. I mean, today, a bypass in the US costs $130,000. It costs $100,000 in the UK. It's about $30,000 in Singapore, $20,000 in Thailand. Yeah. It's less than $5,000 in India. We do a bone marrow transplant for $25,000. It's $850,000 in a place like MD Anderson. We do a heart transplant for $25,000 to $30,000. It costs more than $1 million in Europe or in the US. I mean, that's the kind of differential we are talking about. I mean, the soft power we have, I think, we haven't even tapped the tip of the iceberg as yet.
So for you, 9% goes to what level?
So look, I think, if you actually see, we've been growing at more than 20% top line for many for a few years now. And what that, I mean, I remember year before last, we grew at about 30% because we added 30% capacity. And the international business grew by 30%, but it seemed like 9% remains stagnant. Yeah. So yes, it's been growing at 20-25%, but so is our top line been growing at 20-25%. I see this number grow. Again, it's a little difficult to kind of articulate or pronounce, where I see it in how much time. Okay. But I definitely see India as a leading medical tourism destination in the world. I think, we just haven't found our places yet.
Sustainable numbers for you, if you can guide us in terms of what FY27 looks like when it comes to revenue, when it comes to margins, 26 to 27% band, profit, what are you estimating?
So I'm not going to give you a guidance on numbers. I usually stay away from it. But having said that, you can imagine we just rolled out phased commissioning of 20% capacity. End of the year, before the end of the year, we would have rolled out another 10 to 12%. We don't see any impact coming through on EBITDA margins really, because majority of our rollout is brownfield. I'm not concerned about, at the very least, it should grow in line with what our capacity addition is being. Do keep in mind, less than 2 years back, we added another 30%, which is again, only coming through now.
Hello and welcome to News Center. I am Ashmit Kumar. Now, U.S. Secretary of State Marco Rubio is in India on his first official visit to the country. He met Prime Minister Narendra Modi and External Affairs Minister S. Jaishankar over the weekend. The talks covered defense, trade, investment, strategic technology and energy. Here are the big takeaways. Number one, trade. At a joint press conference with Jaishankar, Rubio called India one of Washington's most important strategic partners and pushed back on suggestions that ties had lost momentum. He expressed confidence that a bilateral trade deal could be finalized within weeks, saying that both sides are working through the final details. Number two, oil. Rubio clarified that U.S. sanctions on Russian oil were never aimed at India. He said that measures were part of a broader effort to impose costs on Russia over the Ukraine war. Jaishankar noted that energy security remains a top priority for New Delhi and called the USA a reliable source of diversification. Number three, visas and anti-India remarks. Well, Rubio addressed concerns over recent changes to green card and visa policies, saying that the overhaul of the system is not India-specific and applies across the board. On racist remarks targeting Indian Americans, he downplayed them, saying that there are people who make dumb comments all the time. Number four, Iran. On West Asia, Rubio said that peace talks were a work in progress, but negotiations had a pretty solid thing on the table. He reiterated that the ultimate goal is ensuring Iran never acquires a nuclear weapon. President Trump separately said that he had told negotiators not to rush ahead and that a deal was not fully negotiated yet. Iran's foreign ministry spokesperson Ismail Baghai said that the two sides were both very close and very far from an agreement. Number five, Pakistan. When asked whether India raised concerns about Pakistan's role as a mediator in US-Iran talks, Rubio said that the subject never came up. However, he added that India has long-standing concerns about armed terrorist groups operating outside of Pakistani territory to target the country. Number six, Quad. Rubio described the grouping as an alignment of four nations with an ability to influence global events on issues of mutual interest. He also said that India is the cornerstone of America's Indo-Pacific strategy. All eyes are now on the Quad foreign ministers meeting scheduled for tomorrow in New Delhi. On a separate note, Trump also made his presence felt by joining an event at the U.S. Embassy over the phone. He hailed India-USA ties and said that India could count him a 100%.
I just want to say hello to everybody. I love the Prime Minister. Modi is great. He's my friend. And I just want to say a very, very good evening to everybody. It's morning here and it's evening there. And I just want to say you're great. And we've never been closer to India. And India can count on me 100% and our country. If they ever need help, they know where to call. They call right here. We're doing well. We're setting records. We have a record economy, a record stock market. And anything India wants, they get. And I'm a big, big fan of Prime Minister Modi.
I view it more as a continuation of a very strong relationship and looking for new areas of opportunity. We hope to have finalized very, very soon a trade agreement that's going to make both of our countries stronger. We obviously share a lot of the same security concerns. We're also using India as the forum for our next Quad meeting for foreign ministers. In fact, it was the first meeting I ever did as the Secretary of State was a Quad meeting, and we were due for another one, and so we felt this was the right place to do it. We have a lot of commonality, obviously. There are a lot of investments in the United States by Indian companies. So I view this visit as much as anything else as sort of a continuation and just continuing to build on what we already have as a foundation and the progress that's been made in just the last year and a half in the second Trump administration.
Well, joining us now to discuss this further is with us Meera Sankar, former Indian ambassador to the United States. Also with us, Professor Adam Dixon, the Adam Smith Chair and Director of Panmure House, and Dr. Satoru Nagao, non-resident fellow at Hudson Institute. To all of our panelists, thank you so much for joining us. Ambassador Shankar, let me come to you first. I'm just going to quote from what we heard from Donald Trump. Anything India wants, they get. Prime Minister Modi is great. He's a friend. I'm a big, big fan. India can count on me 100%. Now, it's not very long back that we heard comments from Donald Trump referring to India as third world, hellhole, tariff king. Something has changed. Are these only diplomatic courtesies being extended ahead of the Quad? Or has something changed after the Iran war, after the Trump-Xi meeting?
I think we have to wait and see. Certainly, the visit is an effort to stabilize the relationship, which has seen considerable stress on many fronts over the last year. Secretary of State Rubio has said all the right words, set the tone for the relationship, emphasizing the importance of the strategic partnership and the element of continuity, building on foundations which have already been laid. But I think we have to wait and see if the rhetoric is matched by concrete outcomes. Nevertheless, I would say it's a very timely visit because of the differences which had emerged over a large number of issues, including trade and people-to-people movement over the last year. And also because of questions about the reliability of the US commitment to build or shape a balance in Asia, not under the hegemony of any one country, because there were ambiguities and uncertainties in the China policy articulated by the Trump administration from time to time.
Right. Let me take that thought across to Professor Dixon. Professor Dixon, let me ask you this. Many have been asking in the build-up to the Quad meeting, which of course is scheduled for tomorrow, many have been asking that with greater Trump-Xi engagement, China as well as the US looking to normalize relationships between them, build business ties between themselves, does that take away from the relevance of the Quad going further?
No, I think actually if you look at what the Trump administration is doing, it's trying to balance relationships across the board. But we should remember that who are the members of the Quad? They are liberal democracies, the largest of the world, that being India is a key member. So I think we shouldn't lose sight that the Quad is led by democracies, and that Trump is trying to balance the relationship with China and not have a less hostile relationship. I mean, ultimately, that's for a better international relations, and I don't think that you can have both at the same time. Is the way I would view that.
Sure. Let me take that across to Dr. Nagao. Dr. Nagao, do you share that assessment? If I were to pose the same question for you, that greater Trump-Xi engagement, does that increase or decrease the relevance of the Quad?
In this case, we cannot forget what happened in the US and China summit. Because US-China summit, the main purpose is stabilize the competition. But this means that competition itself will continue, but how to compete is under the one kind of the rule the US and China agreed. So under such kind of situation, the Quad, originally the purpose is counter China. What is the role of the Quad is matter. So that's why in this case, from the Secretary Rubio, all three countries can listen what happened in US-China summit and what is the US strategy to counter China. So that is very important exchanges of the opinion in this case. After this meeting, maybe three countries can adjust a new situation if this is new. So that's why this is very important strategic turning point, and it could be very important to counter China anyway, because in the long run, China is the only country to top the number one status of the United States. In this case, anyway, US need to compete with China.
Sure. Ambassador, let me come back to you that when we're looking at, of course, evolving relationships between power blocks, between countries, between superpowers, is there a case to be made for the Quad to perhaps transform from being a geostrategic security apparatus partnership into perhaps one that is underlined, that is marked by economic engagement?
Well, I think that India has had concerns about Quad becoming a defense alliance because we don't really see it as an Asian NATO. you have to remember we are the only Quad country with a very long land border with China, which is not defined. So clearly, this is something we are conscious of, that we would not like to provoke a conflictual relationship with China along the border. Secondly, there are priority areas which the Quad can focus on, which would be of interest to all the 3 and 4 other partners and India. And these include, setting up alternative resilient supply chains for critical minerals, which have been leveraged. Resource dominance has been leveraged in trade negotiations and also as a geopolitical, geostrategic lever vis-a-vis countries. So it would be in the interest of all 4 to try to get these alternative resilient supply chains and critical minerals going as fast as we can, because the leverage lasts only so long as dominance continues. Secondly, all these areas of new and emerging technologies, whether it's artificial intelligence, whether it is quantum computing, whether it is semiconductors, space, biotechnology, these are all areas where the 4 countries could work together because as far as India is concerned, we have fairly developed space and biotech sectors, but in quantum computing, artificial intelligence, semiconductors, our capacities are incipient and we are seeking to grow them. So the third area would be the whole area of maritime domain awareness and enhancing maritime cooperation to enhance peace and security in the Indo-Pacific and to keep open the channels of navigation so that there's free flow of commerce. I think a pruning, if you will, or prioritizing of the areas that Quad wants to work on so that we can actually see deliverables, I think would be important because it's had a very vast agenda. And I think if we actually narrow down, it will be helpful for all 4 countries.
Sure. Professor, let me come to you. As far as the Iran issue is concerned now, bear in mind that India was hosting the BRICS summit not very long back. Just a couple of weeks back, we had the Iranian Foreign Minister, Syed Abbas Araghchi, come to the national capital here in New Delhi. Now, there's been a strong push coming in from Iran for using the BRICS as a platform for calling out the US for its aggression. At least India officially, as a part of that BRICS arrangement, has not obliged. There is no statement from the BRICS nations chastising the US for the aggression in the West Asia region. What I want to ask is that post-BRICS, when this Quad Foreign Minister Summit does take place, what will be the expectations from perhaps a joint common understanding, a statement that may be issued at the end of that summit tomorrow?
In relation to the BRICS or to the Quad summit? Because I think the
with respect to the Quad summit, with respect to the Iran conflict.
Right. With respect to the Iran conflict, I think everyone can agree, and this is what Rubio said just yesterday or day before in India, was that there's no discussion that Iran should not obtain a nuclear weapon. That is clear. Whether the Quad signs a statement to that effect, I'm not so sure. I think the members of the Quad would want to be a bit more circumspect in using the Quad for that purpose, considering that it's more eastward focused, if you like, rather than more westward focused towards West Asia. And so I would not expect to see that. Now, the Iranians, as they tried to do with the BRICS, tried to mobilize this other platform to again chastise the US. But the US has been very clear, so the Trump administration has been very clear that Iran should not have nuclear weapons, nor should Iran be allowed, because this would set a seriously bad precedent, to control the Strait of Hormuz, which would go against international law for the last 400 years. We just need to look at Hugo Grotius' 1609 Mare Liberum, the freedom of the seas. And just as the ambassador said with relation to the Quad, part of the Quad is about keeping the free flow of trade that benefits everyone. And what we're seeing in the West Asia conflict is that Iran is trying to if you like, block the Strait of Hormuz and then control it in perpetuity, which goes against a foundational principle of international law, and that is the freedom of the seas. And so I think, if anything, tomorrow, the Quad would have a statement more on that effect, that the freedom of navigation is without negotiation. Whether there's a statement around the nuclear ambition of Iran, I'm not so sure. But I think something around the freedom of navigation, given the interest of the Quad in maintaining an open East Asia, if you like, corridor between Japan, Australia, India, and the rest of the region, I think that would be more of the focus from this particular grouping.
Right, Professor. On that note, let's slip into a very short break, but don't go anywhere. The discussion with all of our panelists will continue on the other side. Welcome back to News Center. You're still with us. We have with us Ambassador Meera Shankar, Professor Adam Dixon, as well as Dr. Sataru Nagao. Dr. Nagao, let me come to you. You were referring in your earlier answer about how it's important to see the Quad summit in context of the recently concluded Trump-Xi meeting. I want to borrow from that meeting. There was a very distinct red line that China had drawn, especially with respect to Taiwan. Now, Taiwan is one issue where we've seen Japan becoming increasingly more vociferous, more vocal. They're talking about Taiwan now. I just want to draw your attention to a recent interview that Donald Trump had given to Fox News, where he said that Taiwan should cool down, that they should not seek independence, and essentially saying that he doesn't want to travel 10,000 miles to fight a war there. Does this cause any concern as far as Japan is concerned, especially when it's entering into the Quad meeting?
Of course, there is a concern, but the concern is not so big. Because when the journalist asked a question to President Trump hesitated to reply about the Taiwan-related issue. This means that he understands how sensitive this is. And viewed from the geography, Taiwan is a very strong and important location to attack the coastal city of China. This means that if the US need to compete with China, Taiwan is a knife just side of the China's neck. So that's why this is a very important card. If the President Trump try to deal with China by using Taiwan, in this case, this is too strong to deal. So that's why US will not abandon Taiwan is fixed. In this case, Japan and many Japanese experts agree. So there's no concern, no strong concern that President Trump will abandon Taiwan in this case.
Right. Ambassador, let me come to you that in terms of going forward, there are many aspects that Marco Rubio has made a reference to as a part of this visit. He's talked about selling more oil. He's talked about a trade deal that's not very far away. There seems to be a transactional approach that Donald Trump wants to follow. There's a very distinct carrot and stick approach that he wants to follow. In exchange of all of these aspects, providing energy, looking at a potential trade deal, what are the areas where he'll want to extract concessions from India?
Well, on the trade deal itself, I mean, the energy sector is a sector of potential cooperation because India is seeking to diversify its sources of energy as part of its approach to energy security. But we would certainly like to take into account, availability, reliability, and affordability. All three factors come into play because there is a logistic and geographical disadvantage which the US faces as far as India is concerned because of distance. And also because the US crude is not the kind of crude that our refineries generally use. We've been using sour crudes, and I think Reliance has agreed to buy Venezuelan oil, which is a poor quality sour crude for which their refineries are equipped. So I think there are issues, but I think gas is something which we're also discussing with the US, and certainly it's a good area for us to expand trade between the two countries and for India to buy more from the US. But equally, we would like to buy from other partners because I think we want to avoid over-dependence on any one partner because we've seen that that can compromise energy security. So diversification is important, and other partners will also be in play as far as India's energy supplies are concerned. And here we recall that India was the only country singled out by the US for punitive tariffs on account of Russian oil purchases. China, which is the largest importer of Russian oil and gas, was not subjected to punitive tariffs. Europe, which was still buying Russian oil and gas, even though they were reducing, but they were buying perhaps in certain cases more than India, was also not subjected to punitive tariffs, nor was Turkey, which was another country buying Russian oil. So I think we need to avoid these kinds of scenarios in future where the US seeks to squeeze India's energy options I think that plays very badly in terms of how the US is perceived in India. Buying more from the US is something we would like to do on our own, but not exclusively from the US. In terms of trade, yes, we had a framework for a mini trade deal, and then the US Supreme Court struck down Trump's tariffs. So the whole US tariff policy is right now in the melting pot. There's a uniform tariff of 10% on all global partners, but the US has started investigations under Special 301 on certain trade partners, including India, on account of unfair trade practices, so that they can again impose higher tariffs. Now, if you look at the trade deal, which we were willing to accept at that stage, it was a one-sided trade deal because the US was going to increase its MFN rate of tariff to 18%, even though it was bringing down the punitive tariff from 50 to 18. While India was expected to, reduce duties across the board, but we were still willing to live with 18% because it was marginally better than the tariffs for other developing countries in Asia. They had 19 or 20% tariffs, and China's tariffs were anywhere between the region of 28 and 32%, though nobody quite knows. There have been so many changes in China tariff policy. So unless this relative weightage that is assigned to tariffs to different countries becomes clearer,
Right, Ambassador.
I think it would be premature for India to accept 18% tariffs when we are paying 10%.
Well, that's an interesting comment. Let me take that across to Professor Dixon as well. We're running out of time, Professor Dixon. One quick word from you. Again, some of these issues that India is bringing up with respect to oil, we want to continue buying from West Asia. We want to continue buying from Russia as well. That's a very distinct position that India has communicated. On trade deal itself, India has pointed out that, look, there's a Supreme Court ruling against the Trump tariffs. India has its own concerns with respect to preferential access as well. Does this, again, come at the cost of perhaps patience being exercised by Washington? How much of a wide berth is Washington prepared to give to New Delhi?
So I think, India is doing like any large country, any country should do, and it's trying to be diverse in where it accesses not simply commodities like oil and gas, but other products. And I think that's what, going back to trying to understand some of these global trade relationships and the position of China, is that no one benefits from any one product being concentrated and supplied by one country. And so I think India is right to diversify where it's getting its resources from. At the same time, particular suppliers of resources have other issues that mean that those relationships come into question, Russia being one of them. Now, ultimately, I think the U.S. position vis-a-vis India is one that, historically has been about how do we open up more trade. India's had a history of being relatively closed and more autarkic, let's say, than even the Chinese have. And I think, but we've seen over, in recent years that India has increasingly opened up. And so some of that back and forth between, I think, the U.S. in terms of the recent history of the Trump administration, which I don't think is necessarily as pro-trade as it should be, though I think there is an underlying sense of how do we move to a global trade system that is a bit more fair, a bit more understanding of some of these geoeconomic competition elements that complicate, let's say, a simple view of the world.
I'm just going to have to come in there. We've completely run out of time. But like you said, many issues, many moving parts as far as this relationship is concerned. The Quad meeting, of course, begins at 9 a.m. tomorrow from right here, the national capital, New Delhi. I'd like to thank all of our panelists. And with that, it's a wrap on this edition of News Center. More news and updates shall continue right here.
Welcome to Indianomics. The rupee has recovered a tad over the past 2 days, but remains one of the weakest Asian currencies in 2025 and 2026. Since the closure of the Strait of Hormuz itself, Feb 28, it has fallen nearly 6% again, more than other Asian currencies. The government has taken steps like raising gold import duties, cutting fuel export duties, etc. Raising fuel export duties, etc. The Reserve Bank has cut speculative positions of banks. Now, what else? Today, I have with me two stalwarts to discuss what more policy options the RBI has, which could come, as early as in the upcoming policy. But separately and importantly, we are also going to discuss if interest rates should be used to defend the rupee. My guests are former SEBI member Anant Narayan and former veteran banker. The other guest, former Reserve Bank ED and MPC member, economist Mridul Sagar. Let me add at the outset, I am not saying at all that RBI will use rate hikes. We are having an academic argument on whether we should begin thinking about rate hikes to defend the rupee. So, Anant, Mridul, with that intro, welcome to the show. Thank you very much for joining me, Anant, especially in the studio. So, let me start with you. We'll come to the interest rate debate in a bit. First up, without counting hikes, what more does the Reserve Bank have? They went hammer and tongs at the bank speculative positions. Can they do any more?
Sure. Thank you for having me, Lata. So to start with, yes, there is overreaction happening in the currency market. But I think it's important to take a deep breath and ensure we don't panic and hyperventilate. The reality is RBI still has $580–590 billion of net reserves, even after counting the forward sales. So there are plenty of buffers available to manage whatever crisis unfolds over the next few months and weeks. So that we should take a deep breath and start with that and not start to shoot in all directions and try and see what can be done. That said, of course, there are things that need to be done because, as I mentioned, there is an overreaction happening in the rupee. I think the rupee has moved far away from its fair value. And one of the big components of that, I think, is sentiment. The reality is the demand for dollars that is emanating right now is not just your traditional balance of payments components like current account deficit or FDI or FPI. It is more the fear and greed trade also playing in terms of very negative sentiment, which is coming in and buying in dollars.
Yeah. Can you give those numbers, FY26?
So, I had done this math this is an estimate, for FY25 and FY26. I estimate that the RBI has sold between spot and forward markets about $190 to $200 billion in the currency markets. Against that, if I look at current account deficit, the FDI numbers and the FPI in equity for those two fiscal years, that's about $85 to $90 billion. So my point is that the amount of dollars that the RBI is selling, about $110 billion, for other purposes, which is likely hedging or speculative positions, is actually higher than the gap that you're seeing on the balance of payments, the normal components. So that sentiment has to change. And specifically, and also let's look at this, we are talking about a current account deficit for FY27 of 2 to 2.5% of GDP. This is nothing.
Yeah.
We've lived with these numbers forever. So
for 3-4 decades.
Yeah, the average, I think, since the beginning of the century is around 2% of GDP. So these numbers are not extraordinary at all. So one of the reasons why we should not be panicking is precisely this. It's about getting 2% of capital flows again, net capital flows again, which is not beyond us.
Okay.
So I think changing the sentiment, particularly with respect to capital flows, would be a big area of my focus. There are hundreds of other variables. It's not a univariate equation. And to me, and you've heard me bleating about this in the past, I think some of our irritants that we have with respect to capital coming into the country, even outside of Iran, we would have been addressing them anyway.
Yes.
So things like, for instance, the fact that we have a source-based taxation regime in India, which is a major irritant at multiple levels for both FDI as well as FPI. I think we should be looking to move towards residence-based taxation, removing a big irritant for all major players, and therefore allowing capital to come back in. I think that's a big area of focus. There are other areas as far as FDI and FPI need to be done as well. On other matters, look, the other big debate that I would like to have is we have to recognize that interest rate markets and currency markets go together. They're intrinsically intertwined. You cannot divorce one from the other. Now, to that extent, while we see a lot of debate saying, oh, the currency market should be freer, let the currency find its own level, I don't see an equivalent debate happening about interest rate markets, which I think see a lot more intervention than even currency markets.
Yeah, absolutely.
So this lopsided argument, I think if we allowed the interest rate markets to be a lot freer, if you reduce the level of, to use the harsh expression, financial repression, I think you will find a natural balance at multiple levels, as where capital allocation is concerned, savings is concerned, capital flows is concerned, if you allowed both markets to be equally free.
Fair point.
So I think that's something that you have to move towards. Finally, I would strongly advise against measures such as capital controls at this point in time. As I said, we should not be panicking. Even if you intend to do capital controls for a short period of time, I think the impact that it will have on sentiment in the medium term will be dramatic. I think Dr. Subbarao wrote this very nice piece in the Hindustan Times recently, where he used his own experience to warn against doing anything which sounds like capital controls. I completely echo that. While it might sound like it's the right thing to do in the short term, these things are never only have a short-term effect. Absolutely. The sentiment effect will be completely against what I'm arguing for improving the sentiment of the country.
Fair enough. Mridul, we are going to come to the interest rate debate in a bit. Mridul, I just want to ask you, don your RBI hat, not on the rate issue, but what else can we expect, or would you do if you were in the RBI today to defend the rupee?
So the first thing I would do is to sort of use soft capital flow measures. I know Anant has said that we shouldn't have capital controls, and I'm pretty conscious of that, yes. And I think there is somewhere in the middle an option to use fine capital flow measures which fall short of the total capital controls.
Such as?
But these must be backed by very good communication of structural reforms, of addressing the core issues which is driving portfolio flows away from India, be it the fiscal gap, which is people crunch the numbers and see a delayed response from the government in terms of price hikes for petrol and diesel, which seem to have opened up some sort of a fiscal hole. So you need a confidence on macroeconomic stability. You also need to take some measures forward-looking that we still have an India story. I mean, we may not have joined the AI race in time, but there is still an option to join it. We need to create some sort of positive momentum to get into the...
Okay, I think you have lost Mridul for just a bit. We'll get back to Mridul in a minute. I wanted to ask you the other thing that was floating around. The Indian sovereign doesn't want to raise sovereign bonds. They've made it amply clear time and again. There was a plan that semi-sovereigns like PSU banks can be asked to raise ECBs or bonds. Doesn't that sound like a good idea? Only the hedging cost borne by a Reserve Bank as a subsidy?
I think the broad objective, Lata, has been to see if we can shore up dollars at short notice, maybe $60–70 billion, in order to give some confidence to the ecosystem and achieve what I was asking for, which is a little more confidence around the fate of the rupee. So I agree with that objective. I think, depreciation sometimes begets depreciation. It can become a vicious loop where negative sentiment can lead to more positioning and therefore becomes a vicious cycle. You have to arrest that cycle. We saw this in 2013, where the launch of the FCNRB scheme suddenly made a change as far as the sentiment was concerned, and that practically saw the peak on dollar rupee at that point of time, and we saw a correction thereafter. Having said that, I would again caution that the use of any kind of distortionary instruments has to be done with a lot of care and at the right time. We don't know how long this problem is going to continue for. Do you want to use all your arrows right now from the quiver, or do you want to keep something for later, particularly since all of them come at a cost, come at distortions, and you don't know what the unintended consequence can be. Having said that, compared to an FCNRB scheme which was done in 2013, I agree with you that giving a swap window where you give a subsidy for people who are raising dollars from overseas, either through loans or bonds, to swap it into rupees at a subsidized rate, given that that money will probably be deployed into capital formation and creation of new businesses, I think it sounds like of the discretionary ideas, this sounds like the better idea.
Best.
And it will shore up the reserves of the RBI as well, along with capital formation.
Okay, I want to start the interest rate debate. It will pour on into the next segment. So let me start with that. Just give me your initial 1 minute comments. Mridul Sagar, do you think that at some point FIT, flexible inflation targeting, wants you to use interest rate for inflation and other steps for exchange rate? But at an extreme time when India's rupee is the worst performing currency for 2 years in a row, BOP is in deficit for 3 years in a row, should you not use rates to defend the rupee?
Lata, you asked me at the time of April policy this question, and I did mention to you that I see rate hikes later half in the year. I still stand by that. I don't think we need to jump and raise the rates. This is a classic shock, which is cost push inflation in a stagflationary environment. And you need to see a clear evidence of generalization coming in, inflation expectations coming in. The first sign of it has emerged in terms of the latest WPI numbers, where the inflation has shot up to 8.3%, and the disperse of it is pretty large. But I won't go Bank of Indonesia or Bank of Philippines has raised the rate.
Got it. Mridul, since we have to get into a break, Anant, first step, I'm going beyond what Mridul is answering. I'm saying it is not that inflation is on the horizon, because the Reserve Bank's scenario says that even if they accept $95 per barrel for the full year, their CPI forecast is working to only 5%. Not inflation. I'm asking you, should they use it purely to defend the rupee?
I'm going to change the question, Lata. I'm going to ask the question, what should be the, forget about crisis and should you use interest rates right now for defending the rupee? That's a very extreme question. My broad point is, whether you like it or not, the three issues, which is interest rate markets, capital flows, and currency markets, are intertwined. You cannot divorce one from the other. This is the impossible trinity that we all know of, and Urjit Patel report of 2014 also completely acknowledged it, and every economist and trader will acknowledge this as well. Now, changes in interest rates impact capital flows and currency markets and vice versa, right? How does changes in interest rates impact? So for instance, if the differential between Indian rates and the USD rates are too narrow, if it's only 1.5% or 2%, will foreigners come in and invest in our debt? On the contrary, will you actually see domestic high net worth individuals saying, I might as well take out my money and invest in, through the ODI route or LRS into US debt, where the differential is only 2%, which means that, I'm holding a hard currency at a pretty high rate compared to my own rupee currency, right? The second problem is, because, and I go back to my point about possible financial suppression in this country, because you've had a lot of intervention in interest rate markets, keeping the rates low. We know RBI did 8.8 lakh crores of OMO purchases. They kept the liquidity substantially high, 2 lakh crores of average liquidity surpluses, which obviously suppressed not just the overnight rates, but practically the entire yield curve, right? Now, when you have that and you have a taxation which is against investments into debt compared to equity, what happens? You have domestic investors moving away from your interest rate markets and putting more money into the equity markets. One, it reduces the amount of money available in credit markets. It doesn't allow it to develop. Second, you have potentially too much money going into equity
overvalued
markets and creating pockets of overvaluation, which in turn impacts FDI and FPI flows. So in a very vicarious way, there is an impact there as well. The third impact, the forward rate for dollar rupee depends upon the differential between the dollar and rupee interest rates.
And then I have to interrupt you because it's a mandatory break time. But we are going to continue with this discussion, whether the time has come or a time could come when interest rates may have to be used to defend the rupee. Important debate, back in a jiffy. Welcome back to this very special Indianomics. In this part of Indianomics, we are discussing whether interest rates should be hiked to defend the rupee. Before going to break, Anand was explaining to us that because we tax interest income higher and not equities, we see more money going towards equities, leading to higher valuations, and therefore foreigners not coming in because the valuations are high. Anand, complete your argument.
In fact, one FPI was telling me tongue-in-cheek that your bond markets are overvalued thanks to RBI and your equity markets are overvalued thanks to your retail investors. I don't say I agree with him. I'm simply saying what he told me. But coming back to the point, when your interest rate differentials between rupee and dollar are narrow, that determines the forward premium for dollar rupee. What happens is, in fact, in 2025, we saw points where the 1-year forward premium was between 1.5% to 2%, which means if you're either worried about rupee depreciation or you're betting on rupee depreciation, the premium that you have to pay is very, very low compared to what you expect as the possible depreciation. And remember, this was coming at a time when for the last 2 fiscal years, we had a balance of payments deficit. We had RBI having to intervene heavily with dollars being provided. And the narrowing differentials or the narrow differentials exacerbated both the fear trade as well as the greed trade. There were people who were hedging ECBs, imports, FPIs who were hedging their investments. Plus, there were, including offshore punters who were taking on long positions on the dollar against the rupee. So narrow differentials also helps, express an FX view. And if that narrow interest rate differential is also, impacted by intervention by the RBI, both on liquidity and on bond markets, it is unnatural to the extent that you're offering cheaper rates to people who want to bet against the rupee. So I'm saying that these are interconnected. Now, I'm not saying for a minute that you should not intervene in either the rupee market, the interest rate market, or the currency market. Having said that, you should be thoughtful about what the nature of the intervention is. Of course, if you find inflation is low, as it was the last year, and if you find that the nominal growth rate is reasonably low, even though your real growth is high, and you want to give growth a fillip, you should consider that. But at the same time, when you're undertaking intervention, including rate cuts, liquidity, OMOs, to push through that rate view, what is going to be the impact on the other markets, right? I'm saying this debate, and everybody understands that there is an impossible trinity. You have to make the clinical diagnosis as to whether the impact on the currency market is acceptable, and thereafter you do whatever you have to do on the interest rate market. So it's a bit like this. Monetary policy or any intervention is like administering a medicine, right? When you administer medicines are poison. Any intervention is poison.
There will be contraindicators.
There will be contraindicators. There will be side effects. What you have to ensure is that the side effects don't leave the patient worse off than what she came in with in the first place. First, do no harm. I'm saying that analysis is required. You cannot, at the moment, MPC's discussions are fairly concentrated only on inflation, growth, and interest rates.
I have to get. Mridul, you are the flexible inflation targeting person. You have been an MPC member under that regime. Do you think that at certain points, when all macros are okay, you go with flexible inflation targeting, one instrument, interest rate, for one goal, inflation. But sometimes you have to change when things are extreme. Would you agree?
I agree, and we have said that in the Urjit Patel committee report. I mean, that allows for a certain amount of flexibility on the exchange rate issue. We are not inflation, not like the Bank of England, which stopped intervening, which stopped acting in the market because George Soros broke the back of Bank of England's interventions. Now, the point is, if you see, say, the yield differential between the US Treasury, 10-year Treasury note and the Indian benchmark 10-year yield, from 2000, it has averaged like 372 basis points. If you see the current differential, that is in the vicinity of 243 basis points. Now, it has narrowed. It has not completely shrunk. But if you have to have the capital flows come back, you ought to hike rates by 100 basis points. Would that be acceptable to this economy, which is already facing a stagflationary shock? It's not going to work that easily. So it has to be packaged along with that you hold in for the now, but prepare the markets for possible rate hikes should the Iran war deepens, should it accelerate from here. Then you don't have an option, because headline inflation would soon be crossing 6%. It's only the core which is giving us the comfort. And core, including gold and silver, still is tracking 2.4%.
That's right.
So we have some room to wait.
Okay.
And we can use that, but we have to be cautious that it takes 2 to 3 quarters for the monetary policy to work. And there is sign that generalization has begun with the WPI numbers showing quite a split.
Yeah, you're coming back to the inflation argument. Out of time, but I want to play the devil's advocate, or play the FIT argument. India is losing equity flows. Debt flows have been sticky. We've hardly lost any money despite the interest rate differential. And equity wants lower interest rates. So, how is your argument of higher interest rates working?
Again, it goes back to what I mentioned, which is if your domestic flows are, discretionary domestic flows are being tilted towards the equity markets to the extent that it's higher than the net supply of fresh equity happening in the ecosystem, there are pockets of overvaluation possible, which we have seen. And at overvalued markets, and including what Mridul mentioned about, India, AI story, etc., that you're offering exits to the FPIs at good rates. I just want to quickly add to what Mridul said, and I agree with him. Look, policy making cannot be dogmatic. You have to make choices. You have to choose between what kind of, interest rates is acceptable, including in the political economy. We live in a real world. We don't live in an ideal, world. Yeah. Having said that, all I'm asking for is, can we have a better debate where we actually look at all the impacts of whatever we are doing by way of intervention? Okay. Whether it is in currency markets or interest
one minute. There is a suggestion that you make it a little more expensive for importers to hedge by asking banks to have more reserves when they hedge. Will that, very quickly, will that work?
To start with, if you, for instance, allow liquidity to go into a deficit now. By the way, liquidity going into deficit is actually a market signal that's coming to you. If you're losing deposits because of FX outflows, the market is telling you, please raise your short-term rates so that you retain your deposits and don't lose it outside. So if you go back now and listen to the market and allow liquidity to go into deficit, that itself will push up your forward premium accordingly. That said, if you want to intervene further to make it expensive for importers to hedge or for people to speculate against the rupee, even though it's distortionary, you can contemplate measures. Not just what you mentioned. You can also, because we don't have capital account convertibility in India, you can, for a short period of time, have rupee implied rates in the FX market higher than what the domestic interest rates are, which has been seen for time immemorial. That can also be encouraged. For that, you should allow, for instance, the RBI to take delivery of the forward sales that they've done, so that they're not replenishing the liquidity by doing repeatedly buy-sell swaps and infusing liquidity. Let the forward premium go up to an extent that you have demand supply being determined by the market.
Fair point. Well, this debate is not over, but our experts are telling us that don't shut the interest rate argument completely. Both Mridul and Anant agree, and Mridul says that even the Urjit Patel report says that in extreme situations one would use, but at the moment we are not, perhaps there is no need to panic. There are other instruments available, but liquidity is probably something the Reserve Bank should think about. Thank you very much, Mridul and Anant, for whetting our appetite. We will have more such debates. Thank you for watching Economics.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The rupee ends at a two-week high of 95.23 against the dollar. The currency appreciates against the greenback for the third day, regains most of its losses that it incurred since the start of the month. The market also closes in the green. The Nifty ends above 24,000, led by financial heavyweights and Reliance. Nifty Bank outperforms, closes over 2% higher. Iran says progress has been made on several issues with the United States, but an agreement is not imminent. Also insists that charges for services provided to vessels crossing the Strait of Hormuz should not be described as a toll. President Trump says he has instructed officials not to rush into a deal. Oil prices fall below the $100 a barrel mark amidst hopes of a possible breakthrough. The U.S. Secretary of State Marco Rubio calls the Iran deal a work in progress, says Delhi does not have any issues with Islamabad's role as a mediator between Washington and Tehran. Also downplays racist remarks directed at Indians, says stupid people exist in every country. Fuel prices hiked for the fourth time in 11 days. Prices have now risen by over 7 rupees a litre since the 15th of May. Sources say India's fuel price increase is the smallest material hike for any major economy outside the Gulf region. OMC losses have now trimmed to less than 600 rupees a day from 750 crore rupees last week.
India cannot afford fear-mongering. We need to give confidence to the people with our words and with our action.
Finance Minister Nirmala Sitharaman calls for a sharper focus on the 3F, says challenges on fuel, fertilizer and forex are external, adds the Indian economy remains resilient, also hits out at naysayers for their pessimistic, cynical narrative, says India cannot afford fear-mongering. US H-1B visa approvals widely used by Indian IT professionals seeking jobs in the US down 35% year-on-year. Indian IT firms take a hit. The Trump administration clarifies that many H-1B visa holders who have applied for green cards may continue to stay in the US while their applications are being processed. VinFast-backed Green SM to launch all-electric ride-hailing services in Delhi next month. Plans a nationwide rollout later. Guarantees a monthly salary of 35,000 rupees for drivers in the initial phase. Let's go straight to the top story this evening. The rupee rebounding for the third straight day, touching a two-week high of 95 against the dollar. The Indian currency has now regained most of the losses that it recorded this month. This, as RBI Governor Sanjay Malhotra told the Mint that the rupee may be undervalued in both nominal and real effective exchange rate terms after its recent fall. That is. Ritu joins us now with more on the rupee. 95.23 is where the dollar rupee closed for the day. Ritu, what did the markets make of the governor's comments?
Well, yes, the rupee staged a sharp recovery today, and there's a couple of reasons behind that move. First, and importantly, of course, crude oil prices have eased back below the $100 a barrel mark following reports of a possible de-escalation intentions between the US and Iran, which is a key positive for India, given our large oil import dependence. But markets were also very closely tracking RBI Governor Sanjay Malhotra's comments in an interview to Mint, where he struck a stronger than usual tone on the rupee. Now, he made it very clear that the central bank would step in aggressively to curb any excess volatility or speculative moves in the currency market. In fact, he said RBI would do, and I quote, whatever is required to ensure orderly price discovery in the forex market, adding that India has about $700 billion in forex reserves, along with other tools to deal with disruptive market moves. But what really caught the market's attention was the governor's remark that the rupee may now actually be undervalued after the recent fall. Remember, the rupee has weakened by more than 6% so far this year because of foreign equity outflows, higher oil prices, the global risk aversion linked to what's happening in West Asia. And the RBI governor now said that one could argue that the rupee is undervalued both in nominal terms and in the real effective exchange rate, or REER terms. Now, RBI data shows that rupee's real effective exchange rate index fell to 90.96 in April, which is its lowest level since at least 2014. And remember, a reading below 100 generally indicates undervaluation. Now, Sanjay Malhotra also suggested that if tensions in West Asia ease, the rupee could see some appreciation, which is similar to previous episodes of external shock-driven volatility. Now, on the external sector itself, he acknowledged that higher crude prices can put pressure on India's current account deficit, but he did reiterate that services exports, remittances and capital flows remain resilient, adding that the overall balance of payment situation remains manageable.
All right, Ritu, many thanks for joining us. The rupee ending at a two-week high. From the currency market to the equity markets, the market's also closing in the green for the second straight session, starting Monday strong. The Nifty ending above the 24,000 mark. The Nifty Bank up over 1,200 points, a gain of over 2% there. The mid-cap index up by almost 1.5% higher there on the Sensex. Prashant standing by to wrap up the day's market action. Prashant, clearly the market's hoping, betting on the fact that there could now be a negotiated agreement between the US and Iran.
Well, flurry of headlines over the weekend that things are getting better. Perhaps a framework deal, a structure is in sight with regards to the talks between US and Iran. And all of that had an impact as far as oil prices are concerned. So from Friday morning rate of about $104 on oil, we started this morning at about 99. And through the course of the session, we saw oil prices dropping off a little bit more. So that showed up. I mean, the Nifty ending about 300 points higher. Last Friday, we ended about 90 points in the green on hopes, and it was backed up with today's 300-point move on the Nifty. But Bank Nifty also did well. I mean, actually 2%, and PSU banks did well. Private bank index was up about 2% or so. The other sectors were the auto space, which was up, even though we have the fourth price increase for petrol and diesel, which came through. The capital market index was the other one, which did quite well if you look at sectors in that sense. VIX cooled off about 7.5%. But that's it. I mean, otherwise, except maybe an FMCG index, which was sideways, it was a good session all told. Let's just look at the Nifty stocks. Aisha was the big gainer after numbers, ended up 6% higher, so 7,400 on Aisha. Adani Enterprises was up 5%. Tata Motors Passenger Vehicle, Bajaj Finance, L&T, HDFC Bank, Eternal were some of the 2% moves. Actually, you had about 10, 12 names on the Nifty with gains in excess of 2% today. Max Health was down big on Friday. It was down another 2.5% today. ONGC was down about 1.7% and Hindalco was down about 0.8% or so.
All right, Prashant, many thanks. Now, the government has hiked petrol and diesel prices for the fourth time in 11 days, registering an increase of around 3 rupees a litre. With the latest hike, the standalone prices of petrol and diesel have cumulatively increased over 7 rupees a litre since the 15th of May. Now, the oil ministry sources suggest that the daily OMC losses have been cut to less than 600 crore rupees from 750 crore rupees. That was the number just last week. Sudarshan is standing by now with more on the fuel price hike and what it means for oil marketing companies. And of course, the prices on your screen tells you what it means for you and me. Sud.
Oil marketing companies have been in the focus for the last few days, and today also shares of all the three names, IOC, BPCL and HPCL, are sharply higher, tracking move in crude and the fuel prices. So over the last 2 to 3 days, we have seen a sharp downtick coming in crude price, and today Brent is hovering around $100 per barrel. It's a sharp downtick that we have seen against the recent surge that we had seen, and recent surge had taken Brent to as high as $126 per barrel. Second headline is the fuel price increase. Today, in another round of price increase, petrol and diesel prices have been increased in the range of rupees 2.61 to rupees 2.70 per litre, and following this round of increase, OMCs are incurring losses on diesel at rupees 35.50 per litre, and on petrol, it's rupees 10.50 per litre. It's a decrease of rupees 2.50 if you compare after the loss that they were incurring after the last round of increase. And the information we have from the sources, they say India prices petrol and diesel at or below most of the developing world. In majority of the economies, petrol prices have surged to as high as rupees 150 or say rupees 180 per litre, while in India, prices are still around rupees 100 per litre, even after the increase of a little over rupees 7 that we have seen in the last 10 to 12 days. But major surge in share prices we have seen mainly on the back of fuel price increase and also the crude move or crude downtick that we have seen over the last 2 to 3 days.
All right, so many thanks for joining us. And here is the latest in the West Asia conflict. US and Iran are still talking about a potential deal, but it looks like it will take more time, even though progress is being made. Here are the latest developments of the day. Now, President Trump continues to hint at a possible escalation, while at the same time saying that negotiations are constructive. Trump posted an AI-generated image of a large bomb mounted beneath a military aircraft. The words, "Thank you for your attention to this matter," were painted on the side of the bomb. President Trump said that the deal is not fully negotiated yet, while adding that talks are underway. Earlier, Trump had posted an AI image of a U.S. military aircraft bombing an Iranian ship. Now, according to an Axios report, the White House says a deal with Iran could take days. Iran has tempered expectations as well, with its leadership saying that an agreement is not imminent despite progress being made. Iran's foreign ministry spokesman has said that two nations have reached a conclusion on a large portion of the issues under discussion. He also said that providing services to vessels crossing the Strait of Hormuz must come at a fee, but stressed that what is being charged should not be classified as a toll. President Trump and Israel's Prime Minister Netanyahu had a call. They discussed Hormuz and Iran's nuclear enrichment. Netanyahu said that President Trump reaffirmed support for Israel's right to defend itself against threats on all fronts, including from Lebanon. This as Israeli air attacks continue to target southern Lebanon. According to an Axios report, the U.S. president has urged Gulf counterparts to sign peace deals with Israel once a deal with Iran is reached. In the oil market, Brent crude prices fell below the $100 mark on hopes of a possible deal. The Iranian Revolutionary Guards claim that 33 vessels have passed through the strait in the last 24 hours after Iran's approval. According to shipping data from Kepler and LSEG, 2 LNG tankers bound for China and Pakistan have made their way through the waterway today. U.S. Secretary of State Marco Rubio in India says that Iran's deal is a work in progress. Here's the Secretary of State. Listen in.
Pull it off. It has a lot of support in the Gulf. It has a lot of support globally. Every country that we've walked through it understands it's not just very reasonable, but it's the right thing for the world to get done. As the president said, he's not in a hurry. He's not going to make a bad deal. I mean, the president's not going to make a bad agreement. So let's see what happens. We're going to give diplomacy every chance to succeed before we explore the alternative.
We are not collecting tolls. I believe we should be precise in our choice of words. We are not seeking to collect tolls. The actions taken by Iran and Oman to draft a protocol or a mechanism to ensure the safe passage of ships through the strait represent a responsible step that is in full compliance with international law. Naturally, the service provided alongside the measures to protect the environment of the strait, the Persian Gulf, and the Sea of Oman require costs to be covered. These should not be referred to as a toll or fees.
Well, that is the Ministry of Foreign Affairs spokesperson in Iran. The U.S. Secretary of State Marco Rubio, who's currently in India, has said that Delhi did not bring up concerns about Islamabad's role as a mediator between Washington and Tehran. Speaking to reporters, Rubio also downplayed racist remarks directed at Indians. He said, and I quote, "Stupid people exist in every country." End of quote. He added that sanctions on the purchase of Russian oil was not aimed at India.
They're concerned about the things they're always concerned about, obviously. India is always pointing to the fact that there are armed terrorist groups operating from Pakistani territory that target India. They're always concerned about that. But as far as the role they played as a mediator and a facilitator in the Iran situation, it never came up. I don't think that they would complain about that. I mean, their issues with Pakistan are different.
I view it more as a continuation of a very strong relationship and looking for new areas of opportunity. We hope to have finalized very, very soon a trade agreement that's going to make both of our countries stronger. We obviously share a lot of the same security concerns. We're also using India as the forum for our next Quad meeting for foreign ministers. In fact, it was the first meeting I ever did as the Secretary of State was a Quad meeting, and we were due for another one, and so we felt this was the right place to do it. We have a lot of commonality, obviously. There are a lot of investments in the United States by Indian companies. So I view this visit as much as anything else as sort of a continuation and just continuing to build on what we already have as a foundation and the progress that's been made in just the last year and a half in the second Trump administration. The Russian oil purchase issue obviously had nothing, it wasn't about India. It was about a desire to impose a cost on Russia because of the war in Ukraine. And India just happens to be a big purchaser, but it was never aimed at India per se. There's been some new dynamics in place nonetheless since that time. And so I think what you've seen, though, is that in the process of addressing that, we've also seen an opportunity for India to continue to its plan, its already pre-existing plan, to diversify its energy sources. And that includes the United States and potentially some other countries like Venezuela Venezuela. So we want to continue to be a good partner in that regard. And so I don't think that issue is going to feature very prominently in the future because India was already moving towards diversification. And so, as I said, and hopefully the war in Ukraine will end.
Well, that's the U.S. Secretary of State Marco Rubio. He also flew to Agra today and spent 45 minutes at the Taj Mahal with his wife Jeanette and then visited Jaipur's Amber Fort. He is scheduled to attend the Quad Foreign Ministers meeting tomorrow before wrapping up his 4-day tour. Ashmit joins us now with the key highlights from Rubio's visit. A 4-day visit to India, Ashmit, plenty packed in there.
Well, indeed, 3 days in as a part of that 4-day visit. He's today, of course, as you mentioned, in Agra and Jaipur, soaking in the heat. And he's quick to point out that he's from Miami, so he's not new to the heat. But nonetheless, going forward, as a part of this 4-day program is concerned, he landed on Saturday. He, on day one itself, met the Indian Prime Minister, reaffirmed the ties between the two countries, even extended an invitation to the Indian Prime Minister to come to Washington later this year. But as far as some of the takeaways are concerned, bear in mind that there are multiple moving parts as far as this dynamic relationship is concerned. First, on trade. On trade, he's clarified that, yes, there is significant progress being made between two sides, even alluded to how a deal, at least an interim framework, could be only a few weeks away now. That's an important indication coming in from the Secretary of State. On oil, he's clarified that as far as the Russian sanctions are concerned, it's not aimed specifically at India. It's aimed particularly at Moscow, and that reaffirming the American position of wanting to supply greater energy to the Indian economy, to India. On the green card tightening, again, he's clarified that that is a broad-based approach. Again, India is not the focus of that tightening of the green card regime, and therefore should not be construed as such. On Iran, saying that there is a solid progress being made, that the negotiations are on a solid footing. Of course, we heard from President Trump himself when he said that he's pushing his negotiators not to push too hard as far as the timelines are concerned. And finally, of course, the Quad today, Rubio soaking in the sights and sounds and the heat of Agra and Jaipur. He'll be flying back to the national capital tomorrow. And tomorrow, 9 a.m. is when the Quad kicks off, and this will be critical. Rubio was quick to point out as a part of his first media engagement when he said that his very first meeting as taking over the Secretary of State was, in fact, a Quad meeting, pointing out now that India is the cornerstone of America's Indo-Pacific strategy. So clearly, stakes are high. Tomorrow, 9 a.m. is when the Quad meeting will begin between the foreign ministers of India, Japan, Australia, and, of course, U.S. Secretary of State Marco Rubio.
All right, Ashmit, many thanks for joining us. Now, H-1B visa approvals widely used by Indian IT professionals seeking jobs in the U.S. are down 35% compared to last year. This also includes 6 major IT firms whose H-1B approvals fell by 6,000 cumulatively. Rima standing by with the details. Rima, how are Indian IT companies coping? What kind of numbers have we seen?
Thanks so much for that. We're talking about a 35% drop in the new H-1B approvals for the current year. So the total 2026 approvals stand at 11,000. The comparable number last year was more than 17,000. So we're looking at a drop of more than 35%. And this is data from the top 6 major IT companies: TCS, Cognizant, Infosys, HCL Tech, Wipro, and Tech Mahindra. There are multiple factors driving this, but predominantly it is a strategic reset by the way the companies are delivering work. There has been a very conscious effort by the Indian companies to reduce their dependence on H-1B visa, and every year the numbers are telling you the same story. They are focusing on local hiring, nearshoring, offshore delivery centers from India. But it's also a story about tightening immigration norms. There has been a $100,000 fee for H-1B petitions, which became effective last year. The move from random lottery system to make the approval has now moved to wage weighted. So they are focusing on people with higher skills, higher wages. So it's a combination of factors, but the numbers are telling you a story of a strategic retreat by the Indian IT companies and tightening immigration norms by the US. But separately, there was a lot of news flow over the weekend which caused panic, consternation amongst H-1B visas. So on 22nd of May, the US administration issued a directive which basically said that all foreign visa holders, this includes H-1B, that if you want a green card holder, if you want a green card, then you have to go back to your home country, apply at the US embassy there. Now, you know the process of converting your H-1B into green card can take months, it can take years. So there was a lot of panic because there are so many people waiting for years to get that green card permanent residency, and they face the prospect of leaving their jobs, families, homes in the US, and there was no guarantee that that approval would come through very soon. But then the clarification, some rollback came in from the USCIS, which said that people who present applications that provide an economic benefit or otherwise in national interest will be able to continue on their current path. So basically, H-1B visas holders, workers who add economic value can apply for their green card from the US. They don't need to go back to their home countries. So there is a clarification which has come through, but it's not a guarantee. Right? Earlier, it was pretty much, now it just seems that there is some more uncertainty and discretionary, but there has been a significant rollback on that green card directive, at least for H-1B visas. So that should allay some concern.
Yes, it certainly will. Rima, many thanks for joining us. Finance Minister Nirmala Sitharaman has called for a sharper focus on the 3 Fs, adding that the challenges on fuel, fertilizer and forex are external. Speaking at an MSME event, the Finance Minister also hit out at naysayers for, in her words, the pessimistic, cynical narrative, asserting that India cannot afford fear-mongering. Take a look.
Please understand the context of these 3 Fs. 3 Fs. Fuel, fertilizer and foreign exchange. And the foreign exchange is for, in this context, purchase of gold. So we need to understand this, and we also should appreciate that the challenges are more external driven. We must also recognize that India's domestic economic situation remains positive and resilient even today. Therefore, those naysayers who jump into the scenario, as it were, and say, oh my God, you look around yourselves, it's all falling down, it's crumbling, it's going to hit you. There is a section, I would think, of Indians who very quickly want to decry the achievements of our own people. And therefore, for all the good that is being done by the common people themselves, that is forgotten. And a pessimistic, cynical narrative is generated, which is just not right. It's not right is one thing, but it is wrong because it is fear-mongering. India cannot afford fear-mongering. We need to give confidence to the people with our words and with our action.
Well, that's the Finance Minister. We'll head into a break, but up next, Bengaluru startup Pronto has come under scrutiny after it admitted to using footage recorded inside customers' homes to help train physical AI and robotic systems. That and more when we return. Well, quick home services startup Pronto is under scrutiny after it admitted to using footage recorded in customers' homes to train physical AI systems. The company says the camera-based pilot was strictly opt-in and covered only a few users. Rachna is standing by now with more details. Rachna, take us through what has happened here exactly, and we're given to understand that the government is now looking into this.
That's right. Pronto is a home services startup founded by 23-year-old Anjani Sardana. Since its launch last year, the company has been on an extraordinary growth trajectory. It raised $100 million in Series B funding in March at a valuation of over $100 million. But this week, the company has hit a major scrutiny roadblock. Now, Pronto has been piloting a feature that involves cameras worn by workers during service delivery inside people's homes. The company's workers carry these cameras while cleaning, doing laundry, and handling other household tasks in customers' residences. This has triggered significant backlash on Twitter and other social media platforms, with critics arguing that this represents a direct breach of privacy as it records activities happening inside someone's home. The backlash intensified when Pronto's main competitors weighed in. Snabit founder Ayush Agarwal posted publicly that his company had been approached by several players offering the same technology. He said Snabit studied how this works but chose not to deploy it. Then there was Urban Company. Founder Abhirat Singh Behel made a similar statement, saying his company does not engage in such activities and has no plans to do so. Both the competitors are now positioning privacy as their core advantage against Pronto. When CNBC TV18 reached out to the company to understand what it was doing, Pronto provided a detailed response. The company told us that the camera feature is strictly opt-in, which means customers have to actively choose it at the time of booking. Less than 0.01% of Pronto's customer base has enrolled in this pilot. They also said that the feature of faces, there is a feature that will blur the faces and any identifying details, and they will be automatically blurred before the footage is uploaded. So all the video that is uploaded in their service is then automatically deleted within 48 hours from the service. The company also stated that it is not sharing this data with any third-party AI labs. But the broader privacy question still remains. Main privacy policy, which is on Pronto's app, contains language allowing indefinite use of aggregated household data for unspecified research or statistical purpose. So will this also qualify under that? All of that is unknown. Now, under India's data protection law, consent must be purpose specific, which means customers who book a cleaning service, they're consenting to the service and not to the indefinite research use of the data gathered. These are fundamentally different purposes. Now, the Union Ministry of Technology, Information and Technology is looking into Pronto's practices. So this is shaping up to be India's first major enforcement test of the Digital Personal Data Protection Act. So we'll have to see where this goes.
Yes, we will. Rachna, many thanks for joining us. And that's it then on this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. We're back in a moment after a very short break.
Now, 6 to 8 years ago, a smart mattress sounded niche, a luxury villa rental sounded aspirational, and of course, a billion-dollar food company without dining rooms sounded improbable. Today, all three are mainstream consumer behaviors, thanks to these gentlemen and founders on stage with me. So let's find out how they won in markets that didn't exist before. Harshal, let me quickly start with you. The sleep company was founded in 2019. And your first offline store was opened in mid-2020. So that means the earliest phase of customer education largely happened online and during the pandemic years. So how did this unusual start sort of shape the company's DNA in terms of, storytelling, customer trust, product demonstration, and of course, the later pivot to offline retail?
Yeah. So we started in 2019, and we started by selling online in a category which had to be felt, a category which had to be experienced. And very early on in our journey, we realized that it was a tough job, and the only way to do it was to make sure that your content was like your demonstration and ensuring that you give a lot of clarity out to your customers and keep it very simple. So we launched our own proprietary patented material called the Smart Grid technology and tried to keep the science of it very, very simple. And that really helped us going forward when we opened our stores, because it gave us a lot of clarity in terms of really understanding customer pain points, designing our stores and our customer journeys around it, and ensuring that today sleep is just not taken lightly, but very, very seriously, and people are given and made to experience all the right kind of products.
Absolutely, because this category was not heard of. And so what you're saying is that being digital first actually helped you, later help the offline expansion be more sharper, more data-led. Pranav, let me first go to you now. Stay Vista started with a single holiday home in 2015 in Lodavla, long before luxury villa rentals sort of became a mainstream travel category in India. Did you ever second-guess yourself or question yourself whether, affluent Indian travelers will trust professionally managed vacation homes? And what was the first signal that gave you the confidence that this was no longer a niche business, but it was actually a structural travel shift?
Yeah, so absolutely. In fact, when we started back in 2015, the market was very, very unorganized. So market always existed. There are more and enough homes in the country, but these homes were always locked, or the way to book these homes was very unorganized. What we came up with was trying to build a reliability aspect to this market, which was unorganized. And it was a matter of time. Indians as a community love to travel together. We travel in families, friends, milestones, events, all of this. So it was just a matter of time someone raises their hand up and says that, okay, I am going to build reliability in terms of the space, F&B offerings, the entire experience, and ensure that the trust can come into the space. So we were lucky that many of our homeowners trusted us and allowed us to open their home, which was earlier, the access was reduced to only few. So the large part of credit goes to the homeowners who allowed us to do that. And then once someone tasted their blood in terms of ensuring the private spaces is great, the memories which you can create in a home is unparalleled while the group being together. So that really worked the magic for us.
So did you remember that, do you have a fond memory of when you were like, yes, this has become a mainstream shift?
So when we started with 4 homes. In the second month, we got a call asking that, can I go to another place? And typically in hospitality, user acquisition cost is very high, loyalty is very low. We realized very soon that both on demand and supply side, the loyalty was very, very high. Almost 70% of our guests, even today, are repeat and referral. And almost 60% of our homes comes through references. So that made us realize that there is a business which you can build in with sensible unit economics and a profitability to it in the hospitality segment.
All right. Ankush, let me come to you, the true rebel that we have on the panel. Rebel Foods, you literally pioneered the idea that restaurant brands could scale without having dining rooms. The recent funding that you raised last year, QIA, they suggest that Rebel is now looking at physical restaurants and food court spaces alongside cloud kitchens. Now, is this a strategic move, or is it simply the next evolution of building omni-channel food brands in India?
Yeah, so I think, first of all, our purpose for for 14 years we've been building this is always because almost all industries, technology changed, like the way people shop, the way